Good morning, dear students. Today we are going to start the marathon in financial management. Just now I told you CA is not a tough course, but it is a course for tough people. Yeah, if you observe the pass percentage of CA, some students who implement the best strategy in exam, they used to get the ranks. Hello, but coming to some students, they may not able to clear the exam. So the difference between these two is, my point of view is, they don't have proper examination strategy, because your question paper and your examination subject or talent or presentation, everything is examined by who? CA Institute. Are you getting my point? For that purpose, just now I told you, you must have proper strategy. So what are the strategies to be identified? Here it indicates you must have learning. Means any chapter, each and every chapter we have time value of money, cost of capital, capital structure and everything. Each and every chapter has several problems, and each problem has its own concepts. Once you are able to identify that concepts, right, that is a learning, means understanding that concepts, not solving with a number of problems, right, and learning that concept and practicing and attempting and having a winning desire, certainly you can crack the exam strategy of CA Institute. And the point is, just now I told you, even Sachin, Dhoni, Virat, whomever it may be, before going to exam, they go to the ground and check, they will check the pitch, because check it before, what is it? Hit it. Once you cannot check the pitch and wind and everything, who is the bowler, what is his way of gaming, what is his game plan, and without knowing everything, simply if you go and if you want to make attempt like 7th class, 10th class, right, then Jai Hind, you would be Satadhruva Vamsam. Fir bhi aayega, Malli. Yeah, that is the reason you must have proper plan. So, proper plan means, in order to clear exam, being a student of CA, you must have a plan. When you don't have a plan, believe that you have a what? Plan. But in this class, I will give you plan how to identify your question paper, right? Before going to analyze what is the concept mean, first of all, we will analyze our pitch. What is a pitch? For Dhoni, pitch is a ground. For our pitch is, if you make analysis, you can hit. So ball should cross the border of the country, not boundary. Boundary, so common dialogue, you know. Alright. So, you know, FM financial management question paper you are going to write within after a couple of days. Yes, ma, you know. Sure. Right. Here the point is, dear students, financial management question paper, you will find 3 segments. First one, question 1. It is a compulsory question. So in this compulsory question, you have four questions. Each carries 5 marks. That's why already I told you, learning strategy means from which chapter, which concept there is a chance to ask for 5 marks. You must have the plan. Marginal cost of capital come weighted average cost of capital, could you expect 5 marks? Weighted average cost of capital basing on book value, market value, can expect 5 marks. Calculate NPV, payback period, discounted payback period, profitability index, 5 marks. No, it should not. So which concept they may chance to ask 5 marks and which concept they may chance to ask what? 20 marks, you should be able to identify. Here 4 questions, dear students. Each carries 5 marks. Are you getting? And here it is. Each carries 5 marks. So you have a multiple chapters, right? We have, what are the chapters? Approximately cost of capital, capital structure, leverages, risk, dividend decision, capital budgeting, ratio analysis, and one more, advanced concept. Yes or no? So from this aspect, you have to plan for first given question 4 questions. Are you getting? This is, and thereafter, this is completely, what is it? Problematic. Are you getting, ma? I am writing here, whatever I am writing, I will save it. This is nothing but, and thereafter question number 2, 3, 4, 5. This is also problem. So here 4 into, here you will score how many marks? 4 marks. Here already 20. So 4 into 10, 40 marks. Hello? And here 20. It means that, dear students, by observing this one, we can say FM is not a theory paper. It is, what is it? Problematic. Do you agree? And whereas any of the problem in the given problems is really problematic, then better to go with, what is it? Theory part. In theory part, you will have question number 6. This question number 6, you have 1, 2, 3 alternative. For first question you will have a 4 marks, second question 4 marks, and third question you have an internal choice. Okay, total 10 marks. Any of the problem from 2, 3, 4, 5, among the 4 problems, any problem is tough, then better to choose what is it? Theory part. For the theory part, what are the chapters so important means scope and objective of FM, and at the same time working capital management, and at the same time types of finance. What are the chapters? Scope of what is it? FM and working capital management. In working capital management you have a theories. Do you know? Baumol theory, Miller theory. That's why first priority go with the scope. Second priority go with the scope. First types. Second scope. Third one what is it? Working capital financing you give the least priority. Okay. That would be the identity. Once you have this question paper analysis with support of Balu sir marathon class, let's crack. Shall we start? It's CA also, man. This is exclusively I prepared for CA Inter. That is only, man. That is a secondary concept. Here you have financial management. First of all, you should understand what is a financial management. From this session, I observed the past question papers. You have a 2 marks, you have a 4 marks, you have a 4 marks. So from 2018 to up to the time point, I observed there are certain, frequently they've been asking certain questions. Question number 1, what is a financial management? Question number 2, what are the major decisions of financial management? Question number 3, what are the aspects of financial management? So these are the means 3 questions frequently they are asking. Along with this, they would be asked the objective of financial management. Hello? Objectives. Here it is. The first one is we are studying financial management not with respect to what is it? Personal. What is it? Personal respect. We are studying with respect to what is it? Company, right? Company type of business. That is an important point. Before that, you should understand at least what is a business. But generally, people have same identity that business and trade both are same, right? They will identify that trade and what is it? Business both are same. But the point is you should have a difference between these two. So buying and selling of goods and services with an objective to earn profit is called just what? Trade. But business includes one more point is called what is that? Manufacturing. What is that? Manufacturing. So business comes to, what is the business indicate here? It is a production and at the same time marketing and at the same time sale and must generate what is that? Profit. Hello? You must able to generate a profit. This activity should run in a continuous manner. It indicates that production and at the same time sale and marketing and continue manner you should able to generate. What is the difference between trade and business? Buying and selling goods and services with an object to earn profit is called what? Trade. But it includes manufacturing, producing production and selling in the market is called what? Business. Right. Here today in the market if you observe, business includes what is that? Various aspects to be considered. What is that? You have to produce. The question arises here is what to produce, where to produce, how to produce. Yes or no? Everything to be considered. At the same time once you produce, you must have proper what is it? Research. And at the same time you must have good sale and marketing strategy. And at the same time you should have wonderful office and administration. So while considering all the aspect, you should able to do production and make a sale. But it is a traditional concept. Nowadays we are learning the financial management, that from the financial management viewpoint of view, business is not simply a task of this 4. Now you have to understand what is the most important point is, what is this? Government rules and regulations. Just 2 days back Switzerland banned completely tobaccos. Government has taken with effect, you are the company financial manager of ITC, what would be the impact? Because Indian government also got the inspiration from Switzerland and they also going to implement what? The same strategy. With effect, ITC company profit may be drastically affected. Yes or no? Then you have to follow customer behavior. And you know that nano car is the one of the best example. When nano car was initially initiated, all the customers in India, they showed a positive attitude towards the buy this car. But once actually car was produced and brought to market, people raise their hands. So that is another important point, means you should also follow what is it? Customer behavior and at the same time competition. You know the Geo effect, how the Geo created a miracle. So geo competition, sometimes even you produce research, sale and marketing, sometimes when you are not able to handle what is it, competition, you cannot survive. And at the same time, finally, environmental factors. Revlon is a company which was going for liquidation because of COVID impact. The company which has a magnificent sales revenue in lipstick manufacturing, because of COVID, entirely sales has gone because all the people mask. Then what is the sale? That's why production, sale and marketing, office and administration, government rules and regulations, customer and behavior, competition, environmental factors, considering all these things, being in the cutthroat competition, right? Doing business is not getting success is not a simple thing. It is really risky. Yes. But even that a risky, people will say that will you do business in an easy manner, means the people will believe that what is it? It is a hard. We are not going to do this business. Okay. But the thing is, once you have what is it? Proper what is it? Decision, it could be possible. Okay, because any of the decision if you take successfully, even considering all the aspects, you can run your business perfectly. So do you have any proof of evidence? I have proof of evidence. The Videocon company took lot of decisions, but they went wrong. With effect, what happened? 6,760 crores of loss they projected, and with effect, once the share price was 800 rupees, came to 2.80. Is it now tell me business is risky? Yes or no? And she is a promoter, she is not a promoter, she is a equity shareholders, right? After completion of our class, she is going to do suicide because 800 rupees share price came to how? 2 rupees. That's why many people used to say business is risk. And along with this, I will support you one of this man. Who? Anil Ambani, father of Dhirubhai Ambani. Yes or no? Very good. Thank you very much. Son of whom? Dhirubhai Ambani, brother of Mukesh Ambani. He also submitted 30,142 crores of loss. Now tell me, 30,142 crores loss in one financial year means, is it not because of decision? Is it one decision? No, such as several decisions. That is the reason people used to say, Balu sir, risk. That's why don't do. No, this is one side. Okay, see another side. Chudu, oka vaipe kaadu. ఇంకొక వైపు చూడు. In 1990, if you might have invested in Wipro company, 10,000 rupees turns to 741 crores. This is a report is saying. A company just investment of how much? 10,000 may turns to 741 crore, means try to understand this is the success of effective decisions. So what I would like to say is, from the above observation, 3 points is confirmed. What we studying with respect to business, with respect to corporate business, large scale business, with not what small scale. Business is business includes a risk, but the profit is reward of risk taking. Once you take a decision, if something goes wrong, you know the case study of Videocon as well as Reliance. And at the same time, if you take successful decision, it may gives you a positive return, like which one? Wipro, right? But what happened? You must able to take a decision. In order to take a decision, which subject we have to learn to take effective decision means, that is our subject, which one? Financial management, right? What is a financial management? 2 marks question. From 2018 to 2013, if I observe 4 times they ask this same question. What is financial management? Before going to financial management, you should understand financial management is a title. This title itself is a 2 parts. One is what is it? Finance. Another one is what is it? Management. But in detail, finance is called blood of the business. Finance is called science of money. Whatever study with respect to money oriented activities, everything comes under the category of what is it? Finance. So banks, how banks works, mutual funds, how it works, exports, imports, forex, everything comes under what is it? Finance. Are you getting? Finance. And that is the reason in India we have finance minister, but we don't have what? Money minister. So finance is a wider concept, money is the narrow concept. Got it? And second important point is, several times they asked a 2 marks question. What is a financial management? So financial management is what? It is a systematic management of business finance. What is that? Systematic management of business finance. And it is the managerial activity. What activity? Managerial activity, which considers planning, controlling. Whenever you are going to undertake any business, you must have what? Plan. Plan, it indicates what to do, how much capital is needed, how would this finance to be procured, how this finance to be utilized, what the results you are getting. Before making a plan, everybody have their own objective. Yes or no? Once your plan executes, it gives a results. Yes or no? That results and actual plan should be, what is that? Compared. Once the results and at the same time your planned objectives both will matches, let's continue. Hello? If not, then you have to take another concept. Which one? Control. Hello? Control to be comes to the picture only once. Only once. You don't know once what the results you expected, what the results you are achieving, what is the difference in this between. So that would be, what is that? Planning and what is that? Control of financial management. So 2018 to previous attempt, 4 times this question came. What is the financial management? Clear now? Right. And another important point they've been asking, what are the 2 basic aspects? 4 marks questions. Regularly asking. What is the basic aspects of financial management? There is a 2 aspects. What are they? One is procurement of funds. Another one is, what is it? Utilization. Procurement and utilization. These are the 2 basic aspects. Compulsory, you can expect 4 marks question. Just you listen, you write down, that's enough. Right? Just listen carefully, that's enough. Financial management aspect 2 times. Or you may ask, tell me basic functions. Sometimes they may cheat you. With the title they will ask you, what are they? Basic functions. Write the financial management functions means you can write any of the function, right? Discussing with employees, raising bank loan, paying it, right? Investing, everything. But if the question is asked like this, what? Sir, 2 basic functions, tell me. 2 basic functions means basic function number 1, what is it? Procurement of funds and utilization of funds. But only by writing these 2 concepts will you get 4 marks, dears? No, you have to elaborate. How you are going to elaborate? Procurement of funds means what? What you have to write to get what? 4 marks, right? Procurement of funds means you have to define what are the sources. In order to procure the funds, the financial manager has 2 choices. One is long-term funds, short-term funds. This is the 1 point. And while raising these funds, you should consider 4 points. What are they? Cost, risk, control, government, rules and regulations. So funds can be procured from how many sources? Either long-term sources, short-term sources. So what the way we have to procure? Sir, we need 100 crores. We procured, sir. Hello, my dear, you procured funds. But once you don't know exactly how much funds is required, then you are going to be overcapitalization. Hello? In overcapitalization, you have to pay high interest. High interest leads to high cost, leads to low profit. That's gone. Okay, I will raise, sir, in order to control cost, sir, I will raise less funds, right? Less funds means you will fall into undercapitalization. In order to run the company with the undercapitalization means sometimes you have to do certain illegal activities, no doubt at all. And sometimes you might have cheat employees also because you don't have adequate capital. Then legally you would be punished. So your business might be closed because you are not at all obeying government rules and regulations. So that is the reason, dear students, what are the factors to be considered? Cost, risk, control, government, rules and regulations. Once the funds are procured, what should we do? You should not, what is it? Idle. Funds should not be kept idle. Okay. Funds should be utilized in what assets? Fixed asset, current assets. Considering that while investing in fixed asset, current assets, you must generate return because you raise these funds, you have to pay what? Cost. So you should invest the raised funds in such a way that return should be greater than cost. This is the 2 basic aspects. If you follow these 2 steps, no business in the world will get what? Loss. If any business getting lost means something somewhere they are not at all doing these 2 functions. That's enough. Not several functions. Hardly 2 functions, man. Take any business. Financial management believes that. So these 2 functions they are not at all doing effectively. That would be the reason. Right, ma? That is the reason. Wonderful, important question. And at the same time, what is the financial management? Explain various decisions. See, financial management, financial accounting, both are not same. Accounting is art of recording, classifying, summarizing and interpreting the results of what we have done. That is historical data. Which one? Accounts. Financial management is future. This is guesswork. That is a practical work. Which one practical work? Financial management, guesswork. That's why 4 marks question they may ask you, what is a financial management? Or there would be a question, one more question I said. What is the difference between financial management versus financial accounting? But several times they asked only one question, dear students. Which one? Financial decision. Financial management is a subject of what making? Decision making. How many types of decisions means? You have 3 types. What are they? Financing decision, investment decision, dividend decision. Financing decision means raising of required funds at a least cost by considering risk, cost, control, government rules and regulations. See, in 2 aspects you have to write these decisions as a functions. But if 3 decisions is asked means that 2 aspects will come as a 2 decisions. So that is a financing decision where you are going to raise, what is cost, what is this flotation cost, everything you have to consider. Raising of required funds at a least cost is very, very important decision. And at the same time, whatever the funds you raised, you should not keep that funds idly. You have to invest it various assets. Various assets you have to invest. You have to invest on fixed asset, you have to invest on current assets. With the current assets, you must generate R. That R should be greater than cost. This is the most important. Here C should be very, very low. Here R should be very, very high. When from the return you are getting, even after paying cost, you will get the profit. That profit belongs to equity shareholders. Now what to do? Should I do D? Should I do R? What is that? Dividend decision means should I do R? Should I do D? D means what? Should I pay dividend? R means what? Whatever the stupid thing you may do, sir, but the thing is, Balu sir, market price of the company should increase. So these are the most important point, dear students. So maximum, if you observe past question papers, 6 marks compulsory questions I dealt with, and one more bonus question I gave. What is it? What is the difference between? Yeah, sometimes if the problem is question paper is easy, explain financial management functions means you can write all the functions, right? You have to raise, you have to discuss, you have to negotiate, you have to understand that and this. All the functions of financial manager. That is the reason if a financial manager takes these 3 decisions, CA Institute believes that any business, in any business you take it, they may generate the profit. That would be the reason they developed the syllabus. See, you syllabus strategy, I identified this one. And surprisingly, I got it the information. Financial management, procurement of funds, utilization of funds. For procurement of funds, there is a chapter called types of financing. Hello? Thereafter, you have to procure the funds at a least cost means you must study which one? Cost of capital. You must study capital structure. You must study leverages. These 3 chapters are there. Coming to utilization means you have to invest. For investment, you have what assets? Current assets, you have working capital management. You have a fixed asset. Fixed asset means you have 1 chapter capital budgeting 5, one more advanced capital budgeting is 6, and risk in capital budgeting is what is it? 7. Once you do effectively utilization and you generate a return, you may have excess profit, and you have which one? Dividend decision would be 8th. If you want to take all the chapters, one more analysis you need, what is it? Ratio analysis. This would be the CA Institute master plan. You try to understand. Why you are learning? Cost of capital is after leverage, I think so. Or leverage is after, before, that after diff. No, that would be the reason. Are you getting? This is the way they planned it. But the thing is, all the financial management decision is based on one aspect that is called, what is that? Time value of money. So time value of money means here, whatever the functions, whatever the decisions you have to take, all these things are based on one chapter that is called which one? Time value of money. Time value money is not relevant for decision. Time value of relevant for what is it? Principle. So it is one of the basic principle, right, in which all the financial management decisions being based on it. That chapter is called, what is that? Time value of money. Coming to, this is the first concept is finished. Introduction to financial management. Got it, ma? Important questions I told you. Coming to time value of money. Time value of money is not at all relevant for decision making. Do you agree? It is not at all relevant for decision making. It is just an academic purpose. But you know, before going to understand financial management, at least you must have the conceptual knowledge of what is that? Time value of money. I won't spend much time within 10 minutes because we used to spend for 1 week approximately. But maximum, what is the time value of money? So time value of money, it indicates, what is that? It is a basic principle. Just now I told you, time value money is what? It is a basic principle in which all the financial management decisions are based on it. Once you don't know, being a financial manager, you have to take a decision. But if you want to take a decision, you must know what is it? One of the basic principle. That basic principle is nothing but time value of money. So time value of money is the basic principle in which all the financial management decisions are based on it. What this time value of money it indicates? This time value money indicates value of rupee today is not equal to value of rupee to be earned in future. That's enough. Sir, only this? Yeah, but that small line gives you lot of analysis before taking investment decision, financing decision, dividend decision. So how? Because this indicates rupee today worth more than rupee to be earned in future. For example, here 500 rupees now at present. After 5 years also, if you have 500 rupees, both are same? No, not same. From the currency point of view, both may be 500. Here also Gandhi is there, here also Gandhi is there. But both are same? Yeah, both are same. The person who believes that he don't know basic ideology with respect to finance. If such a person takes any decision, Jai Hind. But we have to believe that no, from the currency point of view, both are same. From purchasing capacity point of view, both are not same. Then which rupee is worthable? Present rupee is worthable. Present rupee worthable means what I do? Wherever you will invest, same options, wherever you will invest, if the same that business or that bank, they will assure you to give same amount in future, will you take? No, because you believe that. So currency point of view, it would be same. But purchasing capacity point of view, both are not same. Right? Here what it indicates. Let us take an example here. You are the investor, Mr. Subbarao. He deposited 10 lakhs in SBI Bank at Bradipet. He hold it for how many years? 10 years. After 10 years, he went there and he asked, sir, give me my money back. Then bank comfortably gave how much? 10 lakhs. Sir, thank you very much. Take your 10 lakhs means Mr. Subbarao takes. Because same 10 lakh, both are same. No, you should not. Why? Because 10 years he hand over this money to there, right? If the same money gives means, sir, whatever the money you gave, same money we gave it. So sir, you are giving same money means you don't know time value of money. Taking same money means, I don't know. You have to give certain additional amount, sir. Why? Because present rupee, whatever I gave it, that is really worthful than what you are giving. Then he may crack the joke. Sir, if you go to the temple, right, you may leave your shoes outside, right? After darshanam, will you ask small extra shoes, sir? No? Right. If the such situation is acceptable with respect to temple, but not with respect to money and banks, what we have to do means, will you accept? No. The reason is that present rupee has more worthable. Because present rupee has, if the client asks that, why you are expecting additional money, man? Because whatever the rupee I spent is more valuable than the rupee what you are going to give. Do you have any proof of evidence? Means we can say, number one, what is it? Opportunity cost benefit. Today 10 lakh is there. I gave to you. After 10 years you are giving same amount, right? For example, if I don't have given to you, right? I wouldn't have given to you. I might have invested outside. Then certainly I might have got what? Opportunity cost benefit. Number two, what is it? Inflation. Present rupee don't have what? Inflation. Future rupee have inflation. Present preference for present rupee. 10 years I deposited your money means 10 years I might have postponed my preferences. Yes or no? For that purpose, I should expect something written back. And finally, taking future money, right? Taking future money as it is same means, for example, I gave the money to you. After 10 years, you are giving back. But during the 10 years, I faced what? Risk. Are you getting? So, because of all the reasons, present rupee is always worthable. For that purpose, what we have to do is, same amount I won't take you, but I will expect. Yeah, same amount I will take you, but here I will expect. If I deposit 500, I don't take this 500 exactly. If you give this much, I will take. That extra money is called, what is that? Time value of money. It means that what? Whenever you will invest, keep it in mind. This time value money indicates whenever you do business, you have to expect a time value money in the form of profit. Whenever you do deposit in bank, right? You should expect, what is it? Interest. So the business which won't give you any profit means that business don't have what is a basic sense of what? Time value of money. Such a business don't do. So here we have such an approaches, because when we deposit our money in business, we will expect a time value money as a profit. Okay. But actually that business involves risk. But how much time value of money or return we should expect from businesses depends upon, without risk, how much we supposed to generate. For that purpose, we have to analyze how bank computes, what is it? Interest. You know that simple interest? Yeah, simple interest. Simple interest, simply they give interest. Interest on interest, not possible. Okay, simple interest formula? PNR. Yes or no? Do you have calculators? Can you able to solve? If I deposit 6,000, take the calculator, 6% and 5 years, what would be the value? 18,000, is it right? And the amount would be, if I add this principal, I will get it how much? So 18,000 plus 60,000, how much? 78,000. Got it, ma? Simple interest is not. Today financial system, RBI could not accepted which one? Simple interest. There is another method came into picture. What is it? Compounding. Here you should understand what is the meaning of compounding. The word compounding means interest add back to principal. So interest add backs to principal and forms the principal in order to calculate interest. Thus this method gives interest on interest is possible. Interest again converted into principal, and hence one can earn interest on interest because it considers opportunity cost benefit of investor. Basing on this, we used to calculate future value of single amount. Future value of single amount means sometimes the client may come, sir, I have this much amount, I need this much amount, I have this much, I need this much. At what rate I should deposit? How long I have to deposit? At what compounding pattern I should deposit, so that to get that much of amount? He may ask you, you may ask you. And being a financial manager, in order to solve this issue, you have to understand how to calculate future value of single amount. Which table supports you? Future value table number 1 or cumulative value factor table. Future value factor, future value, how do you calculate? Present value into future value factor or percentage n number of years. But here many people, they believe that R is nothing but rate of interest per annum. But R is not rate of interest per annum, rate of interest per compounding. N means number of compoundings in a given year, and sometimes compounding may take place how much? Annually, quarterly, monthly, daily. In such a situation, R to be divided with the compoundings, yes or no? N to be multiplied with the compoundings. Then you have to use the formula where future value equal to present value, R to be divided, N to be multiplied. With this aspect you can calculate. Can you understand here? If you deposit 1,000 today, bank pays how much rate? 12%, compounding annually above 4 years, 8 years. Then in which situation company able to generate more future value? 4 years or 8 years? If you deposit 1,000 today, if the bank gives 12% rate of interest, if you hold for how many years? 4 years, 8 years means at which situation you may generate more future value? 8 years, because 8 times interest you used to get it. In 4 years, this would be hardly 1,574. In 8 years, it would be 2,476, right? Thereafter, you have a present value. It is very, very important for capital budgeting, the next chapter what we're going to discuss. Because in capital budgeting, future cash inflow should be brought into present. So present value means what is it? This is the value of rupee she is going to get. In order to get this future value, how much she has to invest as on today is nothing but present value. Future value includes what is it? Present value plus interest. What you have to do? You have to deduct the interest to find what value? Present value. The process of finding present value is called discounting. The process of finding future value is called compounding. Are you getting? So present value, why we should learn present value, sir? So present value enables, what is this? How much to be deposited. Because investment decision, capital budgeting, NPV calculation, everything for this present value is very, very important. Without touching this one, if I start even capital budgeting, those students who have awareness with respect to present value, they can. But those students who don't know exactly means, for this video would be useful for them, right? So present value. To calculate present value, what is the formula? Present value equal to future value divided by future value factor. This is one alternative. Another alternative is there, what is it? Future value divided by future value, present value equal to future value into present value factor. Future value factor we will be available in table number 1. Present value factor is available at a table number 3. And thereafter we had a discussion. You see here, Mr. X has to buy a machine 20 lakhs after how many years? 3 years. How much has to invest now means whatever this 20 lakhs would be future value. Rate is 10%. N is 3 years. So in order to find the present value, you know the formula of present value? Present value equal to future value into present value factor. Present value factor 0.751. If you multiply, this would be 15 lakhs 2000. It means that if you hold it 15 lakh 2000, if you deposit at 10%, if you hold it for how many years? 3 years, then this amount will become how much? 20 lakhs. So this is the present value concept. Thereafter you have future value of annuity. Annuity indicates what is that? So series of cash inflow it indicates. Annuity indicates a stream of regular periodic payment made or received specific time frame. Same cash inflow when you receives, then it is called what is it? Present value of annuity. If you are going to deposit and if you want to find in future, then it is called what is it? Future value of annuity. Future value of annuity enables systematic saving. Here you see, here is a gentleman. He want to buy this building. Okay, mastermind wants to start a branch, or anybody have fixed financial commitments. For the sake of commitments, if the people wants to save, future value of annuity is a wonderful concept, supports you. Future value of annuity, how do you calculate? This is the same amount, this is called annuity. With this amount, if you calculate the future, right, then it would be what is it? Future value of annuity. And if the same amount going to get it in present, if you find it out, this is called what is it? Present value of annuity. Right, future value of annuity formula, how do you calculate? Future value of annuity equal to periodic payment into future value of annuity factor R percentage n number of years. And what about the present value of annuity? Present value of annuity indicates, here you see here in front of you there is an investor. He is saying that later he is going to get money, but the people are asking to deposit what? Now. So he is going to get later, but the people are asking now. For example, X is a company which says I will give you 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. Over the period of 8 years, 8 lakhs I will give you. Just to deposit 5 lakhs means what happened? From 8 minus 5, so 3 lakhs we got the profit. Will you take decision like that? No. So what you have to do is, we have to calculate present value of annuity. Agrigold Finance is a case study, wonderfully influences not having the knowledge of present value of annuity. Because we don't know exactly how much to be deposited. The people start blindly, they used to compare present value with what money? Future money, they made it investment. For whatever the future you are going to get it, what you have to do? You have to bring into present. After bringing the total, whatever the value you will get, it is called what is that? Present value of annuity. Present value of annuity can be computed like this. What? Periodic payment into present value of annuity factor R percentage n number of years, right? Thereafter you have, suppose here you see, a nationalized bank agrees to pay how much? 25,000 over the period of 5 years. If the rate of interest is 10%, Mr. Jain wants to know what is its total worth. Now what we do? Present value of annuity, every year periodic payment 25,000, rate 10% n. So present value of annuity equal to periodic payment 25,000 into present value of annuity factor 10% 5. If you bring into present, it would be 3.791 would be the present value annuity factor. It would be how much? 94,775. Actually they are going to get it 25 means 525 means 1 lakh 25,000. If the bank may insist you to deposit 1 lakh, right? Now in such a case, will it decision right or wrong? Wrong. Why? Because a layman who don't know the concept of present value of annuity, he accept this proposal thinking that I am getting how much? 25,000 benefit. But actually those students who know the time value of money, they believe that investing 1 lakh also not at all beneficial. Even it is a worst class. Even just if you deposit 94,775, you won't get it. No profit, no loss. That is the power of time value of money. And thereafter you have a perpetuity. So perpetuity means if we invest now, forever income we need it. Puttaparthi group of organization, Tirumala Tirupati Devasthanams, Vatican City, all this organization, they have a lot of expenditure. So whether devotees give or not to give the money, right? They need forever income to take the expenditure what is there. So here you have two types of perpetuities. What are they? Ordinary perpetuity, growing perpetuity. Ordinary perpetuity means the same cash inflow you are going to receive in long period. How do you calculate ordinary perpetuity? Cash flow divided by rate of interest. Forever income, if you want to get it, means, so how much amount to be deposited now? Very simple. How much money you want to get it? Take the cash flow divided by with what? Rate. You will get the present value of perpetuity. And what only with the perpetuity, here you see, forever 10,000 is needed. What is the rate of interest is available? 10% rate of interest, but investor expected rate is 15%. Means if you deposit 10,000 at 10%, you are going to get 1,000, and investor expected rate is 15. If you bring this cash flow into 15, how much it is? 6,667 is the total worth you are going to get it at infinite time period. So Tirumala Tirupati Devasthanam, Puttaparthi group of organization, case study, how they successfully running means because of the perpetuity. But sometimes there might be a small issue with respect to creating perpetuity. Reason is that because they will give you same cash inflow. When cash inflow same manner you are going to get it over the period, right? You are ignoring impact of what? Inflation. When ignoring impact of inflation means it's not a right thing. For that purpose, you have to create one more perpetuity. What is it? Growing perpetuity. Present value of growing perpetuity, how do you calculate? Cash flow divided by rate minus growth rate. Then you are going to find it out, present value of perpetuity. Are you getting by these students? So this is the point, time value of money. Hardly within 15 minutes we recovered all the points. Simple interest formula. Simple interest. Future value of single amount. Present value into future value factor R percentage n number of years. Present value. Why should we learn present value? How much to be deposited? Why should we learn future value of annuity? When you have any commitments in future, it enables you to make what? Systematic saving. Why should we learn present value of annuity? Because to handle investment decision. Right? Why should we learn perpetuities? Reason is simple. Sometimes problem is permanent. Don't think about what is it? Temporary solutions. Problem is permanent. For that, don't think what is it? Temporary solution, right? So with this, we completed which one? Time value of money, right? And the next concept we are going to discuss is capital budgeting. So this is the one of the restaurant in Israel. You try to understand how big it is. This is the restaurant they constructed. Still we are struggling for Polavaram. Okay, what the difference is? Nothing but they have excellent executive capital budgeting. And previous class also, in order to make you remember, by taking sand in the ship and filling it and making land and constructing land in the ocean, and they constructed apartments and they sold. You know that why are you mad means a financial manager says no sir, you have to take a decision. Why sir? Why sir? Why you are going to ocean sir? You can construct close to Arangalpet. No sir. When you fill the ocean and if you sell the if you fill the ocean and creating land and constructing apartment, selling means you are not going to sell for popcorn price. Yes or no? The price also would be right. Now tell me, if you are the financial manager, can't you make evaluation whether it is worthful or not? You try to understand this much of efforts they are taking. Hello, taking sand, filling the land and developing artificial land and constructing like this and selling one apartment means how much cost, how much of time they spent, right? Are they puppets or innocent fools? What is this is the, you see, in long shot. And it would be, this building would be like this. Here is this building, this much of investment. And coming to surprise, this much of efforts they have taken. Dubai Palm Island, one Palm Island cost is how much? Kitna re? Crores. 677 crores is a one duplex apartment price is the best one. Of course, if it is a very, very worst one, similar to Bradipet apartment, of course it seems to be 67 crores, right? But how many apartments they sold? These many apartments. Before constructing, they made a plan. Now tell me, is it last one? Is it risky one? No risky. They were nothing but they felt very, very wonderful. Konre, how to evaluate this, sir? We too have ocean. మనకి సముద్రం ఉంది, మన దగ్గర కూడా ఇసుక ఉంది. మనకి సముద్రం ఉంది, మనకి ఇసుకుంది, మనకు కూడా కావాలి ఎంత, 677 crores. But what happened, our kallu would be pellipothai. But we don't have a strategy, but they have a strategy to do this one. You try to understand these many apartments they are selling for this one means try to understand. Now that is the reason they are constructing this. This is the moon restaurant. This is the grandfather of that one. Where you can see the train would be there within this apartment. Train ఉంటుందంట దీని లోపల, అంటే ఇంటర్నల్గా ట్రైన్ వెళుద్దంట. అంటే చూడు ఇందు లోపల ట్రైన్ వేసుకొని వెళ్తే ఇన్ఛార్జ్ రావాలనుకోండి, అక్కడ రే మాట్లాడబాకంటే టికెట్ తీసుకోండి సార్ అనాలి. ఇక్కడ టికెట్ ఎక్కి ఫస్ట్ బెంచ్ దగ్గర ఆగి అక్కడ మాట్లాడి అక్కడ వెళ్తాడు. అలా ఆలోచించడానికి హౌ ఇట్ ఈస్ వెరీ షాకింగ్. బట్ యు నో రియల్లీ దిస్ ఈస్ ఆల్సో షాకింగ్, రైట్ మ్యాన్? This is also shocking, taking sand here, going there. This is also shocking, but this is too much. But how they are going to do, sir? That is already worked out. This is work in progress. But how they could do capital budgeting? That is our chapter. That chapter you are going to learn 1 hour exactly, right? All the points and maximum including problems also I cover. But capital budgeting, surprisingly, they not only asked problems but also theory part. One of the regular common question, what is a capital budgeting? Theory question, they are already attempted this one. Dear students, follow this one. What is a capital budgeting? What is capital budgeting? Question number 1. Okay, na? Capital budgeting is, what is a capital budgeting? 2 marks question you can expect. Capital budgeting is the evaluation and selection of short term or long term? Long term projects. Only when you write this word, you may get it the 1.5 marks exactly. This is a long-term project. It is also called capital expenditure planning. What is, okay? Why we should learn, sir, capital budgeting, sir? Capital budgeting enables how to invest on what asset? Fixed asset. How much to invest on what is it? Long-term project. Whether it is worthwhile to invest or not. All the questions. If anybody have the identity that, sir, could it possible, sir? Sir, could it possible, sir? Sir, could it possible this one, sir? This one, this much of restaurant, could it possible, sir? So because you know they made it evaluation, because the person who don't know financial management while saying filling ocean and selling constructing apartment and means they will keep the face like this. ఇలా చూసాడు దిష్టి బొమ్మ చూసినాడు, ఎలా పాసిబుల్ రా అని. పాసిబుల్ చింతకాయ. If you have calculator, learn certain techniques, you can identify it. When you evaluate like this, you see the bank manager, you see the inventory manager, see Dubai king, Dubai queen, they should be shocked while seeing this one. How could it possible, sir? Yes, I have a knowledge of what is it? Capital budgeting. Capital budgeting means, sir, immediately they will ask you, systematically investment on current assets. Yes or no? Only fixed asset. If in order to generate return from fixed asset, sometimes you may also make, what is it? Current assets, right? Here 4 marks question they may ask you. What is the purpose? What is the significance? Why we should learn capital budgeting means because the investment what you are going to make on fixed asset includes, what is it? What expenditure? Substantial expenditure. What is a substantial? More. And at the same time it is short period or long period? Long period. Impact. Long period or short period means long period impact. And is it irreversible? Irreversible. Irreversible. Once you make investment, you are not going to get it money back. That's why you have to think 1000 times and then you have to make investment. And finally, investing such a huge fund on the project is not a simplex. It is what? Complex. So SLIC, this is the shortcut. S means substantial expenditure, long term, irreversibility, complex, right? 4 marks question you couldn't expect. Then you know the methods, right? What are the methods? Payback period, forgotten? Payback period, accounting rate of return. Capital budgeting methods being classified into 2 types. What are they? Traditional method ignores, modern method considers. In traditional methods you have payback period and accounting rate of return. In modern method it would be net present value, internal rate of return and profitability index. For I gone with the past exam 2018, just now I been using this word, right? Here I observed only one method they've been using several times. Which one? NPV. And the second one is second priority profitability index. Sorry, profitability index. Third one is IRR and last one is payback period. Remaining techniques they could not ask. You make attention for this, because my support also needed to find it out. NPV, profitability index. Remaining you can read comfortably. Hello? But I will explain, no problem, right? And in order to evaluate any of the project, you should understand any of the method you want to use it. You must be very clear with respect to given aspects. What are they? Cash outflow, cash inflow, life, tax, as well as time value of money. Understand? Before going to before touching capital budgeting chapter, I discussed with you time value of money, because without this, if I come here, certainly you will ask, sir, what is the time value money means? What should I do? Again, I have to go there. That is the reason I spend the time. So time value money, if you don't know, means you cannot learn capital budgeting, right? Coming to here, you should understand the cash flows of the project. Cash flows of the project are skeletons. These are called skeletons. Whenever you want to design any of the method, you should understand cash flows. What is the cash outflows? Means cash outflow is an investment. Cash goes from investment pocket, investor pockets. And here you will find, what is it? Inflows. This is called what inflows? Operating cash inflows. This is, what is that? Terminal cash inflow. Because you brought the cash. With the cash you purchased asset. You used asset for how many years? 4 years. 4 years decently used. Still you have asset. By selling this asset, you may get what cash inflow? Terminal. This terminal cash inflow called, what is it? Optional. Right? For that purpose, I will give you shortcut. 5 years means 5 years. 5 years means 5 years, 5th year. 5 years operating cash inflow. 5th year terminal cash inflow. Beginning cash outflow. This is the code you can understand. 5 years, 5th year. Beginning of the year. Now, any of the problem you can take it. Capital budgeting, NPV, whatever it may be. What is that? This operating cash inflows they are going to consider, right? These are operating cash inflow, you are going to sum it up, and with the terminal cash inflow you are going to compare with cash outflow. Once cash inflows are more than cash outflows, problem is solved. Even if you don't know answer, right? If you project it, give a presentation, you may score the marks. For that purpose, you should understand initial cash outflow. What would be the cash outflow? Cash outflow includes, what is it? Cost of asset plus, what is it? Installation charges, working capital, subsidy, net sale proceeds. Any of the problem you see, toughest problem includes subsidy. What is the treatment of subsidy? So whenever you are doing any business which is really worthful to the society, then certainly government will provide you subsidy. When government provides you subsidy, your cash outflow gradually what happen? Decreases. It is very, very favorable thing. Whenever government gives a subsidy, you feel very happy. Then what about the working capital? You made investment on new asset. New asset means it is what asset? Fixed asset. In order to run the fixed asset, you need additional capital for what? Working. Such a capital is called, what is that? Working capital. Best example, you take the petrol bunk. So petrol bunk is a what asset? Fixed asset. Petrol is current assets. You have to invest on current assets. You have to invest on fixed asset. But fixed assets depreciates. Hello? And sometimes it may disappear. But current assets what happen? Circulates. For example, you purchased 5 lakhs worth of petrol, right? First day you started the petrol bunk. What happens? You started petrol bunk, customers came and you sold the petrol. Now petrol tank become empty, but you have a cash in your pocket, right? Again with that cash, what you are going to do? Buy petrol. When you don't have a cash means you have a petrol. Hello? Once you don't have a petrol means certainly you have a cash. Since this assets what happen? Circulates. That is called reason working capital also called, what is it? Circulating capital. Current asset circulates but will remain same. But fixed asset what happened? Depreciate. 4 problems in new study material keeps this point to ask you. That's enough. Nothing. No need to solve all the problems. Array, what is the treatment? Working capital subsidy. I know. Leave it. That's enough. Time value money factor. You know that. You have to understand. That's the reason. Strategy you need it. You want to prepare means now step 1 PV of cash outflow. I know. This is the treatment. Depreciation SLM method. Tax is there considered. You need to, within this short span, if you want to identify means, you must have the identity. What is the highlight of the problem? Subsidy. Pata hai. Working capital. I know. How working capital you are going to get it at the end of the period? Last. Come to petrol bunk. Come to petrol bunk. Ra? Fixed assets may what happen? Depreciate. Working capital circulates. You take capital budgeting, new study material. Toughest problem includes these 2 concepts. That is, tell me cash outflow, cost of machine, plus installation charges, plus working capital minus subsidy. If you want to replace, if you have old asset, that is a net sale proceeds to be considered. This concept, it considers in advance. For example, you have any old asset, that asset you may sell. With that sales proceeds, you may buy the new asset, means automatically your net sale proceeds what happen? Decreases. Got the point? Are you clear? Cash outflow? Hello? Keep it in mind, one marks in your pocket. And the second one, what do you have to do? Operating cash inflow. Hello? Operating cash inflow would be like this. Take the sales revenue. From the sales revenue, you have to deduct variable cost. Variable cost, one of the problem, variable cost is not given. Instead of variable cost, there is a word given. What cost? Direct cost. So sales minus variable cost, you will get the contribution less fixed cost, PBDT, depreciation. Depreciation, keep it in mind. Depreciation is a non-cash expenses. T and D is the rule. What is that? When tax is there, cello limited problem is there, where depreciation is there, no tax. Next problem, XYZ limited. The two problems model asked several times. Two problems, cello limited, XYZ limited. Remaining problems are general concepts. Once you are able to solve the two problems, take study material, go and prepare well now itself, cello limited, XYZ limited. If you are able to solve this problem, you can handle any problem. But one more problem, I personally say, missing value problem. Okay, missing value problem, it is just conceptual oriented. That's enough. These two problems with respect to cash inflow, very, very important. The two problems I will discuss now itself here, right? Then tax and PBT, tax, accounting profit, add back to depreciation, you will get the tax. Now, what is another name of variable cost? Direct cost. Why tax is, depreciation is a non-cash expenses. Why you have taken? Because if I can't take depreciation, then I supposed to pay more tax. That's why when tax is there, depreciation is there. When no tax, no depreciation. Are you sure, sir? Two problems are like this. If you want to go check it, you can check it, right? So this is the operating cash inflow. Tell me operating cash flow, sales revenue minus variable cost, contribution minus fixed cost, you will get it. PBDT less depreciation, PBT, tax, PAT, add back to depreciation, you will get it. Right. Thereafter, you have a terminal cash inflow also. So in terminal cash inflow, you have a two assets. What are they? Fixed assets, current assets. Current assets you may recover how much? 100%. Fixed assets, for that purpose, what you have to calculate? You have to find it out. Written down value. Written down value means cost minus accumulated depreciation. With that written down value, you have to compare with gross sale proceeds. The difference between gross sale proceeds and written down value defines capital gain and capital loss. If loss is there, very good. When gain is there, profit, gain, both are same. Sir, profit happens in the regular sales revenue, sir. Okay? Gain happens only once time. Profit seems to be operation. Gain seems to be postmortem. एक ही बार होता है जिंदगी में. What is that? पदे पदे చేసుకోవాలంటే వర్కౌట్ కాదు. Okay? That is, so now operating cash inflow, terminal cash inflow, cash outflow. Once you know this one means you can handle any of the problem. Most important point, subsidy, working capital, treatment of depreciation, yes or no? Another name of variable cost. These are the questions, new study material. Each, before preparing this 714, actually 1200 questions, pages I prepared. But because of time is constrained, 2 days I thought it, 1 day. Because of this, I identified this one. You try to understand, I gone with the each and every pages of capital budgeting means your study material, but hardly only that problems are covers. Right? Now, another method, payback period. 2019, your seniors were asked for 10 marks. 10 marks, that question I am going to show here. 2019, anybody completed CA means you ask which batch you are. I completed CA. Which batch chapra? 2019, you pass, అదే క్వశ్చన్ నాకు వచ్చుంటే ర్యాంక్ వచ్చేది దద్దరిల్లిపోయేది. ఎందుకు సార్? బికాస్ దట్ ఇయర్ యు ఆర్ లక్కీ మ్యాన్. నువ్వు ఆషాఢ మాసంలో పుట్టినట్టున్నావు నువ్వు ఆ సంవత్సరం పే బ్యాక్ పీరియడ్ ఎన్ని మార్కులు అడిగాడు? 10 మార్క్స్ అడిగాడు. 10 మార్క్స్ నువ్వు అడిగితే పాస్. అదే నాకు అడుగుంటే దద్దరిల్లిపోయేది. మేబీ ఎక్స్పెక్ట్ విత్ ఇన్ ఎ కపుల్ ఆఫ్ మంత్స్. ఐ ప్రే, ఐ విష్. ఎస్ ఆర్ నో? తిరుపతికి వస్తాను మొక్కున్నా నేను. ఈ ప్రాబ్లం కానీ వచ్చింది 2019 నుంచి ఇప్పటిదాకా అడగలే. ఇప్పటిదాకా కనీసం టచ్ కూడా చేయాల పే బ్యాక్ పీరియడ్ని. మేబీ దాచిపెట్టినాడేమో మీకోసం, అల్లు అర్జున్ దాచిపెట్టినట్టు. మీకు ఇస్తాడు చూడు. This is the payback period. What is a technically payback period? If you make analysis of payback period, take a knife, cut it the payback period into 3 parts like a cake. Pay, back, period. Pay, I invested. Cash inflow comes as a back. What is the time period? That's enough. If you ask means what is a gantal, oogi chadavalra? Pay back period. That's enough. Here you see Mr. Subbarao. Subbarao is going to start a business. Cash outflow goes from his pockets to business, yes or no? And this project is an outflow, right? Outflow goes or comes? Goes. But this project generates 2 types of cash inflow. What is it? OPCI, operating cash inflow, terminal cash inflow. With this cash inflow, this project cash inflow comes to Subbarao pocket. But the Subbarao is asking, how long I have to wait to recover? What is a year? Year plus days are, months are, weeks are. That is called, what is that? Payback period. So simply if you ask this, what is a payback period? Payback period is a time period in which invested cash outflow can be recovered from cash inflow. Sir, should I consider operating come terminal, sir? See man, if you invested this project life is 10 years. If you are able to recover 2 years means remaining year gives you profit, right? But you should, if you depend upon what is that? Terminal cash inflow means your investment waste. That's why 99% you have to prefer which one? Operating cash inflow. How do you calculate payback period? You should understand. To calculate payback period, first one you should estimate cash outflow. That is the reason. Cash outflow నేర్చుకోలేదా payback period వచ్చినా waste మీకు. ఎందుకంటే already cash outflow format ఇచ్చే. Are you getting ma? You should understand, you should read that cash outflow. Cash outflow, if you don't know, I want to solve the payback period means how? Some student they used to ask, sir, payback period very easy, sir. Then I asked, tell me cash inflow. Operating cash flow, how do you calculate? Sir, operating cash inflow, why sir? Why entra? Operating cash inflow untene kada terminal consider చేస్తావు. In the problem they have given simply operating cash inflow. But in NPV they will ask you to calculate operating cash inflow. Are you getting? 2019 they got the 10 marks means luckily they got it. In general you won't get it, right ma? In order to calculate payback period, step 1 what to do? Step 2 cash inflow, how many? See, unable can, there is a rule. Unable means operating cash inflow unable to recover investment, then can, which one? Terminal cash inflow. This is a basic rule. Unable, then only, not can, then. So then finally you have to calculate payback period. In order to calculate payback period, you should understand in 2 ways. Payback period can be computed when cash inflows are uniform, equal every year. In such a case, initial investment divided by annual cash inflow. In every year cash inflow unequal means covered year plus balance divided by next year CFAT. You see in this problem, every year cash inflow equal unequal? Equal. When every year cash inflow equal, what is the payback period? Initial investment how much? 10,000 divided by 5,000. You got it how much? Right. What about the if every year cash inflow unequal? In such a case, you should understand one rule. CB. What is the CB? What is the how much amount you covered? What is the balance? That time period you have to understand. For example, 10,000 you invested. C how much? 2,000. What is the balance? Second year again you got the 3,000 means C 5 balance. Third year 6,000 balance 4. Fourth year again you covered 3 means covered how much? 9,000 balance. It means that hardly you have to wait for how many? 4 years plus. For 5th year, maybe months or weeks. For this purpose, you have to calculate payback period equal to covered year 4 years, balance of how much? 1,000. Next year CFAT how much? 8,000. Now tell me what is the payback period here? 4.125 years. Once you calculate payback period, are you getting ma? How many ways tell me? In order to calculate payback period, first you should understand pattern of cash inflow. Every year uniform, another one is not a uniform. Okay, this is the way to identify payback period. Coming to decision making, how do you take decisions? Once you calculate payback period, you must have what payback period? Standard payback period. If payback period is less than standard payback period, accept. If payback period is more than standard payback period, reject. Payback period is equal to standard payback period, either accept or reject, right? Multiple projects given means you should understand mutually independent, mutually exclusive. Mutually independent, keep it a word, India. Independent means India. India treats all the people equally. Mutually independent means I need all the projects. Hello? All the projects means accept the project which has highest payback period, least payback period, low payback period. Mutually exclusive. Exclusive means keep it a shortcut. Excellent. Excellent only one would be happens. In this class only excellent means rank holders might be one. So in such a case select the project which has what is it? Least payback period. Mutually independent means 5 projects are there, all are need. Multiple mutually independent. Independent shortcut India. అందరూ కావాల్సిందే మనకి. Mutually exclusive. అందరూ వద్దు. ఎవరు కావాలి? Excellent. One person is needed. This is the way. Sir, while calculating payback period, I calculated payback period. Can't I take a decision when I don't have what period? Standard payback period. Yes, absolutely your statement is right. When you don't have a standard payback period, you cannot take decision. Are you getting ma? These are the rules you have to follow. నేను చెప్పిన రూల్స్ మధ్య మధ్యలో మీరు ఫాలో అవ్వాలి. ఈ క్లాస్ అయిపోయి ఇంత కంప్లీట్ చేసినా కూడా మీరు చెప్పింది కన్సిడర్ చేయాలి. వర్కింగ్ క్యాపిటల్ ట్రీట్మెంట్, సబ్సిడీ, ట్యాక్స్, cash inflows in order to calculate payback period, which cash inflow should not be considered? Sometimes we have to consider. When operating cash inflow unable, then what is it? Yeah, coming to, you see, this is the problem. 2019 10 marks they have given. Your super seniors is rocked the market. So these are all. Avuna, you see, this is the project A. How many? 5,000. First year 1,000, second year 1,000, third year 3,000. Now C, B. What is a C? 1,000. First year C, how much? C means what? Covered. What is a B? You done a business for first year, covered 1,000. What is the balance? 4. Second year covered 1,000, balance 3. Third year 3. What is the balance? Nil. So payback period is Shura. Payback period is how many years? 3 years. What about that? This one. B, tell me. 1,000. First year 0. Second year 1,000. What is the payback period? 2 years. Third year C, project C, 5,000 you invested. First year 3 years. Yes or no? First year 1,000 here 3 years. Now here they asked to calculate payback period. Now tell me, if the cutoff period is 2 years, then which project should be accepted? Wrong. Examiner 10 marks ఇచ్చాడు పిచ్చోడు వాడు, అందరూ ఇలాగే రాస్తారు. రాంగ్. ఎందుకు చెప్పు? You are saying that 2 you are writing. So if the cutoff period is 2 years, then which project should be accepted? No project should be accepted absolutely. A and C should be rejected. C may be accepted, may be rejected, but you are writing accept. మీరు ఇలా రంటారనే వాడు ఇచ్చాడు. అది ఇదేరా కావాల్సింది రైట్. బి యాక్సెప్ట్ ఏం చేస్తావా? ఇంతసేపు గొంతు చించుకుని వచ్చాను బి అని చెప్పేస్తే పాపం మీ సీనియర్స్ ఎంత కష్టపడి పాస్ అయ్యంటారు. ఈసారి కనిపించినప్పుడు థ్యాంక్స్ చెప్పండి. అన్న సూపర్ అన్న, మీరు 2019లో యాక్సెప్ట్ అనుకున్నాను, కానీ సర్ప్రైజింగ్లీ ఎయిదర్ యాక్సెప్ట్ ఆర్ రిజెక్ట్. విల్ యూ ఆన్సర్ బి డిఫరెంట్ ఇఫ్ ద స్టాండర్డ్ పే బ్యాక్ పీరియడ్ ఇస్ 3 years? Then accept all. How you are getting confusion? Now tell me, if 3 years public exam 10 marks question amma, 3 years means in such a case, sir 3 years wait sir, project B must be accepted sir. A and C may be accepted. For sir 2 years means sir which project should be accepted? No project sir. C, B may be accepted or rejected, but A and B rejected, right? Payback gives too much cash flow that occurs after the cutoff period. Means after standard payback period any projects happens or any project gives the cash inflow, will the project takes? No. Payback won't thinks about the profitability, it thinks about recovery of investment. Once the investment recovered, after whatever the cash inflow generates, it never considers, right? So this statement is true or false? False. If a firm used a single cutoff period for all the project, it is likely to accept too many short-lived projects. Yes, if the cutoff period is there, so less than time period, okay? Comparing to, for example, standard payback period is 5 years. All the projects should be accepted if the payback period is less than 5 years. This statement is true. This is the 10 marks for your seniors who got it. Next, net present value. Got it? Damn sure net present value compulsory question. What is the net present value? If you try to understand one thing, what is the difference between gross and net? See, if you mug it up means nothing is going to happen, Maji. You have to understand. Gross means we are going to deduct a few. Hello? Net means we are going to deduct all. Here the title is given value. It's not a profit. Here value indicates it is a wealth. Do you agree? Here the point, the reason behind this one you should understand is, here you see value means it is a wealth actually. So for example, this idea behind this one, if I make investment now, right, what is the wealth I am going to get it now? When? Now itself. If I make investment now, what would be the wealth I am going to generate now itself? So how do you get it now itself? But sir, I will tell you, if you invest now, this is your investment, right? With this investment, you are going to do sales, right? Hello? From the sales, you are going to deduct variable cost. You are going to get it contribution, fixed cost, PBDT, depreciation, tax, PAT, add back to depreciation. You are going to get the CFAT. Hello? Now tell me, you made it investment, you got the CFAT. This is the idea, you try to understand. So, up to now, what you have deducted? Variable cost, fixed cost, treatment depreciation, not deducted depreciation, treatment depreciation, tax you deducted, yes or no? Now if you bring into present, time value of money, discounting, compounding, whatever the future comes, if you bring into present means you are discounting. Discounting means you are adding interest, kada? Deducting. It means that already you three deducted here. What are they? Variable cost, fixed cost, tax, and you are doing discounting means interest you are deducting, and finally you made it investment also you deducted, and this is finally it is called what? Net only, no? Net value. Is it profit or value? From the revenue, if you deduct cost, it is called profit. From the revenue, if you deduct along with cost, along with cost, what is it? Investment also, then it is called, what is it? Value. So value, it indicates NPV, it indicates it is the value or wealth generated as on the day of investment. In Balaji, my main campus, while paying CA inter fees worth of 1 lakh rupee, you should hold the counter like this. Then cash counter asks, leave it. No. What you are doing? Thinking. What I am thinking? NPV. What are you thinking? Now I am paying how much fees? 1 lakh. How much I am going to generate? When? Array. Now. Then cashier may fell outside. So how it is possible, ma? How it is possible? Possible, sir, with concept called, what is it? NPV. Now I am paying fees. I will become CA after 5 years. Okay. And I will generate after 20 years 2 crores. Okay. If I discount the 2 crores into present, it would be 10 lakh 50,000. Now I am paying 50,000 piece. 50,000 if I pay right hand side, left hand side I may get it 10 lakhs. Thanks for giving 10 lakhs. While paying 50,000 fees, say to cashier, thanks for giving 10 lakhs means he will check in the cash box. What happened? Then say that, sir, don't worry. It is just a calculation. Is it calculation? Huh? Yes. Technical calculation called, what is it? NPV, net present value. Now tell me, what is NPV? Sir, it is a value or benefit derived from the project as on the day of investment. So what you are going to do means, first of all, find it out. Operating cash flow, you know. Terminal cash flow, you know. Bring into present and deduct your cash outflow. That is called NPV. What is the NPV formula? PV of operating cash flow, PV of terminal cash flow minus cash outflow. Cash outflow calculation means you must know the knowledge of working capital. Because that is a part. You see, cash outflow deduct cheyalante working capital teliyali vadiki. Subsidy teliyali. Net sale proceeds of old machine to be deducted from here. You must know. Set off costs you should know. Installation costs you should know. Without knowing anything, you cannot calculate NPV, my boy. And coming to operating cash flow, variable cost, fixed cost including depreciation, excluding depreciation. Hello? And terminal cash inflow. Everything you have to bring into present. In the process of bringing present, when you don't know time value of money, Jai Hind. When every year cash inflow equal, annuity factor should be used. When every year cash inflow equal annuity, every year cash inflow unequal means, then you can go with what? Present value factor. NPV formula? PV of cash in operating cash inflow minus PV of cash outflow. Got the point, Maji? How do you take decision? NPV is greater than 0, accept. NPV less than 0, reject. NPV equal to 0, either accept. Mutually independent. Independent means shortcut. India, we need all. Why? All? So which projects do you need all? Sir, those project which gives you what? NPV, here it is, the NPV is more than 0, then project should be accepted. Mutually exclusive means? Excellent. Which project should be? Highest NPV, that should be happens, right? Here this is the very, very important problem. Cello company oriented problem. You have your study material, new study material, old practice manual. You see how many times they asked new study material, old study material, RTP, MTP, May 2019. Hello? Are you getting 2018 also similar model is asked? From 2018 to till to the date. Pucha nahi ra isko. దాచిపెట్టినాడు బయటికి తీస్తాడేమో ఏ ఇయర్. What is the highlight of the problem? Very simple. Highlight of the problem, roughly I will tell you. Cello Limited company buying a new machine, have a useful life of how much? 5 years. 1,25,000 is the investment. Scrap value would be 30,000. 80% is going to pay when? Now start of the project. Remaining 20% at the end of the first year. One project, multiple payments. Hello? One project, multiple project. Now you try to understand 80% how much? 1 lakh. Should I bring into present? But what about 20%? I should bring into present. How should I bring present means you must have the time value of money knowledge, right? That is the reason I explained. So time value of money, simple, that 25,000 what you supposed to make at the end of first year, you have to bring into present. And the problem produces 50,000 units. Keep it in mind. Whenever problem begins in units, it is your due responsibility to find it out only contribution per unit. Don't touch selling price, don't touch variable cost, consumes your time. That is a contribution per unit. Direct cost, selling price is how much? 3 rupees. Direct cost is? Sir, variable cost not given, sir. You see how smartly he cheated, right? Then fixed cost including depreciation. What method? Straight line method. See, either you shout at, either it is a straight line method, WTV method. I won't take. I will take depreciation only when there is a tax. But surprisingly, in this problem, what is not there? Tax is not there. But students feel very comfortably. Oh, fixed cost including depreciation means if I deduct a depreciation including fixed cost 1, right? Then immediately I will get to PBT. Is it right? No. You should not consider which one? Depreciation. That is the most important point. Highlights of the problem. One asset, multiple payments. Where direct cost, treatment of tax and depreciation. But in this problem, working capital missed. Examiner may consider. In this problem, subsidy is missed. They may consider. Hello? In this problem, only 5 years. In order to test your efficiency, they will make 3 more years added. Are you getting? 8 years తీసుకున్న ప్రాబ్లం చేయొచ్చు ప్రాబ్లం. సో ఇదే సోల్ ఇక్కడ నుంచి తీసుకుంటాడు, ప్రయోగాలు చేస్తాడు. And at the same time, the first and second year sales promotional expenditure not included. Certain expenses he ignored, we should consider. Hello? Certain expenses he considered, we should ignore. Hello? What he considered, we should ignore. What he ignored, we should consider. That is the highlight of the problem. See how many times they asked this. Very simple way. What you have to do is highlight of the problem. Okay, na adugutunnadu. Era ardhamainda ani. Estimation of PV of cash outflow when investment is made at a different time frame. Direct cost, treatment of depreciation in the presence of tax, in the absence of tax. How to use present value factor, annuity factor. How to use annuity factor in the middle of the year. Because 3, 4, 5, you are going to get the same cash flow. Are you getting? So in this problem, how we have to do? Step 1. Cost of new machine, first installment, 1,25,000 into 80%. Okay na? Yes or no? Right. Then additional equipment. Additional equipment, not additional equipment, sir. Additional installment, right? Remaining balance at the end of first year, you are going to pay 1,25,000 into 20% present value factor, 22,725. For this purpose, we have to calculate depreciation. Sir, why you are calculating depreciation? Sir, tax is not there. Yeah, in order to exclude this one. So calculation of cash fixed cost. Fixed cost including depreciation 40,000 less depreciation 19. We got it at 21,000. Got it, ma? Thereafter what I have done? See, I took year 1, year 2, year 3. Contribution per unit. Selling price minus 1 minus 1.75. 1.25, 1.25, 1.25. Total contribution I calculated. Less fixed cost I deducted. Sales promotional expenses 1 and 2. Sir, 3 and 5 you could not take in, sir. Because no information, right? Then what we have done, right? Then what we have to estimate here, ma? Here you see, thereafter sales promotional expenses, we got the PBT, PBDT, both are same. Do you agree? Because what is not there? Depreciation is not there. So then we took the present value factors. Yes, but how do you get this 2.5? This is nothing but present value factor summation of 3 plus 4 plus 5. Okay, 2.5. By multiplying, summing up, we got the PV of operating cash inflow 1,35,805. Terminal cash inflow, I could not calculate it, written down value. What is the reason? SLM method. No Maji. Why I should not calculate it, written down value? No tax, man. Even if you calculate written down value, you got the gain. What happens? Nothing happens. Even you got the loss. What happens? Nothing happens. That is the reason you should not. But the answer is, sir, because of SLM method, because of WDV method, that's not. Tax is not there, right? You don't have a chance to get either gain or loss. So that is the reason 30,000 used to get at the end of 5th year, and you bring into present value factor, you got 18,630. Then you got the NPV. PV of operating cash inflow, PV of terminal cash inflow, minus cash outflow. You got the NPV. NPV positive of 31,710. Since NPV positive amounted to given amount, the proposal should be accepted. Highlight of the problem, very, very important. Several times I gave with the proof of evidence also. But the same model, he won't get it, right? He may make it tough. Same problem he will take. Tax may given. మొత్తం మారిపోద్దిగా ప్రాబ్లం. దట్ ఈస్ ద ప్రాబ్లం. ఇంత ఎత్తుకు మీరు ఎదగాలి. ఎవరంత ఎత్తుకి? నాకైతే ఛాన్స్ లేదు. అంటే ఎత్తు అంటే ఫైనాన్షియల్గా, ఫిజికల్గా కాదు. ఫిజికల్లీ హైలీ ఇంపాసిబుల్, ఆల్రెడీ పెరిగేసాం కాబట్టి. అండ్ రైట్, నెక్స్ట్ వన్, అనదర్ మోస్ట్ ఇంపార్టెంట్ ప్రాబ్లం ఈస్ XYZ company. One of the standard based company. This is the very, very important company. And in exam, when you don't have efficient in calculation, don't touch this problem. This problem is XYZ limited. If you are able to solve this one problem, I will assure you, you can solve any of the problem, man. Within in time, if you are able to solve. In order to solve this problem, at least your finger should touch calculator more than 5,000 times to 6,000 times. అన్ని సార్లు కొట్టాలి దాన్ని. నువ్వు బొట్టు పెట్టినట్టు చేసావు అనుకో, వేర తిలకం పతా. దట్ ఈస్ ద రీజన్. ఫింగర్ షుడ్, మిలిటరీ వాడి చేతిలో గన్ను, సిఏ వాడి చేతిలో పెన్ను. ఆ లెవెల్లో వర్క్ చేస్తే ఈ ప్రాబ్లం టచ్ అయ్యి, లేదనుకో దీని బదులు థియరీ రాసుకో. Open with recording, I am saying. It means indirectly, it does not mean that you are going to skip. You have to practice well. That is an intention. Okay. So this problem, why I took this problem means, if you are able to handle these two problems, remaining problems you can handle. Now you see, XYZ Limited planning to introduce new product. How many years? 8 years. 8 years. 8 years means I told you. 8th year. 8th year operating cash inflow. 8th year terminal cash inflow. At the beginning, cash outflow. Okay. The initial equipment would be 3.5 crores. Additional equipment could be 25 lakhs. It would be purchased from the cash inflow of 3rd year. So surprisingly, he is going to buy the asset. Here, your investment is 3.5 crores only. Hello? Sir, 25 lakhs also I purchased, sir. That is not your investment. That is a surprising in this problem. That is you purchase that asset from the cash inflow made, right ma? At the end of 8th year, the original equipment have what value? No resale value. Sir, in such a case, client may ask you, sir, shall I try for capital loss, sir? Tax shield, sir. Why? Because my asset value is 0. Hello? Your asset value is 0, but we will calculate what value? Written down value. Hello? Written down value, we will find it out. In that written down value is there, you are unable to scrap, then we will consider capital gain or capital loss, then we will take care about this. Then additional equipment cost is no resale value, but additional equipment would be sold for 2,50,000. Working capital would be 40,000. What is the treatment of working capital? Right. Problem is given in units. Already just now I told you. Units are given contribution. Here units, right? Selling price per unit is 240. Variable cost ratio is 60%. Maji, variable cost ratio 40% means contribution ratio 40%. 40% into 240, 96 would be the contribution per unit. If you multiply with the units, total contribution. Fixed cost, previous problem, includes depreciation. In this problem, excluding depreciation. Sir, excluding depreciation means we should exclude depreciation. Kada? Sir, excluding, including does not influence, sir. This influence tax. Okay, right. And the loss of any year will be set off from the profit of subsequent 2 years. Means concern year, if you get the loss, you won't get it any tax shield, but this loss should be settled in next year profits. Okay, right. But that should be recovered within 2 years. The company subject to tax 30%. Margin T is there, D is there, and the appropriate cost rate is 12%. And calculate NPV of the project. And immediately in this problem they asked, what is the treatment of investment? When investment subsidy provided, how much? When subsidy provided, what would be the impact of investment? Increase or decrease? Decreases. Now you see, cost of initial equipment 350 lakhs. We had additional working capital, how much? 40 lakhs. Total investment is 390. Initial cash outflow also 390. Subsidy I should not consider because it is a part B. Hello? Part B, I think 50 lakhs. Now, then I calculated depreciation. Depreciation, cost minus scrap divided by life. First initial equipment, how much? Original equipment 350 minus 0 divided by 8, 43.7. Additional equipment 25 minus 2.5 divided by 5, 4.5. Right, here I need to find it out contribution per unit, because I know that when problem is given in units, we have to consider this. Right, then selling price is 240, variable cost ratio 40, means my viewpoint of view, contribution is 40%. 240 into 40%, 96. You should not hold face like this. Avuna? Yes, I got it, Bellary. What is this face? Idiot. Right, now you have to take, what is it? Sales unit. Problem is given thousands. In order to save your time, what is that? James Bond. Shoot the zeros. So take the sales units, right? And the contribution, by multiplying both, you will get the total contribution less fixed cost and PBDT. Up to problem here. Thereafter less depreciation. You have to add one more column. Why? Because set off losses. So first year you have to calculate, because first year if you complete, then only you can understand. In second year, only after deducting depreciation we have to calculate tax. Or is there any set off loss? Are you getting Maji? Then, so brought forward loss, PBT, tax, PAT, add back to depreciation. And here one most important point is, student will forget this one. Which one? Adding back. Why? Because it is not at all loss to concern here. You are artificially showing that there is a loss in order to reduce the tax burden. For that purpose, once you, in order to reduce the tax burden, what you have to do? You have to deduct depreciation and set off losses, and you have to minimize the taxable income. Once tax is paid, you have to add back not only depreciation, my dears, but also, what is that? Yeah, then forward losses, and you have to calculate. The problem is given like this. So what you have to understand here, every year, first year we got the loss of how much? 10.43, but we should not consider any tax advantage here. We added back to depreciation, and finally we got 33.12, we brought into present. Second year we got the PBDT of how much? 43.75. Here you see 43.75. Then we deducted how much? 10.43. Then immediately taxable income we reduced to 13.33, and we paid a tax of this, and we got the PAT. We added depreciation, not only depreciation but also brought forward loss, and we got 63.69. we brought the present. Coming to third year, you got the PBDT. Sir, here we have to stoke 10.63, sir. Sir, 2 years set off loss given, sir. 2 years means the loss should be there, sir. Here loss is not there, you should not consider. But in this point, you have, why I deducted 25? Because the problem is said initially, from the third year CFAT, I am going to use 25 lakhs to acquire, what is it? Additional equipment. That is the reason. Even though CFAT I made it 62.645, but I got it 137.645. If you bring into present, 98. And the remaining year it would be same procedure only. But only one thing is, here you have to sum it up the factor value. Why? Because here it is a 4, 5. What about here? 6 and 8 also you have to sum it up. Right? This is the highlight of the problem. Once you bring into present, you have a 533.945. Coming to terminal cash inflow, you purchased asset for 350. You used over the period of 8 years. Your gross sale proceeds is 0. and gross sale proceeds additional equipment is 2.5 because you scrapped the asset only to the extent of written down value itself. And recovery of working capital, here you see working capital circulates and remain same. Terminal cash inflow 42.5, you have to bring into present 17.15, and finally calculate NPV. NPV is 161.144. Since NPV is positive, the project should be accepted. If investment is given, in such a case, what is the treatment? Less subsidy, your initial investment would be decreased. This is the point. If you not so far started to read FM, if you are able to solve these two problems in NPV, any of the problem, if you have doubt, go to the net and collect the question paper 2018 to till to the date. You can able to handle all the problem. At least you can 90% you can put an effort with respect to capital budgeting. I am assure you, right? These are the points you should understand in NPV, right? Thereafter, what is that? Profitability index. Once again in NPV, topics are, remember concepts: working capital, direct cost, treatment of depreciation, contribution ratio, variable cost ratio, yes or no, subsidy, okay, installation charges, all these things. Without knowing all these things, if you can handle, means it's really, really difficult. Here it is, profitability index. इस फेस को देखो, डर रहा है, because profitability index comes to the picture. Profitability index. Profitability index means if you invest how much? 1 rupee in a project, how much return you will generate. Fact is this, you cannot invest 1 rupee, but we will think that if you invest 1 rupee, what would be the return to be generated? Profitability index, also another name, it's benefit cost ratio. Profitability index is the cousin brother of NPV. NPV formula, PV of operating cash inflow plus PV of terminal cash inflow minus cash outflow. But profitability index is PV of operating cash inflow plus PV of terminal cash inflow minus PV of divided by, now tell me, profitability index 1.286. What do you mean of this? If you invest 1 rupee in this project, it will gives you how much? Means then basing on this, can you take a decision? How do you take a decision? If profitability index is greater than 1, profitability index less than 1, profitability index equal to 1. What about mutually independent? I told you, India, in such a case, all the project, accept all the project if profitability index greater than 1. Mutually exclusive means excellent project, right? So highest profitability index. For this, for a study material, you have a problem. Navjeevan Hospital, this problem very, very important. Don't miss it, this problem. Now even we can discuss in this problem. Here it is, very simple. Navjeevan Hospital wants to purchase a machinery 2 lakh rupees. Why? Because you know certain chapters are not important, but certain chapters very, very important. Under that very, very important, one of the very is capital budgeting. Even I can spend one more 5 minutes extra for this one, no problem. But here purchased 2 lakhs rupees and life is how many years? It has expected salvage value, right? The annual operating cost of the machine is 22,000, whereas expected general revenue generates revenue how much? So hospital has a proposal to buy a machine. Its cost is 2 lakhs rupees. Life is 8 years, and at the same time every year maintenance is 1,20,000. Operating it generates revenue 1,20,000. Operating cost is 22,500, and salvage value would be 18,000. Presently hospital is outsourcing, okay, the treatment, everything. It is getting 36,000 rupees after net of tax. This 36,000 is opportunity cost loss, because without machine they've been getting 36,000 rupees as a commission. Hello, if they buy this machine, in such a case they won't get it, right? So that would be the point. Basing on this, we have to calculate, what is it? Net present value and profitability index. Tax rate is how much? 30%. Here you see cost of machine 2 lakhs, no working capital, no subsidy, nothing. Step number 2, calculation of depreciation. 2 lakhs divided by 2 lakhs minus 18 divided by 8, how much? What about operating cash inflow? Sales revenue less operating cost, PBDT, you got it, less depreciation, PBT tax, PAT, add back to depreciation you have to add, but here the most important examination point of view, this point is very, very important. What is this? Opportunity cost loss. You are missing, because opportunity cost loss is given here after, you see, opportunity cost loss is given after net of taxes. Because of undertaking this project, you are losing which one? Opportunity cost loss. So that's why opportunity cost loss also must be deducted. Then you got the CFAT. Every year cash inflow same means you have to bring into present value annuity factor. You got the PV of operating cash inflow, and terminal cash inflow you got it, and NPV profitability indexes. Since NPV is positive, profitability index 1.084. Since NPV positive and profitability index greater than 1, so this project should be accepted. Here in this problem we learned what is it? Opportunity cost loss. Whenever you will make investment, any opportunity cost loss is there, that loss also must be considered. Then another concept is IRR, but exclusively IRR model problem is not there. I personally say no given, but what happened while asking NPV, discounted payback period, what is that? In the way they used to ask what is that? IRR. So what is the IRR? IRR indicates it is the, if investor thinks like this, if I make investment in this project, so what would be the maximum return I can generate? Or if I make investment in this project, what is the maximum cost I supposed to pay? So that would be the IRR. IRR is nothing but maximum rate of return one can earn by making investment in the project. Okay, it is the maximum rate of interest one can pay in order to undertake a project, right? IRR also called, it is a discounting rate at which NPV equals to 0. How to calculate IRR? That depends upon pattern of cash inflow. You know that Maha Mantra. One is Maha Mantra. Whatever the IRR, if you ask to calculate means, do you calculate IRR? Calculate IRR means you say the answer, I know NPV. What is the NPV? Calculate IRR, I know NPV. Calculate IRR, I know NPV. How much? NPV equal to 0. By taking NPV 0, by resolving NPV equation, comfortably you calculate what one? IRR. So IRR is a discounting rate at which NPV equals to 0. By calculating this 0, you have to trace in NPV R. That R is nothing but what? IRR. Any of the problem, right? Coming to IRR, greater than cost of capital, accept. IRR is less than cost of capital, reject. IRR equal to cost of capital, either accept or reject. Mutually independent, accept all the project if IRR is greater than cost of capital. Mutually exclusive, right? So here IRR oriented problem, single cash inflow. If you invest 20,000, you will get 25,992. Okay, calculate IRR means what is logic? You know NPV, very simple. By taking NPV, you can find it out. Any of the problem, this model already why I took this problem also is there in our method, in material, because this problem is given, new study material is given, old study material is given. I thought that this problem might be important, but any calculation, you know calculation of NPV, right? Only simple logic, because we have a time constraint, right? Time constraint, that is the reason you follow one simple logic. When they asked estimate, which one? If you ask to estimate, what is that? IRR, you believe that you know what is that? NPV. NPV is 0. By taking NPV 0, any of the cash inflow, you can trace the IRR. This is the given method also. Everywhere I took the same identity. Any situation I took, what is that? Everywhere I took the same identity. In 3 situations, by taking NPV 0, I calculate IRR. This is the basic ideology with respect to which one? IRR. Okay, just you can practice this one, because IRR is a simple estimation, but you should understand what is the IRR is. IRR, in order to find it out, you can estimate, you can come back to 0 to rate. Hello, sometimes when multiple unequal cash inflow is there, then you have to use interpolation. What is the formula of interpolation? L1 plus NPV at L1 minus L1. Another 2 marks question, there is a chance to ask reciprocal payback period. What is a reciprocal payback period? When you calculate payback period reciprocal rate is called, what is it? Reciprocal payback period. For example, payback period is how many years? 4 years. Then convert into percentage means 1 divided by payback period into 100. That is the reciprocal payback period. Okay. Payback reciprocal, here you see a project investment how much? 20,000. Cash flow how much? 4,000. Estimate what is it? Payback reciprocal. Very simple, right? How much? First you calculate which one? Payback period. 20,000 divided by 4,000 how much? 5 years. Convert into rate. 1 divided by 5 into 100, 20%. Generally this would be given for 2 marks. Okay. But all the in capital budgeting, I gone with the 3 questions I explained, even though comprehensive problem XYZ limited. While taking this one, I thought it Balasubramaniam, time would be very, very constrained. What to do? I thought it that shall I manage time? Shall I give productivity to the students? Productivity. Let's OPE. ఏమైనా కానీ కొద్దిగా గట్టిగానే చెప్పేద్దాం. ఈ 3 ప్రాబ్లం చెప్తే చాలు, you would be clear ma. Right? Thereafter which one? Discounted payback period 99% we can't get it this one. Discounted payback period means it is the payback period which considers time value of money. What we have to do is first you have to discount the cash inflows and basing on that discounted cash inflow you have to calculate payback period. So what we have to do, let us take some example. Here one is a Geeta Limited is a company which makes investment of how much? 7,600, right? Every year cash inflow. First year 6,000, 2,000, 1,000, 15,000. They are asking you to 5,000. They are asking you to find it out. Discounted payback period. The cost of capital is 12%. What we have to do is, first of all, whatever the cash inflow given, you have to bring into present. Then discounted cash inflow must be cumulate, and basing on this, you have to calculate discounted payback period. Hello? So this is the way to find it out, discounted payback period. First you have to discount the cash inflow, then you have to calculate payback period. Then last concept in this method is called, what is that? Capital rationing. The word rationing means limited. Capital rationing means it is the, what is it? When funds are limited, in such a case, what to do with the financial manager? When capital rationing is there, the word rationing means scarce. Capital rationing means systematic allocation of limited funds on more financially viable project with an objective to generate maximum NPV. In the process of making capital rationing, projects being classified into 2 types. What are they? Divisible projects, indivisible projects, right? The proportionate divisible projects means, sir, proportionate investment is possible. No surplus funds should be founded. For example, gold, silver, shares, debentures. Whereas project may be indivisible, means proportionate investment is not at all possible. Such a projects are called, what is it? Building, land, machinery. How do you make capital rationing basing on divisible project? First, to estimate financial viability. Means check whether the projects are financially worthable or not. For that purpose, you may calculate NPV or you may calculate, what is it? Profitability index also. Then you have to give rank, means OPI, order of preference of investment. And you give the rank. Basing on the rank, you have to invest your projects. Whereas projects are indivisible means check the project, what is that? Financial viability, and you have to make investment as per the combination. Hello, now tell me, if the projects are divisible, they are divisible. In such a case, what to do? First you have to calculate rank. Basing on rank, you have to make investment. When projects are indivisible, whereas divisible, no rank, go with what? Combination, but identify that projects are financially worthable to make investment. Hello? NPV should be project. Then you take any of the combination so that what happen? You may generate maximum NPV. Got it? Which method to be required to calculate rank? Divisible or indivisible? Indivisible ki ranks. Divisible ki rank under. Indivisible, no rank. Combination. Where R and C. R means for divisible, invest as per rank. For indivisible, as per C. Make it a shortcut. Okay? You extract a shortcut. When exams are getting closer, you should find it out. And this is the identity. Capital rationing problem. This is the London, Germany, Paris oriented. All these corporate companies, they have a problem. If you learn this one, you would become a financial manager for these topmost companies. నమ్మబుద్ధి పుట్టట్లేదా? నేను బ్రాడీఫైడ్ ఫోటో కూడా పెట్టేవంటరా, అవునా? బట్ ఐ థాట్ ఇట్ దట్ I told you I came like this because I want to see you like this. When I want to see you like this means in Bradipeta could not happen, right? If I go with the Bradipet like this, many people will see. Ado rakamaina see. Okay. Avasarama meeku? Avasarama antaru cheppandi antaru. But whereas here it is, if you go with the normal, right, they will say that avasarama inta pedda company neeku antaru. But our dream is to crack this one, right? Not stupid Bradipet, right? No. Bradipet is good only. Here, simple point is, this is one of the repeated model. Shiva Limited company have a projects. It have how many projects? 5 projects, all which gives what is that? NPV positive. So cost of capital is 15%. Project A, NPV investment is given NPV. Maji, NPV positive only, no? When NPV positive means all the projects should be acceptable. The company total spending limit is 1,20,000. Now tell me total investment required. Total investment, take calculator, tell me. 50, 40, 25, 30, 35. 1,80,000. But funds available? There is a scarce, right? In such a case, you have to think about what is that? Profitability index. Here projects are independent, divisible. Em cheppanu? D. Divisible means R. What is the indivisible? C. What is that? That's enough. Combination. Same point you see, understand. Here, when projects are, what is that? Divisible means I should calculate what is that? Rank. Already NPV given, right? I gave rank as per what is that? NPV. Here project A, B, C, D, E given. This is the investment. This is the NPV. Basing on this, NPV is here highest, right? Highest NPV 1, 2, 3, 4, 5. I gave the rank. First, now tell me whatever the amount I have, first I should spend as per rank, right? Which project I should take first? Yeah, I took here, I went for E, and first I invested E, and I have 1,20,000. I took investment, E means I spent 35. Balance would be 80,000. NPV I scored second rank B. 40,000 I spent. Balance 45. This is the amount. Another one is 25. I have 20. But last project I need D need how much? D need no man. D need 30,000, but I have 20,000. But this project is divisible. Divisible means proportionate investment is possible, right? If I would have invested 30, I would have got 11.2. If I invested 20, then how much I got it? 7.76. With the support of 1,20,000, if project is divisible, I can generate 55,677. Because project is divisible, I go on with what? R. Whereas if it is project is divisible, I go on with what? Combination. Here I took the combination EBC. Total investment I spent 1 lakh. Surplus I got it, but NPV is maximum of 48,100. It's okay. But EBD I got it. So 1,05,000, surplus is 15,000, but 49,200. This is okay. But I tried for ABD also. 1,20,000, but 45,000. Now this is the combination. But first better to move with which one? EBD. If not, then go with the EB, then go with yeah. So this is the observation. You can make it a investment, dear students. So with this, we completed which one? Capital budgeting. But maximum 3 problems are very essential. And last one is a capital rationing. Remaining topics, it's my responsibility. But my duty is to make you these 3. If you read these 3 problems, if you get it well, right, you can handle. Next, cost of capital. Take break then. And here you see 175 pages I completed. Still 714 maximum I hand out this one to management. It would be possible. Next we have 172 to 300 pages capital budgeting, everything. Take break and come. And most important chapter, well, you know that after working capital management, cost of capital. So the next most important chapters, cost of capital, Before going to cost of capital, you should understand three major important points for leverages, for capital structure, for cost of capital. The three topics are very, very essential. What is a capital? What is the capital structure? What are the various sources of capital? So whenever any business has to run means it need a, what is it? Capital. This capital can be raised from various sources. The combination of that concerned source is called, what is it? Capital structure. The sources may be debt or equity. The idea behind the capital budgeting, cost of capital is very simple. You see, here there is a company. In order to run this company, do business and earning a profit, this company need what? Capital. This the capital is nothing but huge amount. You know that from since commerce students you've been reading this. Right. Here the coming to the topic is, here the cost of capital of the company, it indicates when company need a capital, capital rises. These are the various sources. What are they? Shareholders funds, external borrowings. When shareholders funds means you can give a cost in the form of sharing what? Profit. Hello? You will raise a funds by sharing a profit is shareholders funds. What are they means? Equity shares, preference shares and retained earnings, everything. Coming to external borrowings, which is that long-term funds, bank loan, yes or no, debentures, bonds, everything comes under the category of what? External funds. Irrespective of your business performance, you have to pay interest. These are the basic identity. Coming to here, who are the various fund providers of the company? Here you have equity shareholders. For equity shareholders, preference shareholders, debenture holders, bankers. For them, what you have to pay? Equity dividend, preference dividend, interest, bank. Right. Coming to aggregate, in aggregate to all the people, how much cost to be paid is called, what is that? Cost of capital. So cost of capital is the return expected by the fund providers. Who are they? Shareholders, lenders and debt holders. So the company must pay to the paid to whom? Financials of the company. Because you know the money what you are going to pay in the form of cost for raising this capital is called cost of capital. It is also known as, what is it? Cut-off rate, hurdle rate, minimum rate. See, when you are raising debt right, and with the debt you are going rising debt in the form of capital. If you are doing business, but the business has to earn such a return, with that return the company able to pay debt interest. Hello? When you cannot understand the concept of cost of capital, if simply do business, when you are not able to make proper return, what happen? The impact would be very, very worst. This is the one of the best coffee day CEO. He is losing money. It's a very, very pathetic story. But whereas such a person who lost the money because of not paying proper debt, and one fine day, what happened? Whereas his wife took the challenge and she handled all the debts. The coffee day debt worth of 7,000 crore. Husband committed suicide. Malvika did a miracle in a year. And what is the difference between these two? Understanding the concept. So when we have this much of debt, right, how we have to analyze it, how we have to pay this is the most important. So cost of capital considers various specific costs. What are they? Cost of debt, cost of equity, cost of retained earnings, and a combination of overall thing is called, what is it? Cost of capital. Estimation, how the corporate companies estimate the cost of capital. There are two steps. What are they? Estimation of specific cost, and number two is estimation of overall cost of capital. What are the various specific costs? You have KE, another one is, what is it? KP, K, and all these things. What are they? Tell me. KE, KP, right? Here KR, and another one is KD. If you sum it up all these things, you can find, what is it? KO. What is another name of KO? Weighted average cost of capital or cut-off rate. Means that whenever you are raising funds, you must earn more than that cost. Otherwise, you know the story. Okay, that is a important point. Cost of capital. So why we should learn the cost of capital means in order to evaluate what decision? Investment decision. Why, sir? Sir, IRR you calculate, sir. IRR should be greater than cost of capital. So without cost of capital, how do you define IRR? Without IRR, how do you take what decision? investment decision. Performance of the appraisal. A company cost of capital is 14%. B company cost of capital is 7%. Which company would be the best? B company is the best. Because of cost of capital, you can comment on what is it? Performance appraisal of the company. And at the same time, designing optimum credit policy. Optimum credit policy means try to understand a company KO is a 14%. Another company KO is 4%. Which company may provide more credit? 14 4 4 only, because this company has 14% cost means they have a huge risk. They never give a cost. But whereas this company would be provides you how much? Just 4%. Means if you have high cost means try to understand your cost is high, your risk is high, your credit policy, liberal credit policy will be never be there, and you will go with a restrictive credit policy. You never give a credit period. When you never give a credit period means then you don't have a choice to become a what? Market leader. Everything can be identified. Hello? This person cost of capital is 15%. Basing on the 15%, what the assessment I can do is, this person cannot give what? Credit. This person cannot give credit means he cannot make marvelous sales. He cannot make marvelous sales means he cannot generate what is it? Maximum profit. He cannot generate a maximum profit means he cannot stand as a market leader. So everything I can make a guess basing on this. And finally, risk associated with the company. Between these two companies, which company has highest risk? If company A is 25%, company B is 10%. Which company has a high risk? A. So basing on cost of capital, you can comment in all the aspects. You can performance, you can identify investment decision of the company, you can identify performance of the company, you can identify optimum credit policy of the company, you can identify risk associated with the concerned company. Theory marks, in 4 marks you may expect this question, right? Coming to cost of debt. Debt means whenever you will raise the funds, right? Whenever you have a choice to raise the funds, you can go with a long-term debt. By issuing debenture, company may raise funds. Whenever company issues a debenture, company has to pay what is it? Interest. That is the most important. Here this debentures being, by the time of issuing debentures, interest you have to pay, but only one of the point is, here you have to consider various aspects. How you are going to issue? Discount, premium, what is the flotation cost, tax, redemption made at discount, redemption at premium. When company issues a debenture, it promises what is that? Certain coupon rate. Hello? This coupon rate may be low or high, that depends upon given factors. Hello? When company issues a debentures at a premium, in such a case, favorable or unfavorable? A company face value 100 rupees. Coupon rate is 10%. But issue made at a discount. 10 rupees discount means company is supposed to get only 90, right? From the 90 paying a 10% means is favorable, unfavorable? Unfavorable. They have to pay high cost. Hello? If it is a premium, favorable. Incurs more flotation cost? Unfavorable. Hello? Whereas a discount, redemption at discount? Favorable. Redemption at premium? Unfavorable. So cost of debt chapter is nothing but, while calculating cost of debt, you have to calculate coupon rate or cost of debt in such a way that by considering which one? All these factors. What are the factors? Issue made at discount, issue made at premium, flotation cost, tax, redemption made at discount, redemption made at premium. Here you should understand, generally if you go for debt, it should be secured with the collateral. It is one of the fixed obligation. You see the chain and gold. Gold chain it is. Whenever you touch what is a debt, it is a fixed obligation. Financial leverage, risk, what happen? Increases. Interest you pay it, but for the sake of tax purpose it is a beneficial. Hello? Whenever you will raise a debentures and you have to give the collateral security and it is a fixed obligation, it is a financial risk increases, interest is a tax advantage, you will get it, and the debt won't have what is it? No voting powers you have. These lines I extracted from the theory paragraph of new study material. A new study material ఉన్న పాయింట్స్ మొత్తాన్ని సమ్ చేస్తే ఈ పాయింట్స్ దొరికే ఆ పాయింట్ హైలైట్ చేశాను ఇక్కడ, రైట్? Then when you are going to calculate, you should understand the following terminology: interest, tax, redeemable period, issue price, and number of years. Cost of, first you should understand irredeemable debentures. What do you mean by irredeemable debentures? Here the debenture which not redeemed by a issuer is called irredeemable debenture. Generally, what is the formula? Interest into 1 minus tax. Why we used to take 1 minus tax? Because we used to get tax advantage. What is the difference between net proceeds and market price? Yeah, net proceeds indicates new company, market price indicates existing company. Can you say cost of debt issued 30,000? Take calculators. Irredeemable debenture, coupon rate is 14%. 150 rupees is the each. The flotation cost of debenture is how much? 5%. Total issued amount. The company tax is 40%. How do you calculate cost of debt? KD equal to interest into 1 minus tax divided by net proceeds, right? Issue made at 150. Out of that, what is it? Flotation cost is 5%. Face value is 100 rupees, means 5 rupees would be the at 150 flotation cost. Hello? Here 150 is the face value, 14% is the interest. Hello? Into 1 minus tax divided by issue price 150 minus 5% flotation cost. Check the answer. Is it this? So what is the formula once again? Cost of irredeemable debenture, interest into 1 minus tax divided by, yeah, coming to redeemable debenture. What is the meaning of redeemable debenture? Debentures always redeemed. In order to calculate redeemable debenture, you should understand how the company is going to redeem it. One thing is lump sum, another one is installment. When lump sum is there, you can use what method? Shortcut method. Keep it in mind, all the problems in cost of capital is maximum covered which what method? Shortcut method. In order to make a shortcut method, redemption should be done at lump sum, coupon rate remain constant. Formula for a shortcut method, KD into interest into 1 minus tax plus redeemable value minus net proceeds divided by n number of years, RV plus NP divided by 2. Whereas redemption done at IRR, redemption is done at installment, go with the IRR. IRR, when there is a flotation cost, better to calculate from whose point of view? Company point of view. When there is no flotation cost? Investor point of view, right? This is the problem. In study material, this problem also given. YTM method means yield to maturity. It is also called, you are going to estimate what technique? IRR technique. This is what is that? Shortcut method. To use shortcut method, what is the condition to be followed? Coupon rate remain same. Yes or no? Redemption should be done at lump sum. Here a company issued 10,000, 1/4/2018, matured at 31/3/2022. The company wants to know current cost of debt. Currently debenture is trading at 85. Tax rate is how much? 35%. You see here the point is first you can go with using what method? Shortcut method. Shortcut method formula? Interest into 1 minus tax divided by RV minus NP divided by N all divided by RV plus NP divided by 2. Whereas interest 6.5, 100 minus 85 divided by 4. 4 is N number of years. Whole divided by 100 plus 85 is nothing but not market price. Sorry, not net proceeds. It is market price divided by 2 into 100. You got it how much? 11.8%. This is what method? Shortcut method. This is the shortcut method where you can use it IRR technique also. Where IRR technique you can calculate from investor point of view. So investor made it an investment here 85. First year he got it a 6.5. Second year he got it. Last he got it 100. So at 10% we brought into present. 15% we brought into present. At 10% we got it NPV positive of how much? 3.90. At 15% we got it 9.24. By taking interpolation formula we got it how much? 11.48%. So this is the identity with respect to cost of debt. Particularly, you see directly they won't ask a specific cost, but that only they will ask only 4 problems they've been asking. Weighted average cost of capital, marginal cost of capital, weighted average cost of capital book value, weighted average cost of capital market value. Only this. But if you want to handle all these problems, means specific cost estimation, in specific cost estimation, majority all the problem they have given cost of debt only. Hello? In cost of debt they have preferred which one? Shortcut method. Coming to the next one is you have cost of convertible debenture. There is a problem in our material. What is a convertible debenture? Convertible debenture is nothing but redeemable value is nothing but number of equity shares at the given time period. So sometimes shortcut method convertible debenture model problem they may ask you for 5 marks. Here redeemable value is nothing but given number of equity shares. In order to support this problem, CRA problem number 13 is given. Last attempt, previous attempt model problem this. I think this problem might not come for the coming exam. Why? Because last attempt only they asked. But we don't know what is his point of view. In this problem, you see given number of value of equity shares. Here company is going to give, what is it? For one debenture, 5 equity shares. Not now, when? At the end of the period. For that purpose, only one logic you have to find it out. Redeemable value equal to one debenture equal to how many shares? 5 shares. But currently the share price is, let us imagine, 20 rupees. It is going to increase by 4%, means 5 share value. If the share grows for 4% over the period of 5 years, each share will become how much? 24.33. Then 5 shares if you multiply, it would be 121.67 would be the redeemable value. If this is the same problem, TT limited to 20,000 shares, 10% is a convertible debenture, 100 rupees each. Maturity period 5 years maturity, debenture holders will have an option to convert the debenture into equity in the ratio of 1:2 share, 1:5. 5 shares each debenture. The current market price of debenture equity would be 20 each. Currently, what is the market price? 20. Growth rate would be 4%. Assuming tax rate would be 25%. And compute cost of 10% convertible debenture. Here, convertible means redeemable. Redeemable means you can use a what method? Hello, shortcut method. Shortcut method formula is what? Interest into 1 minus tax plus redeemable value net proceeds. Everything is okay. What value is not there? Redeemable value is not there. If you able to find it out redeemable value, you can easily calculate. Now tell me, what is the redeemable strategy? One equity share equal to how many debenture? One debenture equal to how many shares? What is the present share? What is the share value at the end of redeemable period? That you have to identify it. Hello? So once again, logic, got it ma? So how you find it out 121? You tell me this one. The topic is over with this. So one debenture is how much? 100. One debenture equal to how many shares? 5 equity shares. Not now, at the end of 5th year. Growth at 4%. This equation, if you are able to solve, you may get 5 marks here. Okay. Now you try to understand how CA Institute has developed this logic to solve this one. They noted 500 rupees and here they observed it. How much it is? Check it. One equity share equal to one debenture equal to 5 shares. Yes or no? 20 at the end of each year? 5th year. So 121. Okay. This is the share price is going to 20. Growth at is 1.04 over for the 5 years. Then convert this one debenture at the end of 5th year. It would be 24.33. 5 shares means 121. One debenture redeemable value equal to 5 equity share at the end of 5th year would be 121. By taking this 121 minus flotation cost goes right. By deducting flotation cost, he estimated no flotation cost. If flotation cost is there, okay. No flotation cost means redeemable value 121.67, 10.68%. Okay. This is the most in cost of debt. Two things. 2000. I observed the question only one. What method? Shortcut. All the problem shortcut. Another one is irredeemable. Irredeemable means no problem. Only shortcut method they asked. Another important point is convertible debenture. They asked for 5 marks. You take care about this. Thereafter, what is it? Cost of preference. Cost of preference calculation is estimation is similar to cost of debt. Cost of irredeemable preference shares. Principal amount would be never be repaid. What is the formula here? Preference dividend divided by net proceeds or market price. Same, whereas redeemable preference shares, redemption is done at lump sum, shortcut method, and redemption done at installment. Here also you have shortcut method formula. KP equal to preference dividend plus redeemable value minus net proceeds divided by N, RV plus NP divided by 2. Whereas company point of view, you can calculate IRR from company point of view, investor point of view. When there is no flotation cost, better to calculate whose point of view? Right. Here, can you able to solve this one? Irredeemable debenture. Company issued 40,000, 12% redeemable preference shares, 100 rupees each. So 100 into 12, multiply. How much? 12. At a premium of how much? 5 rupees. Redeemable after 10 years. Premium of 10 rupees. Flotation cost is 2. I already covered maximum. Flotation cost I covered. Premium I covered. Redeemable period. Now, can I use IRR or shortcut method? Shortcut method. Why? Redemption should be done at lump sum. So redemption should be done at lump sum means what is the formula here? Preference dividend. Here it is. Here preference dividend. Redeemable value minus net proceeds divided by n. So 112%, right? 110 why I took? Very good. Premium. 103 why? Yes. Whereas here divided by 10 years. So 100 plus 103 divided by 2. You got it how much? 11.92%. Whereas most important thing is cost of equity. Cost of equity is the minimum rate of return that a company expect to pay to whom? Equity shareholders. Generally, equity shareholders are called owners of the company. There is a false obligation that for the sake of, since they are owners of the company, there is no need to pay any cost. Is it there like this? No. Equity shareholders are not only investor, highest risk takers in the company. That is the reason company has to pay better, best cost to them, right? If you cannot pay better, reasonable, best return, what they do? They will sell the shares, they take the money, they will quit the company. With effect, market value gets what? Collapsed. That is the reason financial management objective is to maximize wealth of whom? Equity shareholder. This is the cost of equity. How many methods given in your material? Dividend price approach, earning price approach, growth approach, realized approach, capital asset pricing model. CA Institute has declared all these methods. Coming to dividend price approach. In this approach, company, whatever the profit it makes, earnings, right? It gives a dividend. Okay. Here the company follows 100% dividend payout ratio. What is that? 100% dividend payout ratio. This model also called no growth model. What is that? No growth model, because in this model company follows 100% dividend. In this model, equity shareholders expects only cash dividend. He never bother about what is it? Market price. Okay. Here investor believes that the expected rate of return, being an investor, how much I am going to earn is absolutely higher than the return to be generated by who? Company, right? I am a company, you are the investor, you will expect 100% dividend. Then I said, sir, I will return, reinvest, I will give you better return. But what you people say, sir, if you return, reinvest, how much return you are going to get it? We can generate what? More than that, sir. Give it a dividend. In such a model, KE equal to EPS or DPS divided by net proceeds or market price. Market price equal to EPS or DPS divided by KE. KE also called investor expected rate of return or yield rate. Hello? Can you able to solve this problem? If you solve, you can dance like this because your bag with full of cash. Radiant Limited, this is a study material problem. Radiant Limited has a dividend of 10 per each equity share of 10 rupees each. The current market price of share is 80 rupees. How much dividend they used to pay? Equity share face value is how much? Now, how much dividend they are paying? 30. What is the current market price? 80. Sir, actually, shall I take 10 na? 80, sir? Sir, actually, face value 10 only. No, sir? MRF share price 10 rupees face value. 87,000 rupees. Now they will say that I am giving a 100% dividend payout ratio. 100% dividend payout ratio means how much? 10 rupees. What is the face value of share? 87. Last time, I think a few years, last quarter, MRF is declared 100% dividend payout ratio means 10 rupees. Face value, market price is 87,000. The entire market, they made a criticize. Maro, mujhe maro. Maro, mujhe maro. All the investors, they used to hold, maro, mujhe maro. What? See, 87,000 rupees I spent, I purchased a share. They are giving 10%. Try to understand how painful it is. But the equity shareholders' opinion is that, sir, company opinion is that he invested 10 rupees. We made it a capital gain. Try to understand, man, when share price is 87,000, right? So this is the market price. Coming to another one is earning price approach. See, in this model, what the point is, previous model, company, whatever it earns, it gives a dividend. Hello? In this model, I earns, whether I give dividend or not to give dividend, it does not matter, right? I'm your father. I'm your father means whether I will give money, not to give money, whatever money I will earn, that is whose money? Your money, right? My dad used to say, "Hey, can I take carry ra?" Now, whatever I will make, I will give you two, right? Dad, could you send 2 lakhs rupees? I want to celebrate a party, means he will come with the police. Okay, it means, but he used to say that what happened? Whatever the money he will make, that money is for you only, right? But in this model, company, whether dividend is declared or not to declare, that does not matter, right? But whatever the EPS it makes, it considered to be declared. Hello? That is a model. In this model formula, EPS divided by market price, right ma? Can you say in this problem? This is also study material. NSC Limited, earn 25 on each share, 100 rupees. Current market price is 125. But company pays 80% dividend, means how much? 25 into 80% means 20. Now dividend also is there, Maji. Dividend is 20. EPS is 25. Shall market price is currently 125. Shall I take dividend? Shall I take EPS? In first model, how much dividend I paid, you consider. This model, how much I earned for you, you consider. Whether I pay dividend or not dividend. Okay, that is an important. So EPS divided by market price into 100. What is it? Many students, not many students, few students, they used to ask, sir, what is the difference between dividend model and EPS model? Seems to be same only, not same, seems to be same. Whatever they made it EPS, they declared dividend. But here, whatever they made it earnings, either dividend declared or not to declare, they believe that this earnings belongs to whom? You only. That is their ideology, right? And another one is earning price approach. Earning price approach plus growth. In this earning price and approach also called constant growth rate. In this model, what the company do is, this model also covers in dividend model, Gordon's model. Here in this model, company whatever the profit it makes from the earned profit, right? This is the EPS, and this gives this much of dividend, and remaining amount what it do? Retain and reinvest and submits the growth rate. Why? Because equity shareholders expects not only dividend but also growth rate, right? So that is the reason here the financial manager able to find it out. Growth rate. Growth rate equal to retaining ratio into rate of return on reinvestment. So in this model, as per this approach, rate of dividend and growth rate remain constant. EPS is not equal to DPS. Do you agree? Why? This is from this EPS, I am not going to give declared DPS. I am going to give only partial. Remaining I am going to hold. DPS is 0 is not equal to DPS 1. DPS 0 is what, sir? Last year. DPS 1 means current year. So then how should I find DPS 1, sir? DPS 0 plus growth rate. Sir, DPS 2, sir? DPS 10, sir? Very good. So then in such a case, K equal to DPS 1 divided by net proceeds or market price plus growth rate. MP 0 equal to same logic from in this problem. Extract this one. DPS 1 divided by KE minus growth rate. This is the problem they have given in your study material also. Past exam model also they given. Market price is how much? 150. Cost of flotation cost is 3 rupees. Means 150 minus 3, it gone. So how much you have? Net proceeds would be 147, ma? You see. From under mentioned cost of equity X, current market price is how much? 150. Whereas flotation cost is 3. So 150 minus 3 means 147. Right, assume fixed dividend payout ratio. Expected dividend on new shares would be 14 point. So DPS 1. But you have to find it out growth rate. But company declared outstanding pattern of what is that? Growth rate. Over the period of how many years? 5 years. But seems to be 6 years. But here logic I told you. Here year begins at the end of the year. Means first year ending to second year ending 1 year. Second year to third year ending 1 year. Third to 4. 1, 3 to 4, 5 to 6. Are you getting? So 1 to 2, 1, 2 to 3, 2, 3 to 4, 3, 4 to 5, 4, 5 to 6, 5 years. So here year begins at the year ending. So you have to find it out this one. In order to find it out, the future value factor is given. How you have to identify it? See, net proceeds equal to market price minus flotation cost 147. DPS 1 is given. Growth rate you can find it out like this. You know that this problem I solved in classroom. In subsequent year, latest minus late divided by late. So DPS 1 minus DPS 0 divided by DPS 0, 5%. More than 1 year means you can use the concept of what is it? Time value of mining. By tracing factor value, you can find it out. Here also you will find how much growth rate? 5. So basing on this, you can calculate estimation of KE equal to DPS 1 divided by net proceeds plus growth rate. That would be 14.06%. I think 2000 few years back, I think, I don't know. This problem are given for how many marks? 5 marks they given. Convertible debenture 5 marks they given. This problem 5 marks is they given. And cost of debenture, shortcut method, yield to maturity method 5 marks. 4 papers I observed. That is the reason that 4 questions I put it here. Okay ma? Thereafter you have realized yield approach. What is that? Realized yield approach means once you buy a security, you hold it and finally you sold it. Over the period, how much return you got it? Simply it is nothing but realize. Already this entire chapter is nothing but cost of capital, right? Cost of capital in the realized yield given means what is the meaning of yield? That is a return. Whose return? Investor return. Means this entire concept explains that cost of capital is nothing but return made by whom? Investor. Tell me about your friend how he is stupid. I will tell you your stupidity. Hello? నీ ఫ్రెండ్ ఎంత దరిద్రుడో చెప్పు, నీ దరిద్రుడు నేను చెప్పేస్తానండి అర్థం. అంటే నేను ఎంత పే చేశాను నీకు ఎందుకు రా, నువ్వు ఎంత చేసావు చెప్పు నేను చెప్పేస్తానండి. దిస్ ఇస్ ద ఐడియా ఫర్ దిస్ వన్. బికాస్ యు నో title is cost, discussing yield. It means that what? For example, I wear this shoot, right? In marathon, where you get the shoot means management comes that this is our shoot. How do you say? Because how do you buy? I purchased it. How do you buy? I got the salary. Who paid the salary? We paid the salary. It means that you purchased means we paid. It means that we paid, you purchased means indirectly we purchased my balu. Ante that is what approach? Realized yield approach. Okay? But here realized yield approach, if you hold the share price 1 year means you have to understand for the sake of dividend how much you got it and the capital gain appreciation how much you got it. You have to add both. So you purchased market price. DPS 1 divided by market price, you will get the what yield? Dividend yield. And the capital gain being MP1 minus MP0 divided by MP0. So total KE is nothing but total yield. Total yield is nothing but dividend yield, capital gain yield. That is nothing but this. Once you hold more than year, then better to go with what is that? IRR. Okay? That is the identity. This is the technique which we identified. This problem speaks that with the IRR technique or shortcut method technique, you can calculate cost of debt. And this is another method. Which one? Capital asset pricing model. So far various managers are appeared in our class, right? And now this time even animal also coming in order to make you to chartered accountant. Capital asset pricing model. A elephant is walking on rope, right? It is from here to it is coming here. Certainly it might expect something written, right? Better than from where it is coming. Hello? Hello? It means that this elephant is taking what ma? Risk. ఇక్కడ ఉండకుండా ఇక్కడ ఎందుకు వస్తుంది ఇది? ఎందుకు వస్తున్నావు అనొచ్చా? So it is coming from here to here means it is taking risk means here it should get what? Plus. That plus whatever it may be. That is the idea of what? CAPM approach. CAPM approach, it shows the linear relationship between risk and return. Right here risk being classified into 2 types. Diversible risk, non-diversible risk. In this model we will take a risk means only non-diversible risk. Non-diversible risk also called what is it? Beta. Already we know that beta is how many types? Array, how many types? Greater than 1, less than 1, equals to 1, less than 1. Less than 1 means low risk. Equal to 1, normal. Greater than 1 means high risk. Basing on when risk is high, you have to pay high return. According to this model, KE equal to RF, risk-free rate. Then you have to give risk premium. Risk premium could be written like this. What is it? RF plus beta into RM minus RF. As see, from RM includes 2 returns. What is it? Risk-free rate plus risk-free rate. Already from RF you have given. So you have to find it out RP. RM minus RF, RP. RP depends upon what is that? Beta. As beta increases, RP also increases. That's profit is reward of risk taking. Today you took the risk, you've been here and you are facing this because today you are spending your valuable time. Fact is this, even you could not attend this one. This class might be available even in social media, but you cannot pay attention now how much you are paying. Absolutely. But మళ్ళీ చదువుకోవచ్చులే ఇంకా అది అయిపోయింది ఇంకా ఏం లేదు. So you see 1500 thoughts God will develop you to stop you to become a CA. 1500 times multiple chances will provide you that don't go to the class. Don't go. Comfortably here, take mobile, Instagram, WhatsApp, Tokka, Totakura, Sarvanasanam here itself. Okay? But you people, by overcoming that comfortability, you are coming and you are listening here. But something you are getting. You are taking little bit risk, but you would be rewarded. How much rewarded means once results came, man, the same day, one fine day results might be come. 11:30 results announced. 12 o'clock onwards, let us see what the celebration is, right? And those people who are celebrated. No celebrations. What celebrations? Celebrated. Finish. Already celebrated. But you people celebrating. How long? As an Indian economy. Developing. How long? Developing, man. Celebrating. Celebrating. How long? Celebrating. I am getting salary. What is the point? What is you? Celebrated. Then they used to say a wonderful memory that day. Actually, okay, that is the cost of equity. Means you are taking risk, means you generate what is it? Return. Profit is reward of what taking? Risk taking. Without risk, what you will get it? Nothing. So that is an important point, right? According to this model was proposed by Sharpe. Who? Sharpe in the year 1961. This model speaks that if the investor takes high return, irrespective of your level of stupid earning, you have to pay high cost to him because he has taken a risk. Risk means uncertainty of return. There are two types of risk: diversible, non-diversible risk. Risk premium should not be allowed to diversible risk because that risk can be diversified. Hence, it is diversified. The risk can be mitigated. The risk which is mitigated is not at all called what? Risk. Okay, but which risk to be considered? Non-diversible risk. Non-diversible risk which not happens in your control, right? This depends upon external factors: dollar value, war, inflation, interest rate, political instability. Everything may happens. That is the most important point. 2 days back, India, China, Germany and some other countries, they collectively made a meeting and they identified that why don't you develop a currency against of dollar. So far, even Indian currency also, international product can be produced, purchased in such a, if something has happens, automatically dollar value decreases, Indian currency value increases. That company, Indians, those people, some people will feel very happy about this. Some people will feel very, very sad about this. The people who went to America for settlement, when Indian rupee is increasing, what they do? Chalo Bharat. Why? If Indian rupee, they are going America because America is good. Americans are white, but that's the reason, right? For what purpose they are going? While living, friends and family members, food and everything, they are going and crying, man. I know that. Going and crying because you never find Cheruk Rasam and Pani Puri there, right? That would be reason. No. For the sake of income stability, they will go there, but they will lose the relationship, right? Because they are going for what is that? Only dollar value. If the Indian rupee increases, then they will be back, right? So if something happens, one company income position may increase, another company income position may decrease. So that is a diversible risk, non-diversible risk. Can you calculate here? Cost of equity capital has limited. This is study material problem. The rate of return, risk-free rate is how much? 10%. Beta is 1.75. Calculate market portfolio. Market portfolio is 15%. Now tell me KE equal to RF plus beta into RM minus RF. RF 10%. RM how much? Beta is 1.15. RM is 15%. RF is 10%. How much? 18.5%. Then you got it. Cost of retained earnings. Retained earnings are funds belongs to whom? Equity shareholders. Sometimes company may retain for the sake of better investment. When company retains, equity shareholders misses his expectations. Hello? Equity shareholders loses his opportunity cost. That is the reason when company retains funds of whom? Equity shareholders, he has to pay cost. So retained earning, how do you calculate? KE equal to KR. Because KE equal to KR means, since retained earnings are funds belongs to equity shareholders, but one condition applies. There should not be flotation cost. Okay, that is the point. Sometimes you have to recalculate. Hello? In such a case, investor expected rate of return equal to KE equal to investor expected rate into 1 minus brokerage. Hello, sometimes might be personal tax. Are you getting my point? Personal tax might be there. In such a case, you can calculate. Here you see, tell me how many formulas? One is KE equal to KR. Condition applies. No flotation cost. Sometimes KE equal to investor expected rate of return into 1 minus brokerage into 1 minus tax. So in such a case, here investor expected rate of return is how much? 24. But whereas shareholders goes with a personal tax. So 24 into 1 minus 0.35 means how much? 15.56%. That is the most important point to be considered. Here the same problem we took it, right? Another one is most important point. So far we calculated various costs. Hello? KE, KP, KD, everything. Now what we do is weighted average cost of capital. What is weighted average cost of capital? Weighted average cost of capital is systematic summation of various individual specific costs. What are the various individual specific costs? Tell me. This is what? Systematic summation is called what? KO. But the thing is not summation, systematic summation. In order to systematically sum, you have to use what is that? Two methods. You can go with this identity. You can take what is that? Various capital structure. What are the equity, preferred retained earnings, preference debentures. You take amount, you take a weight. Already I told you proportionate technique. This is the format given in your study material, but regularly we used to solve proportionate technique. You know, remember, KO weighted average cost equal to KE into equity share capital divided by total capital employed. This total table I given in the formula. So amount, weight and specific cost, and multiply this and sum it up, you will get it a cost of weighted average cost. Here the madam is asking marginal cost. Sir, cost of capital, marginal cost of capital, both are same, sir. The word marginal means what? Very good. Word marginal means additional. Marginal cost of capital, when company raises, what is it? Additional funds. While calculating marginal cost of capital, what are the steps to be used? Specific cost, marginal cost. Marginal cost may be used, marginal cost of capital may be used in product method, proportionate method. Okay. But you know, once you raise the additional funds, if the additional funds are raised by debt, automatically cost of equity should be, what is it? Recalculated. Why? Because already debt is there. Again, if you raise the debt means old debt, new debt, total risk what happen? Increases. In such a case, risk increases. How should I know, sir? Dividend may increase, growth rate may increase, market price may decrease. So this is the point, and this is the one of the repeated model problem in your study material. You see, PK Limited raised funds from how many sources? 3. What are they? Equity, preference, debentures. And this is the amount is given. You see, this is the old question paper, I think. Old question paper, I took it. This is amount is given. You try to understand. Check it is here. Problem is very simple, but amounts are given in crores. If you take zeros by A, what I told you, you have to kill all the zeros. Equity share company, market price is how much? 200. It is expected it will pay next year dividend 10. Next year dividend means DPS 1. Expected growth rate is 5%. Assuming tax rate is 35%. Calculate weighted average cost of capital. So first part A, if you do it, first you have to calculate estimation of cost of equity. Cost of equity equal to KE equal to DPS 1 plus market price plus growth rate. You will get it how much? 10%. Cost of preference. No coupon rate is the cost of preference, right? Cost of debt, you will get the tax advantage. So how much? 10% into 1 minus tax rate is 35%. Weighted average cost. Proportionate technique I took it, right? You got it 9.2 0.27%. It means that once the company raises funds, the weighted average cost would be how much? 9.27, right? Now the question is marginal cost. Marginal cost means additional cost. Along with this additional funds, now the company wants to rise. Here you see the part bit. Compute new weighted average cost of capital. If company rises additional how much? 50. Now 360 plus 50. This additional plus 350. This time you have to say for 410. Because of rising additional cost, you have to calculate marginal cost of capital. That is rising additional funds by what? Debt. Debt means, in try to understand, already old debt is there. Hello? Additionally again rising, what is it? New debt. Okay? Now try to understand, previously company used to get 10%, right? Now 12% is increased. What is the reason for that? Equity shareholders risk means risk to be influenced to equity shareholders. But here funds is available only debenture holders. Okay? See, when you are able to generate funds 10% means they are giving for 10. But when you are raising additional funds means they are offering, they 12% means indirectly their risk also what happen? Increasing. In order to compensate that one, they will increase, what is it? Coupon rate. Hello? So when debt increases means don't come to conclusion that risk will increases only equity shareholders, but also debenture holders. In marginal cost of capital, one of the specific point this is. But what happened? And this would result in increasing expected equity dividend is how much? 12.40. Previously how much dividend? It means that why it increased? Risk increased. Whom risk? 12%, 10% to 12, that is risk. Debenture holders. What about the leave the growth rate unchanged, but market price 200 to 160. So this is also revised. Risk of equity shareholders, what happened? Increased. Risk increased in such a way that market price decreased, growth rate increased, and dividend increased, growth rate remained unchanged. Now basing on this, you can calculate marginal cost of capital. You have to calculate, what is that? Revised KE you have to calculate. But this time you should take the market price, not 200. DPS 1 not 12.5. Growth rate remain same. So KE equal to DPS 1 divided by market price plus growth rate. How much ma? 12.5. World preference, no effect, right? Which one? No effect on what is that preference? This is the 11.56%. Cost of debt, old, no effect. But you raised a new debt. How much? 15. Into 1 minus tax effect would be there, you know. So how much it would be? 7.5%. Now you are going to calculate estimation of what cost it is. Marginal cost of capital, because you are raising marginal cost of capital, additional funds. Now it would be how much? 10.41%. Now tell me, dear students, what is this? Weighted average cost of capital. Because here how many sources? Here 3 sources. This is 1, 2, 3. Here marginal. One more point is added. What is it? But in this marginal cost, one of the surprising limited is you have to consider which one? Revised equity also. Right, ma? This is marginal cost of capital. Okay. Once again, what is a marginal word? When company raises additional funds by debt, automatically risk of equity shareholders increases, but also debenture holders, whomever the funds they have been providing you, they won't provide you at the same rate. Sometimes the coupon rate also increases. Repeated model, 10 marks they may ask you such a model. So they will give you calculate weighted average cost of capital and marginal cost of capital. And second important point is estimation of weighted average cost of capital basing on what value? Book value, market value. First of all, you should understand what is the difference between book value and market value. So book value, market value, it indicates, what is that? Book value. What is this book value? Issue price. MRF share price is 10 rupees. Now we are going to calculate weighted average cost, means the company has a 1 lakh shares. 1 lakh shares into 10 rupees means if we take weighted average cost by taking a 10 lakhs rupees, is it right? No, now on share price is 87,000 rupees. So now what we have to take? We have to take, what is that? Market value. Okay. So a company may, keep it in mind, a company may calculate weighted average cost of capital basing on what value? Book value, market value. Book value means number of security value issued at the time of issue. Market value means number of security prices floating in stock market. So if you check it, if you go to the office and if you open the books of accounts and if you check it, you will find Book value. If you look at NSE, National Stock Exchange, Bombay Stock Exchange, you will find what is it? Market value. Book value, historical one. Market value, present situation one. Which would be the right one? Market value. Why company calculates book value? Because to know the trend. Hello? Trend, if you want to understand whether it is worthwhile to make investment or not, that would be identity. Are Balu, Subbarao, son came ra. Subbarao son ra. Long ago, once upon a time, Subbarao, their family, today, what to do? Now tell me, is it progress or getting worse? Getting worse. If such a company is the Subbarao, will you make investment? No, if you have your security, you will start to sell and quit the company. You came to certain conclusion that only once you know what value? Book value and market value. Hey, Subbarao son came ra, what extra ra? Huh? Are 2000 before Corona, Subbarao son, I cannot ra. Now you see ra, you cannot see ra. That much of extra ra. What is this man? I couldn't identify ra. What is this ra? Now tell me, will you make investment or not? Yes, absolutely. How do you come to this conclusion? Because you know book value and market value. For Subbarao's previous one, book value is superb, market value is down. You never make an investment. Now second Subbarao, book value is the worst, but market value is somewhere, right? By try to understand those people who've been attending and involving this class, certainly few months after results will come. Then you will understand difference between book value and market value. Your friend says, he is my classmate. That is a book value. But you know, your classmate is cleared, what is it? Cainter. But you and me have a value. You are what value? Book value. Still you have to read the books. But because I kicked the books. This book value, market value, you will understand only once you get the results. Once results are came, right, the people will come with a sweet boxes. And you will also take the sweet boxes, right? And automatically then you should understand, Balu sir, understood sir, right? Book value, market value, right? This is an identity. Because this man is jumping with a briefcase. Book value mora, market value mora. Adi. Market value is very, very high. So this is the way. While calculating book value, market value, very simple technique. Number of security multiplied with what? Market value, then you will get the market value. Number of security multiplied with the book value, book value. But only thing is, while calculating weighted average cost of capital, market value, retained earnings could not consider. Why? Because retained earnings and part and parcel of what value? Market value. But the thing is, if the flotation cost is there, cost of equity is not equal to cost of retained earning. In such a case, you have to make what is that? Appropriation. Market value of equity has been apportioned in the ratio of what is that? Book value equity. Simple logic is that book value is there, market value is there. Okay. In book value, retained earnings there. A investor always purchases a share by seeing what is that? Retained earnings. If the share prices gradually increase, means share value is increased, it's because of retained earning also. So market value also indirectly have the contribution of retained earnings. If there is no flotation cost, cost of retained earnings, cost of equity, both are same. In such a case, while calculating weighted average cost of capital basing on market value, there is no need to calculate cost of retained earning. But the point is, when there is a flotation cost is there, in such a case, cost of equity is not equal to cost of retained earnings. Why? Because we won't charge what? Flotation cost. In such a situation, market value of equity should be as proportioned as a book value. For example, book value is 1 lakh is there. Hello? 1 lakh is there. So, whereas market value become 5 lakhs means, so this 5 lakhs would be proportioned as per book value and equity. For example, here 1 lakh, 9 lakh equity, 1 lakh retained earnings. Hello? Now, market value is 20 lakhs. In 20 lakhs low, total 10 lakh, 90% would be equity, 10% would be retained earnings. For retained earnings, you have to take what is that? KR and KR. For remaining 90%, you have to take KE. When there is no flotation cost, no need. Why? Because KR and KE will remain same. If, for example, I took this problem, here in this problem, weighted average cost, book value and market value. Retained earnings in book value you have considered. Market value should not consider. If in this problem there is no what cost? Flotation cost means what is your opinion? When there is no flotation cost, apportionment is no need. Hello? No need. In this problem, no flotation cost. When flotation cost is not there, proportionate valuation is no need. When flotation cost is there, proportionate should be considered. Are you getting? So this is the point in this problem. We can consider it. Equity debt would be identified because of flotation cost. KE, KR what happen? Changes. When KE, KR changes, then proportionate should be taken. When KE, KR both remain same, no need of taking what is that? Proportion. So this is the point, and key important points why I analyzed it. Because this model, last attempt only given. This problem. Same problem, 2022 question paper, same model. I give least preference to this one. I give much preference to this problem. Why? Because last time kya pucha? Weighted average cost, book value, market value pucha. This time marginal cost. That's why pay attention for this. Right, ma? And most important point, I analyzed past exam question papers. These are the some important points I analyzed. What are they? Read out. How many marks? 5 marks. Estimation of fair market value, 5 marks. Cost of redeemable debenture, 2 techniques. What are they? Shortcut method. Yeah. And estimation of growth rate oriented problem. I solved it. 5 marks they given. Tax advantage on interest. Then explicit cost, implicit cost means when rate is given, that is called what? Explicit cost. The rate what we are going to calculate is called implicit. Cost of equity. Do you know all the methods? How many methods? Cost of equity. Dividend to EPS. No growth in dividend to growth in dividend to realized yield approach to CAPM approach. Then weighted average cost of capital. Book value, market value. What is the difference? Number of security into book value. Book value, number of security into market value. Balu sir, you told that a proportion, something to be done. What sir that is? When you are going to calculate weighted average cost of capital basing on market value, retained earnings should be ignored because it is a part and parcel of equity. Condition applies when there should not be any flotation cost. If flotation cost is there, then market value of equity should be as proportioned as book value. For equity you take a KE, for retained earnings you take KR, right? Then marginal cost, additional cost. Sir, additional cost raised means only additional cost fund would be taken into consideration, sir. Additional cost should be calculated because of risk. Cost of equity should be recalculated. Do you remember? CR rule I told you in class. Calculate newly fund, recalculate equity. Hello? Then risk element of equity shareholders. Deep discount bond, it is a theoretical concept. Flotation cost impact, importance of cost of capital theory part, KE realized yield approach, earning price approach, right? So with this we completed which one? Cost of capital. All the best. And this is the important one. Afternoon session I will take a weighted average cost of working capital, because working capital means you need little bit, what is it? Solid food, right? That is an important. And you know that I personally believe that those people who've been committed, they only get passed, because I won't teach working capital now. Because reason is that are morning session చూసుకొని తర్వాత afternoon session jump అయిన వాళ్ళకి అందరికీ దెబ్బ పడాలిగా. And my student has to pass. My student has to pass. My student means the people who have a committed, they have to clear, right? And then another point is capital structure. This theory part maximum they used to give for how many marks? 5 marks. 5 marks. Weighted average cost of capital. At any cost you have to spend time. Whatever the identity is there, forced to stop and committed to this. Because for the sake of salary purpose, I put this much of efforts in order to keep my job safe and in order to make me too familiar to other people also. Because it takes me a lot of time. I will take the material, I can explain. But I want to give you that each and every in detail manner. That would be the reason I put. Because of this, not only my value increases, whatever the value I will give to you, your value also increases. That's why you may have 1,000 reasons to skip the class. Don't skip it, attend the class and learn it. Because in the absence, you feel that you are reading. You feel that you are reading. But actually you know that you are not reading, because I'm also student once. Yes or no, ma? Capital structure here. What is the capital structure? 2 marks question. In this model, 4 marks you can cover. Several times they asked what is capital structure. One time they asked what is optimum capital structure. Capital structure means it is a mix of just long-term funds. Capital structure means just a mix of long-term funds. What are the various long-term funds? Equity, preference, debentures, and all these things. What is the optimum capital structure? You have to consider this cost in such a way that overall either EPS should be highest and the market price should be high. Are you getting? So now tell me, what is a capital structure? It's a short-term funds or long-term funds, sir? Long-term funds. Are you getting? Long-term funds. What are the long-term funds? Equity, preference, debentures, long-term, right? Even retaining earning also. The objective of this optimum capital structure planning is to determine optimum. What is the optimum capital structure? Optimum capital structure is also called one of the capital structure where through which the company able to generate high EPS, low cost, and market price would be high. Balu sir, capital structure and financial structure both are same. Financial structure is both long-term fund, short-term fund. Capital structure is only long-term fund. Every company has to raise this funds in such a way that KO should be low. When KO should be low means market value what happen? Increases. Once you design a capital structure, dear students, you have to consider all these factors. What are they? When you are designing capital structure, it must be, what is it? Profitable. Hello? It must be flexible. It must be conservative, everything. So you should understand a few things. Here it is Satyam scam, right? When Satyam scam was happened, Ramalingarazu garu was holding just how much percentage, you know? The total identity. This is the biggest scam. He was holding at the time, he was the promoter of the company, but he used to hold only 15%. When scam was happened, he is unable to control ownership rights. Why? Because is the deposits is a whole percentage of holding is just how much? 15%. And whereas coming to Reliance company took a decision that entire India we should give internet free. Hello? Internet free means you are a shareholder. Will you accept it? Say yes or no? What do you say? No. Then they will give you mic. Tell me your opinion. No. Okay. No. What? No. No. Cheppanga sir no ani. Ade kadra antunnavu. No. Why? Because they hold how much? 51%. They will design capital structure in such a way that after all if it goes dividend are ready to take risk. But we don't want to give, what is it? Any ownership rights. They won't give it a ownership rights. So ownership always they used to hold. But whereas Satyam Computers situation is different. What about Vijay Mallya ji? Bhag gaya bachcha. Vijay Mallya ji have a equity more or debt more? Debt more. But royal man. Seems to be authority there as a Pawan Kalyan unnadu. Avana? Yes, here. But the thing is, you know, he skipped out. He is escaped from the country. It means that equity more or debt more? Very good. Debt more. Hello? What about the Nirav Modi? Nirav Modi also bhag gaya. What about Coffee Day CEO? Coffee Day CEO might have decided. No, exactly we don't know because we could not peeped into his books of accounts. But the thing is, Vijay, Coffee Day CEO lost his life. Might be, debt would be very less. Yes or no? Debt would be more. Vijay Mallya bhag gaya. Debt would be very, very less. More. Reliance has announced India free Jio, even though equity shareholders. No. What about Satyam Ramalingarazu? He reduced the debt percentage. He increased equity. That would be the reason. Means if you understand practically the situation what we've been discussing, so while designing capital structure, you should be able to identify in such a way that it should be profitable, it should be flexible, it should be conservation, it should be solvency, and it should be controllable. But while designing each and every capital structure, you should understand while you raising these funds, there would be impact on what is it? Risk, cost, control. Now tell me, if I go with equity, what happens? If I take equity, Maji, equity, tell me, risk low or higher? From company, here is the company. Company, it is a low, but cost high. What about control? Diluted. What about preference? Moderate, moderate, moderate. What about debt? Highest risk. Cost is low, diluted. Now for everything there is a plus, there is a minus. Everything minus means people reject it. Everything plus means people will accept. Minus plus is there means certainly they are being balancing, right? So you are a financial manager has to mix in such a way that while designing capital structure, you should understand what are the most important factors: cost, risk, control, and government rules and regulations. How do you determine optimum capital structure? When you explain, the people has to stare at you. What a capital structure, man, you have to say. While designing an optimum capital structure, you have to analyze 4 analysis, 4 approaches. If you want to explain capital structure like a manager, you should know analysis and approaches. If you don't know analysis approaches, you would be like this. ఇలా కూర్చొని లెక్కలు వేసుకుంటుంటావు. 10 రూపాయలు, 20 రూపాయలు, 30. ఏమిరా? Think in such a way, man, right? That would be, once you have a confident to talk, right? You should analyze, what is it? Analysis, approaches. How many analysis? 4 analysis, 4 approaches. Well, we know that when we go for any marriage relationship, I used to say, అమ్మాయిని చూడడానికి వెళ్తున్నావు అంటే అమ్మాయిని అలా చూడకూడదు, అటు 7 తరాలు, ఇటు 7 తరాలు. అమ్కో 7 terms no need, 4 that side terms, this 4 this time terms. Okay, 4 analysis, 4 approaches. First analysis, what is that? Second approach, third one, financial break-even point analysis. I know EBIT market price analysis from 2008, that question paper analysis. Market price analysis they asked one time, and all the 4 analysis they asked one time. All the 4 analysis 10 marks. Only one time, I think 2018 plus. First attempt lo what adigadi 1, 2, 3, 4 10 marks. Remaining all attempts they are asking 5 marks. And coming to optimum capital structure approaches, 4. What approach? Net income, net operating income, traditional approach, approach. In approach they have been asking market value estimation. That is, first one, they may give you capital structure planning. They will give you plan 1, 2, 3, 4. You have to determine which plan would be the best. Plan 1, 100% equity. Plan 2 may be equity plus debt, equity and debt preference, equity, debt and preference, like this. And factors to be considered, just now I told you. First analysis what? Tell me what is EBIT, EPS analysis? Sir, very simple. EBIT, EPS analysis, such analysis where we used to compute EPS from the given EBIT. Which financial plan gives you? That would be, we recommend best one. EBIT, EPS analysis. It is the analysis where optimum capital structure identified at a highest EPS. But you should able to find it out EBIT kada. EBIT, how do you calculate? Sales minus variable cost minus fixed cost. Or you can also find it out like this. EBIT, total capital employed into rate of return on capital employed. EBIT equal to, you can also find it out like this. What is this? EBT plus interest. What about EPS? Earning availability equity shareholders divided by, same logic. You have to prepare a format like this. From sales you have to calculate EPS. Which financial plan gives you highest EPS? From sales to EPS, tell me the flow. Contribution, fixed cost, EBIT less interest, EBT less tax, EAT less preference dividend, earning availability equity shares divided by number of equity shares, you will get the EPS. Which plan would be the best? Plan 4, because it gives highest one. This is the model problem, the modern chemical limited problem. This problem why I have taken from, this is a new study material, old study material, MTB November 2018, MTB November 2018 and MTB 2 May 2019. You try to understand my strategies. 18, 19 they given, but recently they could not ask this model. After this day, when you get the results, you know, that day you have to say, after writing question papers, sir, same question came, sir. Sir, how, sir? I feel very happy. ఒకవేళ వస్తే అరే maximum my guess is because you know similar model problems also is there, but this model they could not ask. But this model is new study material. My standard is why I picked this problem. Tell me. New study material, old study material. I'm MTP, RTP, past, they asked it, but no question asked from public exam recently. So there might be a chance to ask, right? So this is the problem. Some similar model is given in this problem. Here you see. The problem is Modern Chemicals Limited required 25 lakhs for new plant. This plant is expected to field earning before interest and tax. How much EBIT? 5 lakhs. While deciding about the financial plan, the company considered objective of maximum earning per share. Means what is the objective of the company? Tell me, ma. Market price or EPS? EPS, maximum EPS to be identified, my dears. So maximum EPS. How many alternative? 3. If planning rising of debt, how much? 2,50,000, 10 lakh, 15 lakhs. Even new study material also this model is there. And balance they are going to raise equity. The company shares are currently how much? 150 and expected to decline how much? 125 when funds are borrowed excess of 10 lakhs. The company can borrow rate of interest 10%, 2,50,000 and 15% above 2,50,000 and 10 lakh and above is how much? 20%. Tax rate is applicable to 50%. Which form of financing should the company choose? So this is the point. Means that what this problem, debt gradually company is going to increase. As debt percentage increases, rate of interest also increases. By considering this, you should able to find it out. Which one? EPS. In which financial plan EPS would be highest, that should be identified. In this problem, you see EBIT given. How much? 5 lakhs, 5 lakhs, 5 lakhs. Interest to be calculated. Interest is in option 1 is how much? 2,50,000 into 10%. How much? 25. Because total debt is option 2. Total debt is how much? 10 lakhs. 10 lakhs means it has a 2 slab rates. What is that? 2 lakh up to 2,50,000 is 10% and 7,50,000 15%. So 1 lakh. What is the option 3? 2,50,000 into 10% plus 7,50,000 into 15% and you got it how much? 2,37,500, right? Then by taking this interest, you deducted EBT less tax. You will get the earning availability to equity shareholders. Number of equity share. In first option it would be 150. Second option also 150. Third option I took what is it? 125. Why? Because the debt percentage is increased. In which option EPS would be highest? This option or this option? Not this, not this, this. Since EPS is highest, it is a better to choose which one? Option 2. That is a 60% equity and 40% debt. Got it, ma? So this is the point. This problem. Another approach is market price analysis. In market price analysis, you should understand what ratio? PE ratio. PE ratio is the ratio which shows the relationship between EPS and market price. By PE ratio equal to market price divided by EPS. Then market price equal to EPS into PE ratio. Basing on this, you can also find it out this problem. So here AB Limited, EBIT is 3 lakhs. No, tell me what is the relationship between market price and EPS? As debt increases, here one strategy to be increased. As debt increases, risk increases, PE ratio also, PE ratio decreases. As debt increases, risk increases, PE ratio decreases, then market price gets down. As debt decreases, risk decreases, PE ratio increases and market price increases. So that would be the point. Similar to here, this problem also very important. You see here the debt as well as what is that? Equity. So as debt percentage increases, then automatically risk increases and market price decreases. That point to be analyzed here. Here you observe this problem. The printed EBIT is 3 lakhs less interest. Already interest is there, 60,000. Earning before interest tax is 2,40,000. Tax rate is 35%. Earning after tax 1,56,000. Number of equity shares would be 40,000. Earning per share 3.6 and ruling market price is 39 and the PE ratio would be 10. Hello. Now the company has undistributed reserves of how much? 6 lakh and need how much? 2 lakh, which will the same rate already funds are earned. You are required that debt equity ratio higher than how much percentage? 35% will push the PE ratio down of 8 and interest rate and additional amount would be increases to 14%. Previously debt can be raised by how much percentage? 12%. If you raise additional debt, this time it would be 14%. The company has the two plans. What are they? One is of additional fund should be raised by debt and additional fund should be raised by equity. In two given financial options, you have to calculate which one? Market price. In which option market price would be highest, that should be accepted. Now, coming to this point is, you have to find it out. Here EBIT, already previous, what is the same rate of return company should be able to generate, right? EBIT previously how much it is? 12%. EBIT here, you see, this problem is little bit changed, that is, but the point is same only. Here what we have to calculate? Present capital employed, same amount only, but profit before tax is 52 lakhs, right? Interest rate is 12 lakh. Actually I saved this problem, little bit technical maybe, right? Here what we have to do is present capital employed we calculated, same rate of return the company able to generate. So present EBIT also 52 lakhs. Now what we have to do is EBIT proposed, present capital, additional capital, company able to generate what? Same return. That would be the reason 58,92,200 here and there. Less you have to deduct interest, old interest, new interest. Then you got the EBIT, less tax 50%. You got the earning availability to equity shareholder. Then number of equity shares to be taken into consideration. Number of equity share, old shares, new shares. At which situation market price decreases? Which situation? Initially when debt equity ratio more than how much percentage? What the problem they said here? Here, if the debt equity ratio is higher than 35 ratio, in such a case PE ratio comes to 8. Present PE ratio is how much? 10. Here what we have to do is, in each and every plan we have to calculate what is it? Debt equity ratio. Debt equity ratio equal to debt divided by total capital employed. So previously 100 plus 40 divided by total capital employed 340. In such a situation debt would be 41.18%. Hello, which is greater than 35%. In this option 100 plus here additional funds are you are raising by equity. So 100 divided by 340, here 29.41%, which is less than 35%. In such a case PE ratio would be here 8, here 10. In such a case if you take the market price, here 20.64, here 24.40. So this would be an observation for which option would be the best as per considering market price. In option 2, okay, and you have, this is the way to find it out. Which one? EBIT market price analysis. Thereafter indifference point. What is indifference point? It is the level of EBIT at which EPS will remain same between the two financial plans used to calculate EPS. Which financial plan gives you highest EPS, that would be recommended, right? Here EBIT EPS analysis we will prefer highest EPS. EBIT market price analysis we will prefer highest market price. In indifference point we will find it out what is that level of EBIT where EPS will remain same. Okay, indifference point formula. Indifference point formula is x minus interest into 1 minus tax minus preference dividend divided by number of equity shares. But formula will be remain same only. By resolving equation you can find it out. Thereafter financial break-even point. What is the financial break-even point? It is the level of EBIT at which EPS will remain same. Means company should earn that much of EBIT where the EBIT of the company should be equal to its financial commitment. When company goes with 100% equity, then 100% equity, in such a case financial break-even point is nil. 50% equity, 50% debt means company has to make what? Interest. 50% equity, 50% preference means preference dividend, but here you have to pay preference dividend divided by 1 minus tax. So for that purpose, this is an approval for preference dividend. And financial break-even point, indifference point, at a time if you identified, it would be 0, it would be same. Tell me, what is a financial break-even point? It is the level of EBIT at which EPS will remain same ochi 0 EBIT, and you have Excel limited problem. This is the problem your seniors got this one. You see MTP they given when they given 2018. Thereafter this problem is silent. In this problem, this model also problem is available. Since time constraint, here the 3 problems. Which one? 3 plans. Plan A, B, C. But one plan go with 100% equity, 50% debt, 50% equity. Here 50% preference, 50% debt. In this model they asked EPS they asked financial break-even point, indifference point. You know how to calculate EBIT, right? From EBIT to we calculated EPS. Which financial plan gives you highest EPS? That would be recommended. Thereafter financial break-even point for equity nil. For plan 2 it is a debt, you have to consider interest. That would be this much you have to earn. Whereas in plan 2 you have a preference dividend. So preference dividend divided by 1 minus tax, that would be 32,000. So this model problem also there in our material, you go with this. Then you have indifference point. Indifference point, it indicates it's a level of EBIT at which EPS will remain same. By considering plan 1 and plan 3, by resolving equation we got the 64,000. Hello? 64,000, at 64,000 both plans will give you what is it? Same EPS. And these are the 4 analysis. What are the analysis? EBIT EPS analysis, EBIT market price analysis, financial break-even point, indifference point analysis. Coming to here, what is the theory? A statement of fact based on certain assumption and condition. What is the capital structure theories? These are the theories which recommends to determine optimum capital structure. Theory, anybody can project their own theories, right? There is a personal, but here in capital structure theories being classified into 2 types. One is capital structure relevance theories, irrelevance theories. Relevance theories means because of your capital structure, you can achieve optimum capital structure. It is called, what is it? Relevance theories. Capital structure cannot be achieved, that is called irrelevance theories. Okay. Whereas other theories are called trade-off theories, pecking order theory. Got it? 3 categories. What are they? Capital structure, relevance theories, irrelevance theories, other theories. In relevance theories you will find what theory? Net income approach, traditional approach. Irrelevance theories, net operating income approach, approach. In capital structure theories, other theories, trade-off theories, pecking order theory. Right? Every theory is based on what? Assumption. There are only 2 sources of funds, K, equity and debenture. There is a guarantee of what? EBIT, total capital employed will remain constant. Cost of debt is less than cost of equity. Business risk remain constant. All the companies follows what? 100% equity. Hello? Right. Here net income theory was suggested by who? David Durant. You cannot expect a problem from this. You can expect what is that? Only theory point. Who projected net income theory? David Durant. This theory was suggested by David Durant. According to this theory, what is that? Very simple. According to this theory, a company may decrease its KO and increase its market value by employing least cost fund called debt. Since debt is cheapest, thus it is a best. So that is the point of this one. And Vijay Mallya followed this theory in a wonderful, effective way because he has taken a loan. See how many banks he has taken a loan. But might be this person might be very fond of which theory? Net income theory. Because you want to do business with what? Debt. Okay. Thereafter you have which theory? Net operating income theory. Here one problem for the sake of explanation they are given. If the company presently have 10 lakh rupees, let us imagine. If the company 10 lakh to, if it goes for how much? 40 lakhs. 10 lakhs to 40 lakhs debt, what happens? No. As per net income theory was suggested by who? What theory this theory explains? As a debt proportionate increases, because the least cost fund comes in the capital structure, high cost funds goes out, right? When least cost funds comes, KO what happen? Decreases. When KO decreases, market value of firm increases. Hello? Market value of firm increases. It means that when company has a 5 lakhs rupees of debt, 5 lakhs debt. If company 5 lakhs debt is there, 5 lakhs equity is there. 5 lakh debt, in the 5 lakhs equity, by redeeming 2,50,000 equity, and the company raised a debt. This time debt percentage what happen? Increase. When debt percentage increases, what happens? KO decreases, market value of firm increases. If the company decreases debt per percentage and employs equity more, in such a case what happen? KO increases and market value decreases. So this is the theory point with respect to market value of firm. As company gradually increases a debt, KO what happens? Decreases and market value of firm increases. You see the KO is decreasing as a debt percentage what happen? Increases. With effect market value increases. This is the which theory? Net income theory. Vijay Mallya might follow this concept. This concept indirectly speaks. Debt is cheapest, thus it is best. Net operating income theory. This theory also suggested by David Durant, but he shouted, who told you that there is no risk to whom? Equity shareholders. Net income theory has its own assumptions. Net income theory. What are the assumptions? KD is less than KE. There is no risk to whom? Equity shareholders, even debenture holders also. Company able to generate what is that? Stable earnings. But net operating income theory argument is a company debt equity mix of the company does not change what? KO and market value of firm. Why? Because the advantage of debt would be exactly set off with the risk element of whom? Equity shareholders. You are raising debt and you are getting a tax advantage, but the tax advantage would be exactly set off with the risk element. With effect, KO will remain constant and market value firm will remain constant. With effect, KO remain constant, market value firm will remain also constant. Thus, there is no any optimum capital structure, because every capital structure is optimum, because at every capital structure, market value of firm will remain same. What are the assumptions of this theory? This theory argues that KO remain constant while employing debt there is a KE increases. Hello? KE increases means the advantage of debt would be exactly set off. In this model, what you are going to calculate, KE is going to increase. KE formula, how do you calculate? KE equal to, how do you find it out? This one means market value of firm. EBIT divided by KO. Then KO, you know that in this model KO would be given, means you should able to find it out. Market value of firm. From the market value of firm, if you deduct market value of debt, you will get what? Market value of equity. This is the first point. From the EBIT minus interest, if you deduct, you will get what? Earning availability equity shareholders. So earning availability equity shareholders divided by market value of firm into 100. KE increases. In this theory, you have to prove that KE increases. Whereas net income theory, you have to prove that market value of firm increases. There what we used to calculate, market value of debt is given, take. Market value of equity, you have to find it out. Market value of equity equal to earning availability equity shareholders divided by KE, because the KE would be given there. So with effect market value of equity plus market value of firm. By adding both, you will get what? Market value of firm. EBIT divided by market value of firm, you will find what? KO. As debt composition increases, KO decreases and market value of firm increases. Coming to net operating income theory, debt equity mix does not change what? KO and market value of firm. Why? Because advantage of debt would be exactly set off with risk element. With effect KO remain constant. What this is? Debt is not a best. Debt is not a worst. It is a just finance. There is no optimum capital structure. Every capital structure is a optimum, because KO and market value of firm will remain same. Thereafter, what theory? Traditional theory. This theory was suggested by Isra Solomon. His argument is debt is best. A company can reduce its KO and increases its market value up to certain level. Thereafter, additional debt not only increases risk to whom? equity shareholders, but also to debenture holders. So debt would be the best up to certain level. Thereafter it will becomes costliest, riskiest, turns worst. I told in classroom, పూర్తిగా మారిపోయిన చంద్రముఖి. So that would be the point. Debt, this theory was suggested. This argument indicates debt is cheapest, thus it is the best, but up to certain level. Thereafter it become riskiest and costliest, that it turns worst. And finally you have most important point here, Modigliani Miller theory. Only one question they asked. This theory part already covered in theory, but in Modigliani Miller theory only estimation of what is it? Market value of firm. Modigliani Miller theory was suggested by Franco Modigliani and Merton H. Miller. This approach is refinement of similar to which theory? Net operating income theory, right? Net operating income theory. What is the net operating income argument? Net operating income argument that debt equity mix of the company does not change KO and market value of firm. Hello, the advantage of debt would be exactly set off with risk element of equity, with effect KO will remain constant. But this argument is market value of remains same, not because of set off effect, because of what is it? Arbitrage. Arbitrage means buying a security at a low price and holding it for right time and selling at a high price. Here you see there is a, practically we used to discuss this one. SBI share price 200, Yes Bank also 200, debt equity mix changes, market value firm will remain same. This is the net operating income approach. But suddenly when the two companies links with the stock market, suddenly if the share price 200 rupees share price comes to 20 rupees, what happens? Yes Bank comes to 20 rupees, then try to understand what is your reaction. Then people will start to sell what? Yes, which one? SBI, and people will buy Yes Bank. With effect, when the people will start to sell means its market value what happen? Decreases. If market value Yes Bank increases at one point of your time, both share price will reach us to equilibrium. Why the people will sell means there is a two reasons. What is it? Same investment, more profit. Another one is less investment, same profit. This would be the reason they used to make identity, right? Our class 1. So in next class we will continue this one. Which one? Right. Because you know my personal opinion with respect to preparing this one is cost of capital, capital structure, capital budgeting, working capital management, and a dividend decision. These are the repeated model. That's why it consumed a little bit time. We will continue next class. While in next class I will discuss with this. What is this? Estimation of market value of firm according to approach. So Modigliani and Miller approach. Previous class we discussed Modigliani Miller approach. Capital structure theories are relevant, irrelevant theories. What do you mean by relevant, irrelevant? Yeah. Debt equity mix of the company can influence cost of capital, overall cost of capital. If any theory believes that is called relevant. If certain theories, they used to say that capital structure market value is not at all related to one another. It is called, what is it? Irrelevant. Modigliani Miller is a practically proved which theory? Net operating income theory. Net operating income argument is that because of set off effect, KO remain constant. When KO remain constant, with effect the market value of firm will remain constant. But Modigliani Miller argument is there that the same companies have a link with the stock market. Because of the market bias information, stock price gets what is it? Fluctuated. In such a case, investor undertakes what? Arbitrage. It means that he will start to sell a security which is at a high price and he will start to buy low price. With effect, the lowest market value increases, highest market value decreases. At one point of time, both will reach to what is it? Equilibrium. In order to undertake a arbitrage, investor makes an estimation. What is the benefit for me by moving from this company to that company, or selling this company shares and buying that company share? How it is worthful? For that purpose, he used to make a two observation. One is same investment, more profit. Another one is what is it? Less investment, same profit. So this would be another alternative. Because of this, an investor undertakes arbitrage. Okay. Traditional net operating income approach, market value of firm will be equal. Why? KO remain constant. How? KE increases. What effect? Set off effect. Modigliani Miller approach is nothing but because of investor undertakes arbitrage. That would be the reason two unequal firms will set to be, what is that? Equal. Right here, how do you calculate market value of firm? This is the repeated model. Only one question from 2008 to now. They asked 2 times this question. Remaining everything, theory part they could not ask. Every question asked from EBIT EPS analysis, EBIT market price, indifference. But only one question asked that. How do you compute market value of firm according to MM? Before going to understand market value of firm according to MM, you should identify what is the identical comps. What is that? Identical similar companies. Modigliani Miller arguments that two similar company identical means same capital employed, same EBIT, same risk class, same business. But only thing is the difference of what? Capital structure. In such a case, how do you calculate market value of firm? Two similar companies in the presence of tax, in the absence of tax. See, in the absence of tax, market value of levered firm you should understand. Market value of unlevered firm you should understand. Question number 1. What is a levered firm? The word lever means risk. The company which has employee, which has debt in its capital structure, such a company is called, what is it? Levered company. Levered company means it could not go with 100% debt, right? It may have equity plus debt also. First, what you have to do is market value of equity you should calculate. Market value of equity is nothing but earning availability equity shareholders divided by KE. Okay. Then market value of debt means interest divided by KD. Estimates market value of firm, you will get it. Then market value of unlevered means you don't have a market value of debt. Okay. It means that earning availability equity shareholders divided by KE, if you take, you will get the market value of equity. Market value of equity equal to market value of firm, because that is only unlevered firm. Whereas in the presence of tax, I said, what is it? CA, calculate one, adjust another one, right? So it means that in the presence of tax, first you have to calculate market value of unlevered firm. Market value of unlevered firm equal to market value of equity, that is earning availability equity shares divided by KE. What about market value of levered firm means market value of unlevered firm plus market value of tax shield on debt. Market value of tax shield on debt means what, sir? Because of your employing over the period you are going to run the company, every year you will get the tax advantage. Since the company perpetual existence, forever you will get what? Tax advantage on debt. How much tax advantage for debt you supposed to get it in future? The entire total worth of the tax benefit is nothing but market value of tax shield. For this I gave a shortcut formula. What is it? Debt into tax rate. So no need to calculate market value of debt and market value of equity to find market value of firm according to MM. Simply what do you do? Calculate market value of unlevered firm, add tax shield to this, you will get, what is it? Market value of, this is the only problem they've been asking. One thing is, what is it? Market value of levered firm. This is once again I highlighted this one. Market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. Market value of tax shield on debt equal to debt into tax rate, right? Then this would be a problem. See, old practice manual, new problem, November 2018 public exam question paper. What, Maji? Right. I'm making you to understand this one. There are two firms P and Q identical except P does not use any debt. Does not use any debt means unlevered. Q has a 8 lakhs 9% of debenture in capital structure. Q has a debt of how much? So Q has levered, unlevered? Levered. Its capital. Both the firm have a earning before interest and tax. EBIT how much? 2,60,000 per annum. And the capitalization rate is 10%. Assume corporate tax rate is 30%. Calculate value of the firm according to MM hypothesis. Are you getting past exam question paper, old practice manual? New problem also is given but little bit changed. Hello? This is, how do you solve this one? First what to do? Abhi to Balu sir bataya tha, jab tax tha, what to do? Calculate first what to do? Unlevered firm. Between these two firms, which would be? Given information, P is unlevered firm. Do you agree? Q is levered firm. So debt is how much is there? 8 lakhs into at a 9%. EBIT 2,60,000. KE is 10%. Estimation of market value of firm according to MM in the presence of tax. First what we have to calculate? Market value of unlevered firm. That is a P. Okay ma? So market value of P equal to earning availability equity shareholders divided by KE. EBIT, how much? Interest 0. Why Balu sir you would have taken 0? Unlevered. Into 1 minus tax rate. Yes or no? Divided by KE is 10%. How much you got it? 18,20,000. Check the calculator, is it right? Night hurriedly I calculated. So might be any numerical calculators. Okay, Maji? Balu sir, in debt is there, 8 lakhs into at 9%. That girl is asking, that is only, interest enduku తీసుకోలేదు. That is which company? Unlevered. Okay, ma? Levered company తీసుకోవాలి. Right. Abhi dekho, market value of levered firm equal to market value of levered firm equal to market value of unlevered firm plus market value of tax shield on debt. Market value of unlevered firm how much? 18,20,000. Debt is how much? So debt into tax rate 30%. If you add both, you will get it 20 lakhs. Now tell me, two firms are in equal? Two firms in equal state? No. Q is where? Market value of P is how much? What about Q? Since both are identical, both firms' market value remains same. But how they will become same? Arbitrage. Are you getting? Market value is not same. But they will set to be same because investors may move from where? P to Q or Q to P. Q to P. How they move? By selling this company shares, they will start to buy which company? P. With effect, what happened? P market value decreases, Q market value increases at one point of your time. Both will reflect, both will reaches same. P, Q value increases or decreases? Why decreases? Because we sell. P increases. Why? Because we buy. With effect, market value will reach to equilibrium. So this would be the identity of MM theory argument. Got it, ma? So this is the total analysis of what is that? Capital structure, right? Along with that, I studied past exam question papers also. From the past exam question papers, I came to know that these are the questions. May 2010, they asked, what do you understand by capital structure? How it different from financial structure? First slide. Hello. I am saying this one. Whatever the slide I collected, I projected everything past exam. Only exam oriented. See. Again, discuss the financial break-even point, EBIT analysis. I discussed the theory part, even I proved in problem also. Next, list of the fundamental principle governing capital structure. I showed a hand. What are the factors to be considered? Now, November 2012, 4 marks. What is the overcapitalization state and causes? Initial introduction class itself, it's you may have overcapitalization, you may have undercapitalization. Question paper recovered. What do you mean by capital structure? First slide itself. Video class is recording. First class itself I told you. Yes or no? Yes. State the principle that should be followed while designing capital structure. Blue slide, third one. I projected this one. Okay. Every information just not collected from just study material. Everything identified. Problematic they may ask you. Theory also they will give you, Maji. Okay, man? Right. So how many analysis, please? What are they? EBIT, EPS analysis, EBIT, market price analysis, indifference point analysis, financial break-even point analysis. So this would be the 4 analysis the financial manager used to make. Clear now? As per EBIT, EPS, highest EPS. As per EBIT market price, indifference point, yeah, financial break-even point, no profit, no loss. Net income approach, favor of एक buy without face, I showed it. Net income approach. Debt is favorable, unfavorable. While increasing debt percentage, KO decreases, market value increases with effect. KO start to decrease, market value increases. Thus, the debt is best source of finance. Yes or no? Since debt is cheapest, thus it is the best. Don't write this one, just understand this one. What about the net operating income approach? Debt is not best, debt is not worst, debt is just. What about traditional theory? Since debt is cheapest, thus it is the best, but up to certain level. Thereafter it become riskiest, costliest, okay, and finally turns अच्छा नहीं है, right? So this is with respect to capital structure, right? Ma, the next one is we can take working capital management. So sometimes a student involved in that means debt, tax, depreciation, tax. Asano, when no depreciation, no tax, right? It does not means income tax లేదు అసలుకి ఎవరు తీసుకోమన్నారు మిమ్మల్ని డిప్రిసియేషన్ లేదు కదా ఇంట్రెస్ట్ మీద ట్యాక్స్ అడ్వాంటేజ్ యూ విల్ గెట్ ఇట్ నో ఇంట్రెస్ట్ ఓకే దిస్ క్లాస్ ఇస్ రికార్డింగ్ రైట్ యా ఇట్ ఇస్ అ పర్సనల్ డౌట్ ఓకే ఎస్ మాజీ నో యూ హ్యావ్ టు ఆస్క్ సార్ ఏసీ ఇస్ ఆన్ దీని ఆపేయండి సార్ ఫ్యాన్ హౌస్ లేదు రైట్ నెక్స్ట్ వన్ వర్కింగ్ క్యాపిటల్. After this class, if you have any doubt, you can raise. I will stay. Okay, no problem. Next one, not in the middle. हमको time बहुत कम दिया है. From this chapter, you should understand these are the most important points. Estimation of what is it? EBIT. Okay, because from EBIT EPS analysis, we used to find it out EBIT. Then price earning ratio, PE ratio. What do you mean by EBIT EPS analysis? EBIT market price analysis, indifference point analysis, financial break-even point analysis, risk element of equity shareholders. When debt increases, what would be the risk element to equity shareholders? Right? Do you remember the first problem? When debt is 5 lakhs, 15 lakhs, then coupon rate of interest also what happen? Increases means debenture risk increases, but after certain level, market price 150, it may goes to 125. That is nothing but risk to equity shareholders. That point is asked means I identified. Oh, this question, this point is asked. I made it note. Next, debt equity ratio. Do you remember? Debt equity ratio, one problem, PE ratio problem, they are projected. Assumptions of all the theories. Assumptions of all the theories, net income theory, net operating, traditional approach, estimation of market value of firm according to approach, tax when no tax. When no tax means there is no specification, any of the method you can calculate, but tax is there means CR rule. Calculate one, CA rule. Adjust another one. Formulas, market value of equity, market value of debt, market value of firm. Concept of optimum capital structure. Yes or no? Next, financial structure and capital structure. So these are the very, very important points. Already I showed you each and every question has in past exam experience, right ma? Right. Next, leverage came. Okay. So leverage. What is the leverage? Give me small support, I can do miracle. That is called what? Leverage. Chota se kya? Jada. So now you see this choti si. What is this? Right. Here you see this small. Right? No need because it is a recording. That's why I don't know Hindi mein. But this can move with the biggest efforts because of having what is it? Little bit support. This small one is called what is it? Leverage. And this is a Gangava, belongs to Bradipet. She can lift water with what? When there is a wheel. Okay. If not so, she will jump. Okay. Because of that much of effort she cannot do. So this is the chota se jada. And another one is even the small one. This is similar to your geometry box. Can have a capacity to lift your what is it? Car. Right. This is the leverage, and even if you want to do any big work, right? So with this, you can make a change. You see, this man can move this biggest rock, right? With a small rock, this one called what is it? Leverage. So finally, this is the everything with respect to leverage. But from the company point of view also, we can make an identity. Here we are studying about what is that? What is the leverage of the company? Means from the company point of view, we are going to study. Frankly speaking, every company, this is the company, right? Company has certain cost. Hello? The cost being classified into two types, fixed cost and variable cost. Are you getting? Fixed cost, variable cost. What do you mean by fixed cost? If you understand variable cost, fixed cost, 90% leverage chapter is finished. What is a fixed cost? Fixed cost incurred even if there is no activity. Risk of chances, non-recovery of fixed cost means whether you are produce a product, not to produce a product, such a cost would incurs. This is because of having fixed cost, how much risk the company is supposed to face is called what is a technically leverage. Because non-variable cost means those costs which varies, right? So whether you produce, then only you can, otherwise no. This is also called controllable cost. Which cost? Controllable variable cost, but it won't be. But fixed cost of the company once again classified into two types. What are they? Operating cost as well as fixed financing cost. Operating cost, in order to run business operation regularly, we used to incur rent, salaries, business operation expenses, all these things. These are the fixed cost. And sometimes in financial decision you taking, whenever you take a financial decision, you may raise the debt, right? For that purpose you have to pay interest and preference dividend, right? Because of fixed cost, how much risk you supposed to face is called operating risk, which is also called business risk, technically called operating leverage. Are you getting? Operating leverage, business leverage, operating risk. It arises because of what cost? Fixed cost. Because of financial decision, the company raises the funds, it has to pay interest and it has to pay preference dividend. Because of this, how much of risk the company is supposed to face is called, what is it? Financial risk. If the financial risk as well as business risk collectively called, what is it? Combined risk. It means that if sales increases, sales changes, what would be the impact on company earnings can be identified with the leverage analysis. Okay, variable cost won't come to this track. Why? Because this is a controllable cost. First of all, if you observe any company on general body meeting, they submit a income statement. By observing the income statement, you can identify what cost is here. Fixed cost. Thereafter, what cost is here? Financing cost, right? Okay, financial cost. Even the preference dividend is there, but practically there is no preference shares. But that is the reason 99% we will take an identity that which one? Only what cost? Fixed cost as well as interest. In the leverage analysis, what we are going to study about this concerned company. What is it? This concerned company, we are going to identify that what might be the impact on this company, right? If the company sales may, what is it? Changes. If sales may decrease and sales may increase. If sales increases, the company enjoys the benefit because fixed cost as well as interest will remain constant. What about the if sales decreases means? Sales decreases means fixed cost remain constant and the interest also remain constant. Because of this, the company suffers a loss. Such a analysis. So simply leverage, it indicates we are not projecting current status. We are going to say that if something change happens, it may happens. Okay. If the company happens, sales increases, right? This would be your condition. Finally, this chapter identifies that what if the company has highest what cost? Fixed cost, then advisable, don't take financial decision in such a way that interest and preference dividend should be high. What happens? Sir, high fixed cost, high financial cost, total cost will increases. Within 1 second, you may lose your existence in the market, right? That would be the reason. If it is a compulsory for you to raise the debt, then better to run the company without, not without, low fixed cost. Or fixed costs are low, then better to you can rise with what? Debt. High fixed cost is there, better to go with the equity only. Always run the company with what? Moderate risk. What is that? Moderate risk. So how many leverages are there? So this is the leverage techniques. Leverage is the technique which is used to evaluate risk associated with the business organization having two things. What are they? Fixed cost and as well as financing cost. So here this is the company. Here it is indicates this is the film theater of Prabhas. Operating risk. This is the film theater of Prabhas. When he constructed Asia's second biggest film theater, Corona pandemic came. And he recruited all the people. After recruitment of all the people, immediately Corona pandemic came. Now tell me what we do. Entire all film theaters are closed. But without maintenance, without film theater, he has to pay cost. Over the 6 months, he paid a cost. He's a film actor. He got the money here and there. That is the reason they maintain. Otherwise, no. Because you try to understand, to construct this film theater, he took the loan from concerned bank. He has to pay what? Interest. In order to run this one, maintenance this one, he recruited more than 500 members. He had to pay salaries. Now immediately government took a decision. The film theater is closed. Now what to do? He has to pay interest. You have to pay salaries. Means at a time fixed cost what happened? Increased. So how much of risk? So frankly speaking, I don't know exactly how much of profit you might have got it. But one thing is confirmed. You might have earned income from various sources. That entire source might be spent here. Because of huge risk. You should not take that much of risk. So that indicates, whereas this is the Kingfisher Airlines. Kingfisher Airlines also same problem. Once there is a small what is that, accidents with respect to Kingfisher Airlines happens, and significantly the Kingfisher Airlines could not able to maintain. With effect, revenue of the Kingfisher company is decreased. Once Kingfisher company revenue decreased, immediately company got collapsed and entirely it lost its existence. So because for maintenance of Kingfisher Airlines, you have to employ salary, you have to give, and aeroplanes maintenance from, at the same time when you use aeroplane space of other countries, you have to pay user charges. Everything is fixed cost, and the company purchased this flight by taking a loan from, let us take IDBI. You have to pay what? Interest, and you have to pay fixed cost. But one fine day sales are decreased because of non-safety measures. With effect, what happened? Kingfisher company got its place. No Kingfisher company today. But whereas here still it is surviving, means they maintain that logic. But here it's gone. So finally what we have to understand means how much of fixed cost we supposed to bear, how much of interest we supposed to bear. That minimum logic we should develop. That is called leverages. Actually this leverage, already I told you, it is extracted from physics. Chota hai, lekin zyada kaam karta hai. Right? Leverages been how many types? 3 types. Operating leverage, financial leverage, combined leverage. So sales to fixed cost. If the sales to fixed cost, what the leverage is going to explain means operating leverage. If sales changes, what would be the impact on, what is that, shareholders income? That would be financial leverage. From if sales changes directly, what would be the impact on shareholders income? Can be learned with what? Financial leverage. Now you see here, you let us make it small observation here. This is the company. Sales units are how much? 1000. Selling price, variable cost, fixed cost. Fixed cost means what leverage is there? Operating leverage. And along with that, company have, what is that? Interest. What leverage is that? Financial leverage. Let us take what happened in ABC Limited company. As sales increases, right? If you say, you see, present sales units how much? 1000. Sales 50 rupees means 50,000. Variable cost is 25. Contribution 25. Fixed cost 20. EBIT 5. What happens if sales are double? Everything is double. But fixed cost will remain same. That would be the reason what happened. 5,000 EBIT, but since sales are double, but 5,000 here EBIT went to 30,000. Are you getting? Why 30,000 it gone? Because of what cost? Hello? You try to understand. If the company has sales 150,000, variable cost 25,000, contribution 25, fixed cost is 20. You got the EBIT 5,000. That's everything is doubled. What happened? It should also be doubled, but here you got it more than double. What is the reason for that? Fixed cost, right? But whereas when sales EBIT increases means when sales increases, fixed cost will remain same. You will get the advantage. But at the same time, what happened? It is why she is jumping, because she got more than double. Whereas the same sales decreases, let us take 50%. In such a case, fixed cost will remain same. In such a case, 10,000 to where? 2,500. What to do? Yeah. So this would happens. So leverage indicates what is it? Return as well as risk. How many types of leverages? What are they? Operating leverage, financial leverage, combined leverage. Right here, operating leverage arises because of what cost? Fixed cost. It is also another name. Operating risk. Hello? Its name also called what is it? Operating risk, business risk, right? What operating leverage conveys? 1% by observing fixed cost. I am conveying here. Note it down, Mr. Balsubrahmanyam. At 1% sales changes. Okay? You are, for example, operating leverage is 40. What do you mean of this? 1% sales changes. Your EBIT is going to change by how much? 40%. If 2% changes sales, then it would be, what is that? 80%. Sir, 80% means a plus or minus. Anything may happen. I'm not speaking that either it is going to increase or decrease. I'm talking about decrease. So what is the formula for calculating operating leverage? Contribution divided by EBIT. You can also calculate like this. What is it? Percentage of change in EBIT divided by percentage of change in sales. Thereafter, you may calculate with the different formulas. Operating leverage, contribution divided by EBIT. Operating leverage, percentage of change in EBIT divided by percentage of change in sales. Operating leverage, combined leverage divided by financial leverage. Operating leverage, 1 divided by margin of sales. Hello? This problem already we discussed in classroom. Margin of safety. Right? Then operating leverage, if it is a negative or positive, when it would be better. Now try to understand, if the contribution is less than fixed cost, what is observation? Contribution is less than. So company is not able to handle, what is it? Fixed cost. In such a case, company moving in a favorable or unfavorable? Unfavorable. Whereas if the fixed contribution is more than fixed cost, yeah, contribution is less than fixed cost. What is the EPS, my boy? Positive or negative? Negative. There itself, no need to come to EBIT. उधर ही पता लग जाता है कितना है. So that is an observation. Whereas another leverage is, what is that? Financial leverage. Financial leverage. Tell me, what is that? It's another name. Financial risk. Financial leverage arises because of what? Interest and preference dividend. It is also called avoidable leverage. Why it is called avoidable? Because you have alternative to go with 100% equity. So financial leverage, what it explained? Financial leverage of the company is 20. What do you mean of this? 1% change in EBIT leads to given percentage of change in what? EPS. This is the financial leverage. Thereafter, one more leverage. What is that? You have combined leverage. Combined leverage is nothing but, it is also called total leverage. It is also called combined leverage. Combined leverage arises because of fixed cost, because of interest. Hello? So it shows the relationship between sales and EPS. Now tell me, which leverage shows relationship between sales and EBIT? EBIT to EPS? EBIT to sales to EPS? Combined leverage, right? Combined leverage of the company is 20. What do you mean of this? 1% change in sales leads to 20% change in EPS. So this is the combined leverage identity. First you should understand sales to, here you see, from sales to, what is it? EBIT, operating leverage. EBIT to EPS, financial leverage. Sales to EPS is nothing but, what is it? Combined leverage. And here it is the theory questions. And estimation of leverages, you have given a few problems. This is the problem, a basic model. See, why I have taken this one? New study material, old study material, similar problem, November 2018 public exam question paper. Got it? Maximum they used to ask this problem. Here operating leverage, financial leverage, combined leverage, return on investment. If the sales increases by 6 lakhs, what will be the EBIT? Well, if you want to calculate operating leverage, first you have to design which one? Income statement. Income statement, how do you calculate? Sales 24, variable cost 50%, contribution 12, less what you have to deduct? Fixed cost is 10. You got the EBIT 2 lakhs, less interest 1 lakh. Less interest is how much, sir? Debt is how much? 10 lakhs into 10%, 1 lakh. So you got this one. Basing on this, can you calculate operating leverage? Take calculator, tell me operating leverage equal to contribution divided by EBIT. Contribution is 12 lakhs divided by 2 lakhs. How much, ma? 6 times. Good. Okay. 6 times. What do you mean by 6 times, Maji? Yeah. At any cost, 1% change in sales leads to 6%. What about the financial leverage? EBIT divided by EBT. 2 lakhs divided by 1 lakh. 2 times. What is observation? At any cost, 1% change in EBIT leads to 2% change in shareholders' income, right? What about the combined leverage? Combined leverage, operating leverage into financial leverage, or else you can calculate contribution divided by EBT. So what is the observation? At any cost, 1% change in sales leads to 12% change in EPS, right? Then they asked, what is the return on investment? EBIT divided by capital employed. This can be projected before tax, pre-tax, after tax, right? I could not consider it a tax. And what would be the impact on EBIT if sales increases by how much? Simple logic is 6 lakhs increases means presently how much? 24. Here how much it is? 30 lakhs. Less variable cost. Everywhere 50%, right? Contribution 12, 15. Fixed cost will remain same. So EBIT would be here 2 lakhs, here it would be 5 lakhs. So 5 lakhs EBIT will forms, or if you want to ask incremental EBIT would be 3 lakhs. So this is the repeated routine problem from this. Operating leverage formula? Financial leverage formula? Combined leverage? Right. Then there is another model, preparation of what? Income statement. Income statement means this is the treasure hunt. This is the treasure hunt. This is second model they used to give. So sometimes they will give you, first model is they will give you income statement, we have to calculate leverages. Second model, they will give you leverages, we have to find it out, income statement. Comparing to first model, I observed second model frequently they are giving, okay? But in order to find the missing values, you have to understand given strategy. Strategy, known to unknown. Known to unknown means whatever the data he has given, you have to make experiment with only that given data. Okay, then only you can find that one easily. Then EBT can be written like this. EBIT minus interest. And sometimes what happen? Top to bottom analysis, bottom to top analysis. If you make identity, then only you will get it, right? So then, can you able to solve this problem? This problem, new study material is given, and MTP May 2017 they are given. But such a model problem frequently they have been asking. Operating leverage, financial leverage, interest charges per annum, corporate tax rate is 50%, variable operating cost is 60%, prepare income statement, right? How do you calculate this? Variable cost as a percentage of sales, how much? 60%. So variable cost as a percentage of sales means contribution would be 40%. So operating leverage is given. Hello? Operating leverage is given. With the support of operating leverage, there is a chance to find it out. What is it? Contribution. Whereas with the support of financial leverage, you can find it out EBIT. Hello? So in the problem, financial leverage, interest are given, right? You see, given degree of financial leverage is how much? 2 times. Hello? Whereas interest is 20 lakhs. Estimation of EBIT basing on financial leverage. Are you getting? Right. Degree of financial leverage equal to EBIT divided by EBT. EBIT divided by EBIT, can I write like this, right? So 2 EBIT divided by EBIT minus 20 lakhs. Thus EBIT equal to 2 into EBIT minus 20 lakhs. Thus EBIT equal to 2 EBIT minus 40 lakhs. EBIT equal to 40 lakhs. Once EBIT you know that, right? Then with the support of degree of operating leverage, with the support of EBIT, you can find it out contribution. So degree of operating leverage equal to contribution divided by EBIT. Operating leverage is 3. 3 contribution divided by 40 lakhs. Thus contribution equal to 120 lakhs. Once you know the contribution, then you can find it out, right? Simply contribution is how much? 40%. Hello? So then sales are 100%. Then contribution, if you find it out, fixed cost, EBIT interest already you calculated. Similar in this way you can find it out. From EBIT to interest if you deduct. From EBIT you have to come to down. Hello? From EBIT to, if you go top you will find the sales. So this much of analysis is given. Now tell me first model they will expect second model. Second model. Right? Then comprehensive model, this is the third model. Comprehensive model means they will mix everything and they will design a problem. This would be one of the similar problem you see. What is the firm's return on investment? Yes or no? You see, a firm has a sales of 75 lakhs. Variable cost is 42 lakhs. And the fixed cost is 6 lakhs. Debt is 45 lakhs at 9% of, and equity of 55 lakhs. This is, it has a debt of 45 lakhs, 9% interest and equity of 55 lakhs. Now, why I took this problem? In this comprehensive model, I am explained 3 models I took. First model, income statement they will give, leverage we have to calculate. Second model, third model, comprehensive. Then this comprehensive model, this is the model similar problem covered in old practice manual, RTP November 2018, MTP May 2018 and the new old also they have given. Such a model, very important problem. Why? Because it is given what is the firm's return on investment and does financial leverage is favorable or not. Now, we have to prepare income statement. Return on investment formula, what is that? Return on investment. EBIT divided by capital employed. 27 lakhs divided by 100 lakhs into 100. 100 lakhs, how do you get it? Equity is how much? 45 lakhs. This is the 50, right? Does it have favorable financial leverage? Favorable financial leverage means return on investment how much? 27%. What is the debt rate of interest? 6%. No, sorry, 9%. It means that company raising funds at 9% and investing and generating how much? 27%. So what do you say? Coupon rate of interest is 9%. Return on investment is 27%. Since return on investment is greater than financing cost, right? Thus, financial leverage favorable or unfavorable? Coffee Day CEO because of debt issue. What happened? Is financial leverage favorable or unfavorable? Exactly opposite might be happen. Okay? 27%, at 27% you might have raised funds and 9% you might have invested. Right? Thereafter, asset turnover ratio. What is asset turnover ratio formula? Turnover divided by total assets. Right? Turnover divided by total assets. Here in this problem, turnover is 75 lakhs, total assets is 100 lakhs, 0.75. The problem is asking in this problem whether the company has, if the firm belongs to an industry where asset turnover ratio is a 3, does it have favorable or unfavorable? High or low? Not low, very, very worst. Company asset turnover ratio 3 means, what do you mean of this? For investing 1 rupee on assets, they are generating 3 rupees of sales. But the company, how much they are doing? Even investing 1 rupee also, they are not at all generating, what is it? 3. Hello? So is it favorable, unfavorable? Unfavorable. Unfavorable indicate what is the reason? Maybe for the given sales that much of capital is no need. Hello? Or that much of capital you are investing? That much of capital you are investing means that much of capital you are investing means the sales you should expect what? More. Hello? Pakistan cricketer salary comparing to Virat Kohli salary is more than 7 times. Pakistan cricketer captain salary is less than 7 times. Or Virat Kohli salary is more than 7 times. See, 7 times we are giving. But the difference of Pakistan currency, Indian currency, not much difference. But we are paying our Indian cricketers 7 times higher than Pakistan. Even after providing such a facilities, if India loses match means it is very painful. Hello? Whereas Kenya cricketers, they used to do part-time job and here and there they works and they will come and they will pay the cricket. But they are winning match means you have to appreciate. Because without such a facility also, they struggled, right? When high income person gets success, it does not count, right? But a poor person gets success, it counts. That would be the reason for that. Then another one is you have to calculate what leverages. Operating leverage, financial leverage, combined leverage. Here you have an income statement. Sales you took it, less, what is it? Variable cost, you have a contribution, less fixed cost, EBIT, less interest, EBT. Operating leverage, how much? Take calculation. Contribution, operating leverage equal to 1 point. Contribution divided by EBIT. Financial leverage equal to EBIT divided by EBT. 27 divided by 22,95,000. 1.176. Combined leverage. Operating leverage into financial leverage 1.43, right? This is the point. If the sales drop to 50 lakhs, then the new EBIT would be as follows. If sales are how much? 50 lakhs. Present 70 lakhs. If proposed sales would be 50 lakhs means variable cost. Present how much percentage would be there? Same percentage will happens. Hello? Less contribution 33.22. But fixed cost will remain same. In such a case, EBIT would be, how much it is? 16 lakhs, right? It means that the sales are decreased by one third, right? 25 lakhs to here 33.33%. That means if the sales decreases by 50, then EBIT decreases by how much? Here it is how much? 27, 27 minus 11 lakhs. Okay. So this is irrelevant. How much ma? 40 point. Right. So these are the certain important point, dear students. And in this observation, basic model, very, very small chapter. It need much attention. Only 3 models they covers. The 3 models I gave a proof of evidence also. Okay. Remaining problems are there in our material. But that comprehensive problems, that just they will check your calculation efficiency. With respect to subject, you have to go with this. But after studying all the question papers, right, I analyze that estimation of, they have been asking, estimation of EBIT in this problem also they are asking, price earning ratio, yes or no, asset turnover ratio asked, right? Then a contribution ratio, variable cost ratio, break even sales, margin of safety, operating leverage, financial leverage, combined leverage, missing value, double-edged sword, double-edged sword. When sales increases, because of cost remain constant, you will generate what is that? Massive profit. Hello. When sales decreases, the same cost would be stands like a China wall and you are going to face biggest loss, right? That is called a double-edged sword. I have a sword. If I want to kill the enemy, I will kill it, right? But with the, greatness, if I say that I killed that man, means if I hold that knife on my shoulder, what happened? Gaya. So that knife not only kills others if you not take care about, right? Sometimes it happens. Recently, I think in Guntur, and constable was cleaning gun, right? It got misfired and he lost his eyes. 2 days back it is. So generally, constable has to shoot whom? Right. In his entire career, he never shooted, but he shooted. Okay? That is happens, right? That is very surprisingly. It means that the gun should be very, very careful, because that is a what edge? Double edge. Okay? Then business risk. Another name of business risk. Financial risk. Return on asset formula. Return on asset. EBIT divided by total assets or total capital employed. Return on capital employed. Same. Right. Return on equity. Return on equity. This is not EBIT. Earning availability, equity shareholders divided by equity share capital. Top to bottom analysis and bottom to top analysis. One problem, bottom to top, we got the EPS. Another, in the same part, what happened? EBIT to top we identified. Means sometimes in order to analyze, we have to find it out top to bottom and what is that? Bottom to top. Got it? Right. So this is the leverages ma. And next one, working capital management. Working capital management. Totally how many pages we covered? 300 pages are there. All the best. I hope so. Next, what is this? Working capital, right? This is a working capital. Every company has how many decisions? 3 decisions. One is that financing, investment. Working capital comes to which decision? Investment decision. Financing decision. Dekho, namaskar. Working capital comes financing decision. Yes or no? Array, investment decision. Once you raise the fund should not be kept idly. You have to invest. Investment should be done at what is it? Fixed asset and current assets. So fixed asset, current assets comes on which decision? Investment decision. So investment decision, in investment decision, you are going to plan to make investment on fixed asset as well as current assets. How to make investment on what is it? Current assets is nothing but working capital. Dear students, every company while estimating capital, it keeps the 2 important points. They consider 2 I's. One is that, what is it? Fixed capital, working capital. Fixed capital mean to investment on fixed asset. Working capital is to current assets. So how to make investment, this is the most important. You invested fixed asset, you don't have current assets, it could not happen. See, Air India, Srinagar to Jammu flight delayed after rat seen in plane. This is the flight. The company purchased by spending more than 7.5 crores. What is it? This flight. When the flight is going to take Srinagar to Jammu and Kashmir, passengers are went from engine, so a small rat came outside. ఎందులో నుంచి బీరువాలో ర్యాట్ దూరితే ఏం చేస్తుంది? ఊరికే అన్ని బట్టలు ఉన్నాయి చూసి లెక్కేసుకొని వస్తుంది, అంతే కదా? దేనికి కొరుకుతుంది, ఎక్కడ కొరుకుతుంది దానికి కూడా తెలియదు, వేసుకుంటే కానీ తెలియదు ఎక్కడ కొరికింది అనేది. అవునా? నౌ ట్రై టు అండర్స్టాండ్. This is the NDTV. I was reading this one. I thought to present. But when I was explaining this chapter, I could not got this one. But recently I was saved this one. While preparing this one, I searched this, I added this. Now try to understand, you are a person, you are entering into the flight, right? Immediately from engine, you saw the rat, right? And it was coming outside, it said, Balu Subramanian, don't worry, నేనేం చేయలేదు అని వెళ్ళిపోయింది అది. ఇప్పుడు ఫ్లైట్ ఎక్కుతానా? అసలు దేన్ని ఎక్కిందో, ఎక్కడ ఎక్కిందో తెలియదు, దేన్ని కొరికిందో తెలియదు. ఇప్పుడు చెప్పండి, వెళ్తారా మీరు? ఇప్పుడు అందరూ వెళ్ళిన వాళ్ళందరూ ఏం చేస్తారు? నథింగ్, కుచ్ నే హోగా, జావో. జావో మీన్స్ కిధర్ జావో రే, घर को ना ऊपर जाओ ना. So immediately the flight is stopped, and at the same time they put the penalty of the bulk amount on this. And even the Indian Aviation Department also warned it very, very seriously. Try to understand, Ari, you invested on a flight, right? Can't you invest properly working capital? So that is the very, very important for any organization, right? So 2 marks question, they asked what is a working capital? What is a working capital? Working capital is amount of capital allocated by the company for smooth running of the business. Hello? This is the 2 marks questions. Working capital majority they used to ask, right? So 2 marks questions they may ask you, what is the working capital? Working capital also part of what? Part of capital which made investment on what assets? Current assets. Okay, right. And here 2 marks question previously asked, what is the difference between, explain the concept of working capital. Working capital can be classified on the basis of value, on the basis of time. On the basis of value it could be, what is that? Gross working capital. On the basis of time it would be net working capital. Sometimes on the basis of value, gross working capital, net working capital. What is the difference between gross working capital and net working capital? Only current assets would be gross. Current assets minus current liability, net working capital. On the basis of time, you have permanent working capital, fluctuating. Hello? This is, are you getting what is, tell me concept of working capital being classified into? On the basis of value, on the basis of time. On the basis of value, gross working capital. On the basis of time, on the basis of value, gross, net. What is the difference between gross and net? Current assets minus. Right. The next one is significance. Very, very important. 4 marks question they asked already. But significance means smooth running of business, and in order to generate the profitability, or in order to face the risk, and to get the, what is it, growth and development and smooth payment, in order to maintain goodwill, you have to maintain, what is it, working capital. Got it? Now tell me, working capital should be maintained for what purpose? Smooth running. Keep it in mind, profitability. Because profit is reward of risk taking. Once you want to handle risk right, you must have the money. If you have any problem, what happen? You can handle it comfortably. Then this is the point. What is the working capital management? Working capital management, both are same. Working capital management means systematic management of working capital. You should not maintain more, you should not hold less. You should maintain, what is that? Optimum. If you have more working capital, it's not a good thing. And the least working capital also, it's not good thing. Right? How the corporate company estimate working capital? 3 methods they used to follow. What are they? One is basing on current assets holding period or operating cycle period. What is that? Current assets holding period, operating cycle period. There are certain corporate companies, they used to maintain, what is it? Ratio of sales, ratio of fixed investment. Hello? That is. And what is the operating cycle? What is operating cycle? Operating cycle is the time period in which raw materials are converted into cash. Such a cycle also called what cycle? Operating cycle or cash cycle. This is called operating cycle. So corporate companies, they used to maintain operating cycle operates like this. Okay? This is also called operating cycle. Why it is called operating cycle? A company takes a raw material and converts the finished product and sells them in the market and generates the profit, right? So the time length which is needed to complete this entire process is called, what is it? Operating cycle, right? Company also estimate, for example, you see here, a company gets, what is it? Raw material, hello? Then send to this one factory, that is a work in progress. Then immediately they will sell to produce the product, but they will keep it in godown, hello? Then they will make, what is it? Sales and generate cash. So in order to convert the raw material into work in progress to finished goods to debtors to cash, right? So how long investor has to wait? This entire time period is called operating cycle. If the cycle completes, investor generates, what is it? Huge income. Hello? In order to run this cycle, he has to maintain working capital. That amount which is estimated basing on that operating cycle is called working capital. Okay? For smooth running of any business. Here, examiner asks you calculate working capital, but he will give you various holding periods. To estimate working capital, you have to understand the following points. What are they? First, you should understand inventory norms. Inventory norms: raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, time lag. Cost sheet. Do you remember? Opening stock of raw material plus purchases minus closing stock equal to raw material consumption during the year. Add direct cost, direct wages, direct overheads. You will get the gross work cost. Add opening stock of work in progress less closing stock of work in progress. You will get cost of production. For this, what is it? Opening stock of finished goods less closing stock of finished goods. You will get the cost of goods sold. For this, what is it? Selling and office administration expenses. If you add it, cost of sales. For if you add a profit, sales. It would be on fingertips. Otherwise, that's so cost sheet. Thereafter, you should able to find it out. What is it? Estimation of individual current assets, individual current liability. From current assets to current liability, you will prepare statement showing working capital. Any problem is not given as in sufficient mode, then you can conclude the problem with what? Assumption. Sometimes client won't speak, right? He never be a Balasubramaniam, he will sing a wonderful song, right? It's not possible. But even though whatever the data he will give it, from the data you should able to identify it, right? What are the inventory norms? Raw material, work in progress holding period, finished goods, debtor, right? Thereafter, current assets, you have to estimate current liability, cost sheet, right? You should identify it. Various holding period based, you should able to calculate individual current assets. For example, raw material, it is a time period given to keep the raw material in a go down. Raw material holding period 2 months. Basing on that, can you take stock of raw material? Stock of raw material formula? Raw material consumed during the year divided by 12 months into raw material holding period. Very good. Raw material, you see, it is the raw material you purchased, but before going to send to factory, how long you are going to hold in go down is called, what is it? Raw material holding period. So stock of raw material formula: raw material consumed divided by 12 into raw material holding period. What about the work in progress holding period? It is a time period when raw material sent to factory, how long wait to convert the raw material into finished product. Here you used to invest on 3 things, right? One is a stock of raw material, wages, overhead. Stock of raw material formula: raw material consumed during the year divided by 12 months into work in progress holding period into 100% raw material you have to take. That depends upon assumption. What about wages? Wages incurred during the year divided by 12 into work in progress holding period, 50%. Wages, if not given specifically, then you have to take 50%. Overheads incurred during the year divided by 12 into work in progress holding period into 50%. So this is called conversion cost. So generally, why we have to take a conversion cost means, first we will estimate that how much money required to convert the raw material into finished product. But the client asks that I don't want to convert the raw material, I want to need an amount where I should able to run in a smooth manner, right? Smooth manner, if you have adequate 50% also you can maintain. So for the sake of conversion, you have to check the problem. If the problem won't give you any details or any direction, then follow assumption is raw material take how much percentage? 100%. Wages overhead take 50%. What about here cars are produced, but why they are keeping here? Because they are holding finished product and go down. Because if they produced, if immediately they will sell, what happens? Automatically supply increases, demand gets what up? Decreases. In such a case, every company has to produce the product regularly, but you should not sell the regularly. You have to sell or release the product as per demand. Hello? Already I told you, the nurse gives you, what is that? Saline. Small wheel is there, right? Why? In order to play. Yes or no? అందుకోసం ఇస్తారు అది. ఆ బాడీలో ఎంత బ్లడ్ స్పీడ్గా ఉంటుందో అది కూడా అంతే ఉండాలి. ఏమాత్రం తేడా వచ్చిందనుకో, దట్స్ స్టాక్ ఆఫ్ ఫినిష్డ్ గూడ్స్ ఫార్ములా: cost of production divided by 12 months into finished goods holding period. Finished goods holding period 4 months. What do you mean of this? Finished goods holding period means client comes to your office and he says that I produce a product but I won't sell the product immediately. I will keep it in for 4 months, because if I keep this product 4 months with me, right, then only I can able to maintain demand sustainably. Otherwise, when supply hits, automatically price gets what? Collapsed. Then what is this? You are selling here, collecting cash here. It is called what? debtors collection period. So debtors could be estimated, credit sales divided by 12 months into debtors collection period. And finally creditor, supplier also sometimes gives you credit, right? Credit purchases divided by 12 months into creditor payment period. Thereafter, sometimes wages overhead you may pay in a delay. Hello? Wages, sometimes delay means hardly it may take 10 days or 2 weeks or 3 weeks, but not too much. So wages incurred during the year divided by 365 into time lag. Overheads also, overheads incurred during the year divided by 365 into time lag. So this is the problem. This is the one of the problem I identified. You see how many times they ask this question. MTP November 16, MTP November 15, RTP 17, RTP 19. Same new study material, same problem also given, but little bit changed. Are you getting me? This many times they have a proof of evidence for this problem. You try to understand. If you are able to solve this problem, any of the model you can handle. Are you getting? Alright, can we solve this one? We try. A pro forma of cost sheet of Fibroblast Limited is given for your considerations in provides. Raw material cost, how much? 80. Direct labor cost, 30. Overhead, 60. Total cost, 170. Profit is 30. In the problem, depreciation is not there. Hello? When depreciation is there, there is a contradiction. Should we calculate cash cost or total cost? In this problem, there is no any issue. Right? Company keeps raw material in stock an average of 1 month. What do you mean of this? Raw material holding period, 1 month. Work in progress, half month. Is there any conversion cost is given? No. In such a case, what do you do? 100%. Which one? Raw material. Finished goods in stock, 1 month. Means finished goods in stock, 1 month. Right? Credit allowed by supplier is 1 month. Allowed by supplier. Creditor payment period. How many months, ma? 1 month. And allowed 2 months credit to debtors. 2 months. Time lag in wages is 1.5 weeks and lag in payment of overhead expenses is 1 month. Company sells 1/4 of output against cash. Means 3/4 credit. Cash in hand and bank put over together is 25,000. You are required to prepare statement showing estimate working capital requirement of Fibroblast Limited to finance activity level 1,04,000 units production. Assuming that production is carried evenly throughout the year and wages overhead accrue similarly. So whenever we used to calculate working capital, we estimate that everything goes in a smooth manner, right? This is the problem. Now try to understand in this problem. Raw material holding period, work in progress, finished goods holding period, debtors collection period, creditor payment period, time lag, wages, overhead, right? We have to calculate what is the stock of raw material. What is the stock of raw material formula? See, in order to explain this problem, I took the formulas, values also. Okay, stock of raw material formula. Raw material consumed during the year divided by 12 into raw material holding period. Take the calculator and verify whether I made it any numerical errors or not, right? 1,04,000 into 80 into 12 divided by 1. Okay, this is the stock of raw material. And I wrote it here, 6,93,000. Next, stock of work in progress. Conversion cost is given? No, conversion cost is not given. That's why I may go with the raw material 100%, wages overhead 50%. Stock of raw material formula. Raw material consumed during the year divided by 12 into work in progress holding period. 1,04,000 into 80 divided by 12 into 0.5 into 100%. How much? Okay, na? Are boys, you? No calculator. Involve. Time is very, very daisy time, right? Be active. Working capital. Okay. And next, overheads. What is the formula of overheads? Overheads incurred during the year divided by 12 months into work in progress holding period. How much? Correct. 1,04,000 into 60 divided by 12 into 0.5 into 50%. Next, work in progress. A plus B plus C. 5,41,000. Stock of finished goods. Cost of production. Balu sir. Cost of production, cash cost of production. What is the difference, sir? Depreciation. Sir, in this problem, can I write cost of production, cash cost of production? Anything you can write. Why, sir? Because there is no... Good. cost of production divided by 12 into finished goods holding period. So 1,04,000 into 170 divided by 12 into 1. 14,73,333. Debtors. Debtors also can be calculated cost of credit sales or what is that? Credit sales. So here I took the credit sales. Credit sales divided by 12 into debtors collection period. 1,04,000 into 200 divided by 12 into 2. 3/4 why you took it? 1/4 cash, 3/4, right? 26 lakhs. And estimation of individual current liabilities. Current liabilities formula, trade creditors, credit purchases divided by 12 into creditor payment period. Okay, Maji? So 1,04,000 into 80 into divided by 12 into 1, 6,93,333. Coming to wages. Wages incurred during the year divided by 52 weeks into time lag. So 1,04,000 into 30 divided by 52 into 1.5. 90,000. Overheads. Overheads incurred during the year divided by 52 into time lag. How much, ma? Correct, na? Total, right. Now you can. Stock of raw material 6,93,333. Work in progress 5,41,667. Stock of finished goods 14,73,333. Debtors 26 lakhs. Cash 25,000. Total. Check it this one. Right. Current liabilities, trade creditors 6,93,333. Wages 90. Overheads 5,20,000. And overheads 5 lakh total. Current assets minus current liability. You got the net working capital. In this problem assumption, a year represents 12 months or 52 weeks. While valuing work in progress, raw material are assumed to be finished to the extent of 100% and the wages overhead assumed to be completed to the extent of 50%. Debtors have been valued on credit sales basis. Alternatively, it can also be valued on cost of credit sale. Credit purchase are assumed to be raw material consumed during the year. 10 out of 10. చచ్చిపోలాడు ఇంతకు మించి ఇంకేం లేదు అసలు ప్రాబ్లంలో. ఆర్ యు గెటింగ్ రైట్? this is the problem. Same with respect to this is a working capital based. Okay, thereafter you have theoretical questions. What are the various working capital approaches? Model number 2. Do you remember matching approach? What are the financing approaches? You remember my auntie, my mamaji? Yes or no? Surprisingly, this question is asked for theory part, right? After what are the working capital financing approaches? Tell me. Do you remember theory part? After systematic estimation of working capital, company has to finance this working capital from various sources, right? There are 3 approaches. Which one? Matching approach, conservative approach, moderate approach. These are the 3 people. Yes. Working capital matching approach. According to this approach, company always maintains working capital higher, lower? Low, because low working capital leads to low cost, leads to high profitability. But you know that low working capital leads to low liquidity, high risk. Hello, every policy has certain positives and negatives. That day I showed Andhra Bank. If you go to the Andhra Bank, they will maintain it at least cost. They will hold. No, this class is recording. Andhra Bank, Adbhut Bank. Okay. Yeah, I remembered. I went there, sir. Superb, sir. What is superb, right? This is matching, correct? Matching approach, right? And coming to what is that? Conservative approach. Conservative approach means these companies, they used to maintain what is that? More working capital. Are you getting? This is what is that? This is Sun Pharma company. Do you remember Sun Pharma company holds more amount? One fine day, one person. Class is recording, right? This company is very good. Right? Okay. So it means that these companies, they used to maintain more working capital. This is also another company where it can hold what is that? More. This is, you see, certain organization, they used to maintain more working capital because they want to maintain company in a smooth manner. Here 3 approaches. Tell me. One is matching approach. What is a matching approach? According to this approach, company always maintains what is it? Low. Conservative approach, more. Moderate approach is medium. So this concept I covered because theory part there is a chance. But here observation, matching approach, working capital low, liquidity low, risk high, cost low, profit high. Conservative approach, working capital low, liquidity, working capital high, liquidity high, risk low, cost high, profit low in short run. Okay, moderate. Are you getting? So this is the second part. First part we completed working capital estimation. Second part I discussed with what is it? Approaches. And third one we are going to discuss what is that? Operating cycle. Second important point. Every corporate company, after estimation of working capital, every businessman, they will expect to see that is there any chance to reduce working capital. In order to reduce the working capital, what we have to do? First we should understand that to calculate working capital, we have taken operating cycle period. In order to reduce the working capital, first we have to reduce the working capital holding periods. For that purpose, you should, once if you want to reduce the holding period, means you should compare with the benchmark companies. In order to understand all these things, you must able to find it out. What is operating cycle? What is operating cycle? It is the time period in which raw materials are converted into cash. It includes various holding period. What are they? Work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, and time lags. Okay, how do you estimate net operating cycle period and working capital basing on operating cycle period? Generally, dear students, net operating cycle period is a combination of what are they? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period minus creditor payment period. One question paper already I observed it. Sometimes instead of holding periods, they may give inventory conversion period. Inventory conversion period is summation of raw material holding period, work in progress holding period, finished goods holding period. Got it? Right. So now net operating cycle period also you can calculate like this. Inventory conversion period, debtors collection period minus creditor payment period. Got it? Right. How do you calculate number of cash cycles or cash turnover? 365 divided by net operating cycle period. Working capital, how do you calculate? Total cost divided by number of cash cycles. Hello? So this is the way to identify this. But meanwhile, how do you calculate raw material holding period? Do you remember the formulas? First you know the raw material. Now tell me, remember raw material holding period. Average stock of raw material divided by raw material consumed during the year into 365. What about work in progress? Average stock of work in progress divided by cost of production into 365. Finished goods holding period. Average stock of finished goods divided by cost of goods sold into 365. Sir, cost of goods sold is not given, sir. One problem, cost of goods sold really not given. Then cost of production to be taken. When cost of production is not given, cost of goods sold to be taken. Sir, what is the difference between cost of production and cost of goods sold, sir? Opening and closing stock of finished goods. If the opening and closing stock of finished goods not there, then you can consider directly, right? And debtors collection period. Average debtors divided by credit sales into 365. Creditor payment period. Average creditors divided by credit purchases into 365. Average creditor payment period also called what is that? Deferred period, right? These are the point. What is operating cycle? It is a time period in which raw materials are converted into cash, right? Operating cycle includes various holding period. What are they? Very good. You know these formulas, right? Why we have to understand, sir? Sir, generally a client comes with a holding period. I have a skill to calculate amount of working capital. Next, generally a client comes with a working capital. I may say that could they able to reduce? How should I reduce? Very simple, sir. The amount what you will bring, I will convert into time. The time I will compare with benchmark. Then I will observe that whether there is a chance to reduce or not, right? In the same operating cycle period, we discussed the Aarti Agarwal case study. Hello? Aarti Agarwal. Food will take a time to become fat. At the same time, fat has to go in the form of sweat also need what is it? Time. Immediately, aisa ho gaya. Jai Hind. Okay, this is the problem. You see why I have taken this problem. New study material, this problem is there. Old study material problem is there. May 15, 8 marks they have given. To May, new study material problem is there. This problem already given May 15. तब से अब तक नहीं पूछा. इस बार तो पूछेगा है ना, that is. Can you able to solve this problem? The following information. You listen this problem, with this class, entire class, right? 99% you can clear. But the thing is, of course, those people may not be attentive to today class, but even in the social media also that would be posted, right? You take the material once again just to observe this one, because every question has its own proof, past exam question papers. That is the reason, understand the concept and able to solve. Even something goes negative with this information, you may get what? Money. Of course, certificate sometimes is valuable, no doubt at all. Sometimes by chance negative, don't worry, because this information will feed you. Certainly. Shall we check this one? An average of debtors collected after how many days? 45 days. It means that what period it is? Debtors. Inventories have an average holding period of 75 days. Credits payment period is average of 30 days. Company spends total 120 lakhs annually at a constant rate. It can earn a 10% on investment. It means that by chance, if the company able to reduce this working capital amount, this saved amount, it is going to be invested outside, and basing on that, it may generate some income. That would be the reason he has given opportunity cost. From the above information, you are required to calculate cash cycles and cash turnover and minimum amount of cash to be maintained to meet the payment due. That is nothing but working capital. Okay, minimum amount required, that is nothing but working capital. Savings by reducing the inventory holding period by 30 days. Same problem in a new study material, little bit they modified. Okay, why I took this one, when I thought it that same students, same problem, if I discuss once again, you won't feel little bit interest also. That's the reason I thought it. If it is the same problem I taught it in class, is there any other problem in past exam, little bit innovative? Hello. So that what happen, you people also will feel, okay, this is the problem not we discussed in classroom, but the similar model problem, but which has asked by CA Institute. Okay, that's. Now, can you say, given information, inventory conversion period, how much? Debtors collection period, creditor payment period, 30 days, right? Estimate cash cycle period. Cash cycle period means, sir, cash cycle period kya, sir? Hello, operating cycle period itself is the, what is that? Cash cycle period, man. Now tell me. So here, inventory conversion period 75, debtors collection period is 45, minus creditor payment period is 30. 75 plus 45 minus 30, how many days? 90 days. Number of cash cycles? 360 divided by, sir, why can't I take 365, sir? But in the problem, they clearly mention how much? 360. Right, 360 divided by net operating cycle period. How much? 4. Next, estimation of number of operating cycles in a year. 4 cycles. 360 divided by 90. How much? 4 cycles. Part B, estimation of minimum amount due for cycle or working capital for a cycle. That is nothing but, minimum due means nothing but working capital. Working capital equal to total cost divided by number of cash cycles. Means 1,20,000 divided by 4. How much? 30,000, right? And the estimation of savings by reducing inventory conversion period by how many days? 30 days. Here, working note 1, estimation of proposed net operating cycle period. Net operating cycle period equal to inventory conversion period plus debtors collection period minus creditor payment period. Previously, inventory conversion period 75 and 30 days reduced. I made it a minus of 30 plus 45 minus creditor payment period is 30. Sir, minus 30 kya, sir? First 30 is reduced 30, second 30 is creditor payment period. Okay, 60 days. Now, estimation of proposed number of cash cycles. Number of cash cycles equal to 360 divided by net operating cycle period. 360 divided by 60 equal to 6 cycle. Now, estimation of proposed working capital per cycle. Total cost 1,20,000 divided by 6, 20,000. This time, previously how much? 30 lakhs. How much now? 20 lakhs. How much is saving? 10 lakhs is saving by considering opportunity cost. 10% means, because 10% is given, savings hardly 10 lakhs only. On the savings, if you calculate opportunity cost, then it would be 1 lakh. So this is the most comprehensive repeated problem. Even in new study material also, such a huge problem is not there. This problem is very, very good. Okay. Similar model problem, they might what? Modify it. With this, we completed second one. Third one. First one is working capital estimation. Second one is working capital financing approaches. Third one is operating cycle and its estimation. Right, ma? And thereafter, we have another most important concept. What is it? Debtors management. Damn sure past exam 4 are rankings, 4 areas where working capital management problems been asking. Number 1, working capital estimation. Number 2, operating cycle. Number 3, what is it? Debtors management. Right. Debtors management. Debtors means whenever we will make a credit sales, what firms? Debtor firms. Management means what the manager do is called management. Debtors management means what? Systematic management of book debts. Systematic management of book debts means, you see this man. If you provide more credit period, what happens? More credit period leads to? If I give more credit period, what is the benefit to me, man? More credit period leads to more sales, leads to more profit. Yes or no? Because more sales means I will produce more product. Hello? If I produce more product, fixed cost will gradually decreases. If one unit if I produce, same fixed cost. 100 units I produce, same fixed cost. Since fixed cost will remain same, I will get the double advantage. Hello? That is the reason I will offer more credit period. This is the one advantage. Disadvantages is, if I give credit period more, then I have to put lot of efforts to collect the money. So I have to spend, what is it? Collection cost, administration cost, bad debts, cash discount, opportunity cost, because my amount gets blocked. So every financial manager has a dilemma with respect to 2 things. So what to do? Should I offer credit period or not? So this is the dilemma they will identify. For that purpose, we have to observe debtors management. What is that? Debtors management, where every company they used to design a credit policy, whether it is worthful to providing credit period or not. Debtors management includes the 2 things. One is offering credit period or offering credit period, extending credit period. 2 things. First time offering credit period, already offered means extend the credit period, and increasing book debts. This first part always increases. First time not offered, offer. Already offered, extend. This is the one part. Second part means no offer. I want to collect the money. If I want to collect the money means you do one thing, offer cash discount. Hello? I don't give a cash discount. Then take another person's service. Arangalpet RO line, one person is there. Or who is the name? Factor. These are the 4 models. 4 problems they used to give. First one, tell me. Offering credit period. Second one. Instead of first model, second model would be very, very important. Because already you offered and this time extended. And third one, you want to collect it. For the sake, cash discount. Or sometimes you may take factoring service. So book debts includes, debtors management includes management. Management means, if it is very low means you can increase. If it is high means you can decrease. Hello? This is debtors management includes. Now in order to evaluate means already I offered, I want to extend means how the corporate company evaluate the policy. Suppose company offers 30 days credit period, it wants to make it how much? 60. In such a case, expected profit. What they do? They will take the sales. Hello? From the sales they will deduct a variable cost. Then they will find the contribution, less fixed cost, less bad debts, less cash discount, less collection cost. After deducting everything, they will make a PBT. Then they will get the tax. From that they will pay profit after tax. This is the sales or profit you supposed to get it by offering 30 days. 30 days, how much profit you supposed to get? 60 days, how much you used to get, you have to find it out. Then one more thing left, that is called opportunity cost loss. In present, how many days your amount getting blocked? 30 days. Here, how many days? 60 days. Then you have to calculate opportunity cost. So opportunity cost can be calculated on sales based. Opportunity cost can be calculated on cost based. And present sales 30 means opportunity cost on sales based. How do you calculate? Credit sales divided by 360 into debtors collection period into opportunity cost. On cost basis, total cost means what cost? Variable cost, fixed cost, and into debtors collection period into opportunity cost. Net benefit present 30 days, how much it is? 1,50,000. Hello? 60 days, how much it is? 5 lakhs. Additionally, 3,50,000. Now tell me, 3,50,000 additional amount. What should we do? Is it worthwhile to offer or not? Yes, absolutely it is a beneficial to offer. Suppose if it is a 1,50,000 also in proposed system. Here 1,50,000. Here also 1,50,000. Then no need to provide. Why? Because both will remain same. Here 1,50,000. Here 1 lakh. No. Right? This is the way to find it out. And got it now, ma? What is that? Expected profit. Sales, variable cost, contribution, fixed cost, bad debts, cash discount, collection cost, PBT, tax. Got it? Opportunity cost can be calculated on sales based and cost based. Now coming to, sir, is there any chance to ask public exam? You see, this is the problem. New study material, old study material, MTP November 2017, MTP May 2018, MTP November 2018, new and as well as old. Now tell me, if you are able to solve this problem, XYZ Limited Corporation come. Now this is the what model? We discussed debtors management. Okay. XYZ Limited is a corporation is considering relaxing its present credit policy and in the process of evaluating two proposed policy. Currently the firm has an annual credit sales of how much? 50 lakhs and account receivable turnover ratio 4 times. Very, very important. This is the point. Accounting receivable turnover ratio is 4 times means debtors collection period in a year is 4. Means 12 divided by 4 means how many times they are given? 3 months. Hello? That would be the reason 3. 3 times means? 2.4 times means? Majid, 3 times you are able to collect the cash means? In a year, 4 times means what is that? 4 times how much? 3 months. 3 times means? 2.4 means? 5 months. Instead of giving this months, they have given in times, right? The current level of loss due to bad debts is how much? 1,50,000. Hello? Here it is. Here it is. Here it is how much? 1,50,000. The firm is required to give return on 25%. What is this 25%? Opportunity cost benefit of the investment on account receivable. The company variable cost ratio is 70%. What about 30%? Contribution ratio. Selling price given the following information. Once again, company has present credit period. How many days? 3 months, right, ma? 4 times, right? And it has present policy. It has 2 policies. So here 3 times means? Here 2.4 means? Right. Now present bad debts is how much? Proposed bad debts. Again proposed policy. Sir, Balu sir, my point of view, I think policy 2 looks better, sir. Why? Because Balu sir, you try to understand the sales is going to be how much? 67,50,000. Of course, check the bad debts there. Okay, there more sales, there is a more chance to get more profit, but at the same time, more bad debts. What about in our policy option 1? Less sales, but bad debts also less. So this is the problem. Repeatedly they asked it. Can you able to solve this one? Now let us take evaluation of credit policy of which company? XYZ Limited, right? Particulars, present policy, proposed policy 1, proposed policy 2. Expected profit, sales, how much? 50. Shura, here it is 50 lakhs. Here it is 50, right? 50, 60, right? Here it is 60, 67. Variable cost ratio. Variable cost ratio not given, sir. Given kada 70%. And now calculate whether my calculation is right or wrong. Now tell me. Variable cost 50 into 70%. 30. Second one. Shura. 67.5 into 70%. Right. Next you got the contribution. 50 lakhs, 18 lakhs, 20 lakh, 25,000. Less bad debts. 1,50,000, 3 lakhs, 4,50,000. Net profit. 13,50,000, 15 lakhs. Right. These are the net benefit. What about opportunity cost? Opportunity cost. And we can calculate on sales basis, cost basis. We gone with what? Cost. So total cost divided by 12 months into debtors collection period into opportunity cost. So 35 lakhs divided by 12 into 3 into 25%. How much? 2,18,750. Proposed policy 1. 42 lakh divided by 12 into 4 into 25%. 3,50,000. Proposed policy 2. 47,25,000 divided by 12 into 5 into 25%. How much? Right. Net benefit 11,31,250. Here 11,50,000. Right. Comparing to this one. Right. 13,50,000 minus 2,18,750. Hello. Second one. 15 lakhs minus 3,50,000. 11,50,000. Third one. 15,75,000 minus 4,92,000. 10,82,000. Comparing to first one, policy 1 would be good, right? Because present policy giving 11,31,250, whereas policy 2 is a negative, right? 10,82,000. So that's why which policy would be better? Policy 1. So this is the way to evaluate debtors management. Are you getting? So with this debtors management we identified, and from this debtors, one more important factor concept is, what is it? Factoring. Most important point, also little bit confusing area. Few people cannot understand effectively this one. What is the factoring? Factoring is relatively new innovative service, right? In this factoring, what happens? A company, if you want to make a sale, what they do? Here a company firm is there. If it makes a credit sales to customers, right? And this documents or receivables at a time they will sell to factor, or it gives to factor, and it appoints factor as an agent, and factor is going to collect the money from customer, and again he is going to hand over to whom? Firm. Such an approach is called, what is that? Factoring. Factor may be a person, factor may be an organization, factor may be a company. For example, Andhra Bank may gave loans to 500 crores, but Andhra Bank took the service of whom? Bajaj Finance. So Bajaj Finance might work as a factoring for whom? Andhra Bank. Here the point of highlight is, here is the company. Company made a credit sales, and factor is a person, and company approaches whom? Factor. For what purpose? Number 1, for collection of reasons for taking factoring service. What purpose? Effective collection of book debts and sources of finance. Now here in examination you may be given in 2 ways. Number 1 is evaluation of factoring service. X is a person who came to your office, you want to take, what is it? Factoring service. You have to advise him. So benefits for factoring service you have to calculate. Opportunity cost of factoring you have to calculate. From benefit you deduct which one? Cost. If net benefit is positive, accept, otherwise reject. If company takes factoring service, what are the advantage company is going to get it? Savings of bad debts, savings of collection cost, opportunity cost benefit, contribution benefit. Hello. Thereafter, cost of factoring, factoring cost or fees, contribution loss actually, and interest. You submit up benefits, you submit up cost. From the benefit you deduct net benefit is positive, it is advisable to take, what is it? Factoring service. Now tell me, what is a factoring? Factoring is innovative financial service. It is agreement between 2 parties. Who are they? Why company takes a factoring? 2 points, straight points. Number 1, collection of book debts and as well as source of finance. Okay. Now from this you have one problem. This is new study material problem is there, old study material problem, right? Here factoring agreement to be taken always, what is it? Per annum. Hello. Here one more important point is this. When factor takes money from, when company takes money from factor, both have certain assumptions, or both the people have their own commitments. Here we take an assumption that factor lends loan or receivables not only withholding margin but also commission for concerned days or days. Okay. And factors give loan amount for withholding of interest for concerned days. This is an assumption we used to take. Means factor lends loan on receivables, not only withholding margin but also commission. And factor gives a loan amount withholding interest. Before providing loan, he hold commission. While providing loan amount, he takes interest. This is the assumption. Now you see this is the problem. A factoring firm credit sales of how much? 360 lakhs. And the average collection period is 30 days. The financial controller estimates bad debt losses are around how much? 2% of credit sales. The firm spends how much? 1,40,000 annually on debtors administration. How much? 1,40,000. This cost comprises telephonic, fax bills along with salaries of staff members. These are the avoidable cost. A factoring firm has offered to buy what? Firm's receivables. The factor will charge 1% commission and will pay advance against receivables on interest of 15% per annum after withholding of 10% as a reserve. What should the firm do? Now company makes a credit sales of how much? 360 lakhs. What is the bad debt loss? 2%. Company spends how much? 1,40,000. Right? Now tell me, if company takes a factoring, what is the advantage company is going to face? Whatever the loss, whatever the cost is there, that entire amount it is going to be saved. How much it is going to be saved? Expected benefit. What are they? Savings of bad debts. How much? 360 into 2%. Yes or no? And at the same time, savings of collection cost. Balu sir, that 7,20,000, how do you got? Total sales into, got it now? Next. Another one, what is the cost? Factoring commission, you have to calculate, right? Now you see, commission per annum is 1% on receivables. Kada? 1% on receivables means, first you have to calculate receivables. Receivables means debtors. Hello? Credit sales, 360 lakhs divided by 360 into debtors collection period 30. How much? 30 lakhs. 30 lakhs into commission percent 1% means 30 lakhs into 1% means 30,000. But actually receivables you calculated, it is not per annum, it is for just for 30 days. The 30 days receivables based you calculated 1% means that is a commission for 30 days itself. Now if you want to find it out per annum means 30 days divided by 30 into 360. 3,60,000 is the commission. Next, interest. Interest already I told you how he is going to calculate loan. Loan here he identified that receivables is how much? 30 lakhs. From the receivables, what he told? 10% margin is going to deduct. So 30 lakhs into 10% minus commission for concerned days. How many days? 30 days commission. How much? 30,000 is going to deduct. So loan means 26 lakh 70,000 would be the loan. From that loan he is going to provide what is it? Interest. Interest 26 lakh 70,000 into 15%. How much? 4 lakh 500. So 3 lakh 60,000 is the commission. Then interest is 4 lakh 500. Total 7 lakh 50,000. Now benefit is how much? 8 lakh 60,000. 7 lakh 60,000. How much? This is the factoring point. Okay, maximum toughest problems this is. Okay, so in debtors management also we completed which one? Factoring. Another important point is here it is. What is it? Cash budget. Problematic. What they have chance? Only this, right? Working capital estimation. Then working capital estimation, operating cycle, debtors management. Under the debtors management, receivables, factoring we completed. If it is a miscellaneous means, he may ask what is that working capital financing. Finally, cash budget. What is a cash budget? Cash budget is, cash is a liquid cum emergency asset. All the problems of corporate company directly, indirectly links with. Every company has to prepare a cash budget. Why? Because every company problems are directly, indirectly linked with this problem. If at all any company suffering loss means, I think they are not at all able to handle their cash resources effectively. Are you getting? So to prepare a cash budget, you should understand what is a total receipt and total payments. So cash budget, why we prepare a cash budget? Because better management of cash. Number two, once you prepare a cash budget, you can understand that at which month we may have surplus cash, which month we may have what is it? Shortage. So when shortage may happens, right? Scarcity happens automatically. It supports you take what decision? Financing decision. Once if you have what is that excess amount with you, then you can take what decision? Investment decision. Cash budget serves as a what print? Blueprint in future transaction. It can be done for what is it? Shorter time or long time also. Means month by month, even week by week. Hello? It serves as a blueprint means during the 1 year what will happens if you put it everything on paper. If any month any uncertainty happens, you can handle it. Why? Because you already conceived. The person whom you have to pay will come in future, but if you prepare a cash budget, will come now. Hello? The person whom you are going to pay, actually he will come in future. But once you prepare a cash budget, he will come now. So once you prepare a cash budget means you will have a clear view that what might be happens in future. That is an identity. Recently, Mantana Satyanarayana, while saying one of the example, Mantana Satyanarayana Garatika Party, nothing but he said that write a budget for your life. He said life. At the last moment you are going to, at the time what you want to do. Now itself you have to write. What sir? Why should I write? Live man. Once you put it everything on paper, then only you should understand what life you are going to live. Like a real hero or like a slave or idiot or stupid, whatever it may be. I don't write. Why? Because I will write, I will fear. I will cry. Why? Because once I will put it everything on paper, right? Then we have to put effort. Without any identity, nothing. Are you getting my point? That's cash budget. So, well, now tell me, cash budget is? So, cash budget is the systematic estimation of availability of a cash of the business in a given time frame or period, considering both receipt and right. In cash budget, you should not consider 100% depreciation. So, depreciation should not be considered. And at the same time, any other non-cash expenses all should not be considered. Why? Because cash budget we are preparing means we have to consider only cash, but not non-cash, right? How cash budget to be prepared? You have to understand opening cash balance first. You have to identify. Then identify all the receipts. Then identify all the payments. Submit up all the receipts. Submit up all the payments. From receipts you deduct the payments. And first you have to take opening cash balance, add receipts minus payments, then you will get closing cash balance. Closing cash balance of July will be opening cash balance of August. Opening balance would be September next month, right? This would be the cash budget. Now, first slide, what it indicates. In this slide, I explain what is a cash. Yes or no? What is a cash budget and the significance of cash budget. Then what aspects should not be considered while preparing cash budget. Next, what is the format of cash budget. And this is the one of the problem. MTP November 2018 May. They asked this problem for 8 marks. Same problem is there in your new study material also. Same problem. Okay. But they little bit modified. But now the same problem. Already past exam question paper also it is. New study material. So far they could not ask for exam. Right. Shall we? Hello. Break is up to? Break means only when Balu sir wants to take a break. He wants to take only when he gets absolutely tired. But when students are there, how should I get tired, man? Huh? That is a thing, Those people to attended today's class, these people are not paid. They came for to get clear. వచ్చిన వాళ్ళందరూ ఎవరు పాస్ అవడానికి వచ్చిన వాళ్ళు కాదు ఇక్కడ వచ్చిన వాళ్ళు అందరూ క్లియర్ చేయడానికి 99% you people will clear what is it FM my subject, otherwise I will give you my property. Bring a checks, right? I will write my entire property. Yes, we will take a break after completion of this problem, right? After this we have a maximum permissible bank finance, one concept, concentration banking, logbox system, forgot na? So cash budget is very very important. Past exams, because we have a proofs, right? And another one is double shift historical, man, highly impossible so far, not at all asked. Right, optimum cash management models theory part, that is I will give it, but problematic areas I am speaking, right? Then here you see sales units, February 15, March 16, April 16, May 17, June 18. These are sales units, not sales revenue. Hello, revenue, how do you get it? into selling price, right? Production unit 16,000, 16,000, 17,000, 18,000, 19,000. Direct labor variable overheads incurred 9 lakh 60, 9 lakh 60, 10 lakh 20, 10 lakh 90, 11 lakh 20. Fixed overheads incurred 4 lakh every year 4 lakhs, right? Selling price per unit is how much? 200. How do you get the revenue? Units into selling price, right? Purchasing price per kg of raw material is 50. Each unit of finished product required 2 kgs. 1 unit is how much? 1 kg. 1 unit production you needed 2 kgs. For 1 kg is how much? 50 rupees. It means that for every 1 unit production 100 rupees. Are you getting? Right. 1 unit production 2 kgs. 1 kg is 50 means 2 kgs 100 means 1 unit equal to 100. Raw material and purchased on what basis? Credit. In the month of before they are used in production. Production, suppliers of raw material are paid 1 month after the purchase. It means that purchase, okay. All sales are on what basis? Credit. 80% of customer by sales value pay 1 month after sale and the remainder pays 2 months after the sale. All sales on credit means in February if you make a sales, what happens? March 80%, April 80%, May 20%. Okay. What coming to April? May 20, next 80%. Right, ma? Hello? April means May 80%. June 20%. Next, direct labor, variable overhead and fixed overhead are paid in month of which they are incurred. Machinery costing 20 lakhs will be delivered in May and paid in June. Delivered when? May, but paid in June. Depreciation including that on the new machine is as follows. Machinery and equipment 70,000 per month. Motor per month actually, it is machinery and motor vehicle 16,000 per month. Should we consider this one? No, because depreciation is a non-cash expenses. The opening cash balance at 1st April is estimated to be 3 lakhs. Now prepare cash budget for the each of the 3 months, April, May, June. Now you have to prepare April, May, June. Okay. First, what is the opening cash balance of April? 3 lakhs. Now what are the receipts you are going to get it? That means only collection from debtors. Hello? What are the collection from debtors? February sales 20%, March sales 80%, April sales nil. Okay. So it means that you see here estimation of collection from debtors. February sales, how much ma? February sales 6 lakhs. Actually I am preparing for which month? April, May, June. I took the February sales. 6 lakhs into 20%. 30 lakhs into 20% means 6 lakhs. What about the February sales impact on May? Nil. March. February sales. March sales 80%. Hello? Remaining 20% comes to May. In April, May sales 80% and June it would be 20. It means that finally April you will get what? 31 lakh 60,000, 32 lakhs, 33 lakh 60,000. I took this value here. Okay. 31 lakh 60,000, 32 lakhs, 33 lakh 60,000, right? And now if I make it, this is the total. Total means not opening cash balance. 31 lakh 60, 32 lakh 33. Now payment you have to make, right? Payments to whom should you make? Creditors. For what? Raw material. What the point here indicates? Company purchases on credit in the month of before they are used for production. For example, April I am going to produce. Production is different from purchases. Do you agree? If I want to produce means will I purchase the same day or early? Early. For the sake of April production, I will purchase on March. But the company actually I have to payment also I should make when? March itself. But I will get a credit period of 1 month. So then again payment will comes to April. That means to produce 1 unit, I need 1 kgs, 1 kg, 2 kg. 2 kg, each kg price is 50 rupees. So 50 plus 50, 100. It means that 17,000 units into 100. How much? 17 lakhs in April. May 18 lakhs. June 19 lakhs. This is 17 lakhs, 18 lakhs, 19 lakhs. Thereafter overheads, 2 types. What are they? Fixed overheads, fixed overheads 10 lakh plus 10 lakh 40,000 plus 4 lakh. How much? 14 lakhs. Second, 10 lakh 80,000 minus 4 lakhs. 4 lakh 14 lakh 80,000. Then 11 lakh 20 plus 4 lakh. Right. Okay. Now what I had done is here opening cash balance plus receipt. Balu sir, what about this one, sir? One more machinery you purchased, Machinery costing 20 lakhs will be delivered in May but paid in June. So June you have to consider that one, right? June I considered this one. How much? 20 lakhs. Now what about, sir, you could not consider this one, sir. Which one? Depreciation. Should I consider? No. For machinery, motor vehicle should not be considered. Are you getting? Now if you prepare budget, what happens? So total receipt is 31 lakh 60,000 plus 3 lakhs. 33 lakhs minus payment of how much? 31 lakh 20,000. 3 lakh 40,000. Array, total payments would be 31 lakh 20,000. Receipt is 31 lakh 60,000. Opening cash balance 3 lakhs. 31 lakh 60 plus 3, 31 lakh 20,000. This 3 lakh 40,000 would be opening, right? Plus receipt 32 lakhs minus 32 lakh 80,000. This 2 lakh 60,000 again opening. 2 lakh 60,000 plus 33 lakh 60,000 minus 54 lakh 20,000. This is not negative. Okay. So these are the most important problematic area you can, right? Thereafter you have which one? One more point, right here, optimum cash management models. What is it? This is the completely theory part. Optimum cash management models. There are two models. What is that? Baumol theory, Miller theory. Baumol argument that future annual cash requirement is well known in advance. Future annual cash requirement should be well known in advance. So basing on that advance, if a company holds more cash at office, so it will suffer opportunity cost loss. If it holds less, it has to incur transaction cost. That's why every company has to maintain optimum cash balance. So where optimum cash balance would be, total cost would be very low. So total cost is nothing but transaction cost plus opportunity cost. So he projected that if a company estimates total annual cash requirement, if they keeps the total cash at office, right, more cash at office and less in marketable securities, it suffers an opportunity cost loss. If keeps less at office and remaining at marketable securities, it has to incur transaction cost. Where he projected, how do you calculate transaction cost? So transaction cost equal to number of transactions into cost per transaction. Number of transaction, how do you find it out? Annual cash requirement, this is a requirement, divided by what you want to hold it. Okay, so annual cash requirement divided by economic lot size, what you want to hold it, that defines number of transaction. Number of transactions into cost per transaction, you will get what? Transaction cost. Hello? Whereas opportunity cost means how much cash you supposed to hold at office. Okay, this is the cost. But from this cash you have to take only 50%. Why? Because you are going to use this amount. Hello? How much amount you hold at office is called economic lot size. From the economic lot size, you have to take how much percentage? 50%. On that 50%, you have to calculate opportunity cost. So total cost equal to transaction cost plus opportunity cost. So at which cash balance your total cost would be low, that would be called, what is that? Optimum cash balance. Okay. If you hold more, what happens? Opportunity cost increases, transaction cost decreases, total cost increases. Okay. If you hold less, transaction cost increases, opportunity cost decreases, total cost increases. Transaction cost equal to number of transactions into cost per transaction. Number of transaction equal to annual cash requirement divided by economic lot size. Opportunity cost rate equal to average cash balance into opportunity cost rate. Average cash balance equal to economic lot size into 50%. Total cost equal to opportunity cost plus transaction cost. Finally, this amount, in order to find it out, there is a optimum cash balance model theory formula. right? That is the square root of 2ft divided by r, where f indicates future annual cash requirement, T represents transaction cost, R represents rate of interest. Okay, this is the theory part. Frequently they used to ask the theory part. Coming to another one is, what is it? Miller theory. Miller theory argues that Baumol theory is not practically possible. Why? Because no business can run with the exactly cash balance. So every company has to maintain cash levels. Hello, where business has to maintain 3 levels. When business commences, it must have what cash balance means? Minimum level cash balance. Hello, minimum level. When company do business transaction, cash balances increases at one point of it touches, what is it? Highest level. When highest level it touches, then company has to sense that high cash balance is there. In order to reduce, it has to make investment on marketable securities. Okay, how much it has to invest means so that the cash balance should reduce to return level. Once the cash balance decreases and touches minimum level means it has to sell the securities and it has get the cash balance back. Hello, so that is called a return level. If highest level not touching and the lowest level also not covering means, then you better to hold the cash balance. Similar to, it works as a circulator, like to protect electricals we used to keep the stabilizer. Hello, whereas even from in patients, okay, patients also oxygen counting will takes place. If it is moves like this means one fine day, that's enough. So stabilizing would be needed, right? Now tell me, Baumol theory, Miller theory. Very simple. Sir, Baumol theory arguments that future annual cash requirement well known. What about Miller theory? Future annual cash requirement never be known, right? There he said 3 costs. What are the 3 costs? Opportunity cost, transaction cost. Miller also 3 levels. What levels? Minimum level, return level, highest level. There they projected optimum cash balance. 3 levels. 3 levels ho gaya man. Optimum transfer, cube root of 2ft divided by r. Whereas here cube root of 3tv divided by 4i. You have to find it out z. Cube root of 3tv divided by 4i. Here highest level 3z plus l. Return level z plus l. Hello, what Maji? Highest level here upper limit equal to 3z plus l. Return level equal to z plus l. Optimum transfer cash balance equal to cube root of 3tv divided by 4i. So a company has to maintain cash balance when it touches what level? Highest level. Highest level equal to 3z plus l. It has to invest in marketable securities. It has to come return level. Again, when it touches minimum level, it has to sell the securities and it has to identify it. Okay, this is the Baumol theory, Miller theory. Thereafter you have localized collection system, very classic system, particularly in the time period of what is it? 1956 around, when there is no private systems, means electrical transfer of money, UPI payment system and a private courier system. At the time, how the people used to collect the money, once they used to make a credit sales, a Guntur man made a credit sales to Delhi means in order to receive checks from there, how many days it may take? 5 days. If the checks in postal because of delay happens, that is called what is it? Mailing. When checks come to Guntur, the head office may send for the cashier for what? Processing. There here it may takes what is it? 3 more days. And thereafter this check would be sent to bank for collection 2 more days. So finally if the client pays in time, in order to encash, it will take how many days? 10 days. 5 plus 3, 8 plus 2, 10 days. 1 day opportunity cost 20% means, try to understand, 10 lakhs into 20% into 10 divided by 360 into 10 days. 20% is the opportunity cost ma. Up to 10 lakhs into 20% per annum divided by 360 per year into 10, 5,000. Like that 5,000 members are there in Delhi. In such a case, into 5,000, 2 crores. This is the loss for paying in time. Hello, bad debts is a second story. If the customer pays in time, this is our loss. So in order to overcome this one, we have 2 alternatives. One is concentration banking, another one is lockbox system. What is a concentration banking? Opening a bank account where our customers are widely spread out. Hello, and passing this bank details to whom? Customer. And guiding or instructing customer that to drop checks in the concerned bank itself. And we after that we will go to the bank and we will take a concentration banking agreement. What is that? Concentration banking agreement. According to this concentration banking agreement would be taken for 1 year. We will request the bank that you do the bank transaction, but first give priority to us because special darshanam like that. Okay, first you have to take care of us, then you can take the regular bank transaction. For that purpose, per year I will pay this much of cost. Okay, so that would be on identity. And here why we have to take this concentration banking means because we are going to save various times of delays. What are the delays here? Mailing float, processing float, and banking float. So in order to overcome the opportunity cost loss, we used to take what is that? Concentration banking. So examiner may ask you that really what is a concentration? 99% this is the theory part only. Problematic they could not ask. Theory. What is a concentration banking? That too 2 marks question. What is a concentration banking? Opening bank account where our customers are widely spread out and passing these bank details to whom? Customers. Okay. And we take agreement with whom? Bank. Okay. That is a concentration banking. Another one is what is that? Lockbox system. Lockbox system means we go to the nearest post office where our customers are widely spread out and we will take the rent of post box, the post box number 1562 something, and we pass this post box details to whom? Customer, and we will request them to drop the checks into post box. And any of the customer may collect the checks and in a day, twice in a day, they may give to the concerned bank. But here also we have a bank agreement. Here also we have bank account. There also we have a bank account. But in concentration banking, we take agreement with whom? Bank. But here, post office. This is the post office. But what is the benefit, sir? We will estimate that how much rent we supposed to pay for taking lockbox. But how many days we are going to save? What is the collections per day? What is the opportunity cost per annum? So A, reduction of load. How many days you are saying? B, what is the collection per day? 3, opportunity cost. A into B into C. You will get the net benefit. From the net benefit, you deduct the cost to be paid. If net benefit is positive, accept. Otherwise, reject. So maximum, morning I showed a question paper. From the question, last question, 2 marks question, you can expect this one. And where is another important point is last concept. Which one? Maximum permissible bank finance. After maximum permissible bank finance, this is recommended by which committee? Tandon committee. Tandon committee recommended maximum permissible bank finance in order to provide whether loan to be provided for working capital or not. But this contradiction, in order to solve, Reserve Bank of India appointed a committee. That committee is called what? Tandon committee. Okay. This Tandon committee gave 3 recommendations. What is that? Method 1, 75% of current assets minus current liability. Current ratio would be 1:1. Method 2, 75% of current assets minus current liability. 1.33:1. Method 3, 75% of current assets minus core current assets. So 1 minus current liability. 1.75:1. So this is the methods they projected. Standard current ratio. But while calculating this standard current ratio, you should not consider which one? Bank loan as a current liability, because you are calculating bank loan. One more point is, what is the core current assets? It is the core current assets means the proportionate value of individual current assets where bank should not provide any loan. Okay. For that assets, you must raise. Who? Company has to raise it from his own pocket. Okay. That is the core current assets. One more point, working capital term loan. 3 words you keep it in mind. One is core current assets. Number 2 is working capital term loan. Working capital term loan means excess amount withdrawn by the company comparing to maximum permissible bank finance. How much maximum permissible bank finance to be provided if the company investor already taken excess amount? That excess amount is called, what is that? Working capital term loan, where customer has to pay within the year itself. That is the working capital term loan. 3 points while calculating. Number 1, current bank loan never be considered as current liability. Point number 1. Number 2, core current assets. No loan to be provided, core current assets that would be financed by company itself. And number 3, do you know the standard current ratio? 1:1, 1.33:1. Who appointed this committee? For what purpose? Who appointed committee? RBI. Who operated this committee? Tandon. What is the purpose of this committee? Whether to provide working capital loan or not. These are the major areas for working capital estimation, Maji. Once you take a break and thereafter we will take a dividend or risk, any of the points, no problem. We may go with what is that? Okay, take break. Exactly 15 minutes, I will be back. Maximum so far chapters is there, that would be 5 marks areas. Risk as well as dividend to be discussed. Risk in investment decision or capital budgeting. Okay, maximum 5 marks question you can expect from this model. Right. First of all, while discussing capital budgeting techniques, we took an assumption that we blindly calculate NPV. But we took the cash flows and basing on that we estimated NPV. We believe that there is no any risk. But the thing is, it's false statement. Every project has its own risk element, right? Whatever the cash flow you will expect, right? The same cash flow may not happen in future. Exactly. It undergo risk. So being a financial manager, you should also understand the risk element, and basing on risk element, you have to compute NPV. Here the point is, every financial manager takes a project in 3 ways. One is believing that first direction, it goes Arangalpet side. That is called decision making under what is it? Certainty. Another direction, go to Chilkalpet side. It indicates what is it? Decision making involving risk. And another one is what is it? Under it says a Bradipet, under uncertainty. So decision making under certainty. So if you say that whatever I am saying, everything is going to happen, means nobody will believe it. Hello? That is certain. But for example, X is a client who came to your office and he want to evaluate the project. He projected cash inflow, cash outflow. But you calculated NPV. NPV is positive. But immediately asked, sir, you calculated NPV. Okay. But the cash inflow, cash outflow might be different, sir. Why? Because E is not equal to E. What is it? E is not equal to E. Means evaluation time is different from project execution time. In meanwhile, in such a situation, the cash flow might changes. So, but if the client says, no, it is a certain, means nobody will believe you. If he says that, no, I don't know, means nobody will come to you. But if you calculate, what is it? If you measure the risk, then people will come. How this risk to be measured, right? Here you understand the cash flows of the project, or any financial manager while taking a decision, he will consider cash flow may happen in 3 ways. What is it? Certain, uncertain, another one is risk. What is the difference between risk and uncertainty? 2 marks question. Risk and uncertainty means what you actually identified, what you expected. That is the difference, is nothing but what? Risk. For actually I identified 5 lakhs, I got it at 5 marks. For example, weekend exam, you are writing exam. Out of 20 marks, you expected 15 marks. But you got it 14 marks, no risk. Why? Because you expected 14, you got it. So you expected 15, you got a 14. You are there only. But you expected 15, you got it 2.5. You are somewhere. Such a situation is called, what is it? Risk. What actual, what is expected, that difference would be, what is it? Risk and uncertainty. Frankly speaking, risk is what is it? Measurable, but risk is measurable uncertainty, whereas uncertainty is unmeasurable risk. Are you getting? So that is the point. Got it? 2 marks question, you may get it. Why a project might go with the different types of risk? 4 marks question, they've been asked this question, this point. What is that? What are the various sources of risk? What is that? Project specific risk. Here, first come to here. Competition risk. Geo is a best example. Market risk. Corona pandemic situation. Collapsation of Revlon is the one best example where you are unable to sell your product. Right? And risk due to economic conditions. Because of economic condition, not only economic, political, all the factors condition, sometimes you cannot. For example, Corona pandemic, after Corona pandemic, what is that? Certain commodities sales they lost, particularly cosmetic is one example. And at the same time, poor people usage commodity demand also increased. So here economic condition means because of economic conditions may be better, may be worst. Anything may happen. Because of that, certain commodities value may increase, certain commodities or certain companies income may decrease. That is risk due to economic condition. Next, industry specific risk, OTT versus film theaters. Because of OTT today, film theaters getting lost, right? That is a industry specific risk. International risk. International risk indicates, for example, because of China and India, TikTok was banned. What the crime TikTok done? Nothing. But because India-China relationship is not good, that is the reason TikTok was banned. So this is what risk? International risk. And company specific risk. Sometimes company may do several projects, but one project may get failed. If only specific project fails, that is called, what is it? Project risk. Company risk. For example, you see, recently in Haryana, I told you that cough syrup, which was consumed by African kids, they died more than 125 members. But that product, that cough syrup consumed by African kids, but produced by one of the company. But that company produces several products. But several products are very good. But only fail is what? Cough syrup. But in international platform, they banned what? Entire company. But sir, actually cough syrup means shut up. They said shut up. That's enough. So it means that company specific risk, project risk, these are the several risks. They may ask for theory point of view. Are you getting my point? So this is, another one is how to measure this risk. There is a different types of techniques. One is the statistical techniques. And in statistical you have probability, variance and standard deviation, coefficients of variance. Conventional technique you have risk adjusted discounting rate, certainty equivalent and sensitivity analysis, scenario analysis, simulation, even decision tree analysis. Probability, what you have to understand? Probability, it indicates a chance of occurring an event. Hello? Chance of occurring an event. So probability summation would be 1. Okay, probability summation would be 1. For example, probability is 0.80. It indicates that there is a chance to generate that particular event at 80%. For example, you are expecting 1 lakh. The probability is 80 means what is it? Only 80% chances may generate. So probability, by considering probability, you can mitigate the risk. Simple. How, sir? Because cash flows are there, expected cash flows. Cash flow involves risk. But when cash flows are multiplied with the probability, you will get what? Expected cash flow. When you take a decision basing on expected cash flows, the risk element of the project could be mitigated. For this purpose, they used to give a first problem. Here it is the best guess 3 lakhs, probability is 0.30. High guess 2 lakhs, probability is 0.60. Low guess 1,20,000, probability is 0.1. Now, how much the cash inflow will they get it? Will they get 3 lakhs, 2 lakhs, 1,20,000? No. No 3 lakhs, no 2 lakhs, no 1,20,000. What do you have to do? 3 lakhs into 0.30 plus 2 lakhs into 0.60 plus 1,20,000 into 0.10. It means total? Yes, like this. Best guess 3 lakhs into 0.30, 90,000. High guess 2 lakhs into 0.60, 1,20,000. Low guess 1,20,000 into 0.10, 12. So total expected cash flow would be 2,22,000. Got it? If you take decision basing on this 2,20,000, your risk should be mitigated. Okay? This is the expected cash flow. Cash flows includes risk. Expected cash flow won't include risk because we mitigate the risk, right? So basing on this NPV, expected cash flow, we used to calculate, what is that? NPV. That NPV is called expected NPV. Comparing to NPV, expected NPV is the very, very important topic. What is expected NPV? So it is the NPV which is estimated from expected cash flow. How do you get expected cash flow? Cash flow into probability. This NPV consider risk impact of the project. How do we calculate expected cash flow? First, simple. What you do is take cash flow, multiply with the probability, then you will get the expected cash flow. By discounting that cash flow at a cost of capital, you will get the present values. Hello? From present value of cash inflow minus present value of cash outflow, if you do, you will get, what is it? Expected NPV. If expected NPV positive, accept the project. Otherwise, reject the project. Are you getting? So which NPV is best one? NPV or expected NPV? Expected NPV. Got the point? Expected NPV formula? PV of expected cash inflow minus PV of expected cash outflow. Can you able to solve this problem? New study material they have given. So this possible net cash flow of project A and B is like this, and the probability are given below. Discount rate 10% for the both the project. Initial investment is 10,000. Calculate expected net present value. Which of the project? What should we do? Possible event project A, B, C, D, E. Cash flows 8,000, 10,000, 12,000, 14,000, 6,000. Probabilities are given, right? Between these two projects, which project would be the worthable? You have to find it out. Basing on what NPV? Expected NPV. Tell me what is your task now? Sir, first you have to find it out expected cash flow, sir. How do you do? Cash flows into probability, and that cash flow into probability, if you multiply, you will get the expected cash flow. By taking that expected cash inflow, if you calculate NPV, then such a NPV is called expected NPV. Let us take here, you check it here. For project A, I calculated here project B. First possible events, what is it? A, B, C, D, E. Here project A cash flow, okay? 8,000, 10,000, 12,000, 14,000, 16,000. Probability, is it right the probability? 0.10, 0.20, 0.40, 0.2, 0.1. Check, take calculator and multiply and find it at 8,000 into 0.10. Second one. Third one. Fifth one. 2,000. Next. 1,600. In total, 1,200. So this is expected cash inflow, right? This expected cash inflow, there is no any specification when they are going to generate. We will take an assumption that it is happen in a year. Hello? But at the end of first year, only 1 year cash inflow we got it. These are not, this means a company has a chances to generate the cash inflow at the end of the year from different events. Hello? Right. Coming to project B, check it this one. 24,000 0.10, 2,400, 20,000 0.5, 3,000, 16,000 into 0.50, 8,000, 12,000 into 0.10, 1,800, and 8,000 into 0.10. Now total 16,000. 16,000. Now what we do is you have to calculate expected NPV. Expected NPV equal to PV of expected cash inflow minus PV of expected cash outflow. Project A, expected NPV equal to 12,000 into present value factor 10% 1 minus 10,000. 12,000 into 0.909 minus 10,000. Check it. Expect project B, expected NPV 16,000 into present value factor 10% 1 year minus 10,000. 4,544. Now tell me which project should be accepted. Sir, if the given projects are mutually exclusive, better to take excellent project, that is project B. If mutually independent, both the projects should be accepted, right? How do you calculate expected cash flows? Cash flows into probability. What is the formula of expected NPV? Yeah, what is the difference between NPV and expected NPV? Risk. How do you mitigate that risk? By taking probability. What is the probability? Chance of occurring an event. Summation of probability distribution is 1. Okay? Right. Got it, ma? Maximum 5 marks question we can expect from this model. And the next one is risk adjusted discounting rate. So this technique is similar to what is that CAPM approach, where profit is reward of risk taking, where investor takes what is it? More risk, more return from high risky project. So risk adjusted discount rate indicates, already we discussed this project. You see, from Baradipeta SBI Bank amount by taking, if you do business in Sahara Desert here in this building, could you expect a 10%? More than 10%. More than 10%. In Iceland, if you want to do this project, while taking Baradipeta and going to Gannavaram, Gondwara to Antarctica, and thereafter to this building, you are going to do business here, means will you expect 10%? More than 10%. More than 10%. Why? Because I am taking risk, man. Hello? So, in risk estimates that I will expect two things. What is that? Without risk, how much I will generate? That is called risk-free rate. For risk-free rate plus risk premium. That risk premium can be identified in two things. Either beta or coefficients of variance. Coefficients of variance means for every 1 rupee expectations, how much difference may happen is called, what is that? Coefficients of variance. Suppose coefficients of variance is 5. 5 means, what do you mean of 5? If you expect 1 rupee, you are lucky man. Why sir? 1 rupee plus 5, you may get what? 6 rupees. Okay. This is one side. Another side. If you expect 1 rupee minus 5, how much? 4 may accept. So coefficients of variance increases, risk element also increases. Another one, beta increases, risk also increases. Basing on the beta or coefficients of risk identity, we can observe what is that? Risk premium. This project speaks that investor expect what? Risk-free rate plus risk premium, because he takes a risk. If the cost of capital 10%, that is the rate of interest to be paid for the bank. But by taking this much of risk, will you evaluate the project just by taking 10%? No, you have to take more. That means for 10% you have to add your risk premium. Basing on that, you have to evaluate the project. So that is called, what is that? Risk adjusted discounting rate. Right. So there is a model in this problem. Can you able to solve this one? This is a CA final problem. Old practice manual is there. But this problem is old practice. But CA final also he gave it. Similar problem covers in our material also. But risk index. Now you see. DLF is evaluating new project X. The following information is available. Cost is 15 lakhs. Year 1, year 2, year 3, year 4. Cash inflow should be like this. 6 lakhs, 6 lakhs, 6 lakhs, 6 lakhs. Risk index. Beta is 1.3. Beta is 1.3 means you have to compute. KE you have to risk adjusted discount rate you have to calculate. Minimum required rate of return is how much? 15%. Applicable tax rate is 40%. Risk free rate interest is 10%. Now risk adjusted discount rate you have to calculate. Risk adjusted discount rate equal to risk free rate how much? 10% plus risk premium. That risk premium depends upon beta is how much? 1.8. Then how do you calculate? RF, that is 0.10 plus 1.80 into 15% minus 10% means 0.15 minus 0.10 into 1.80. 19%. Sure? Here you see. Risk free index how much? 1.8. Risk free rate 10%. Minimum required rate of return 15%. According to CAPM approach, KE equal to R risk adjusted discount rate. RF plus beta into RM minus RF. So 0.10 plus 1.8 into 0.15 minus 0.10 into 100. That is how much percentage? 19%. So risk adjusted discount rate is 19%. Now what we do? Should we take a project evaluation 10% or 19%? 19%. So what this method says that if the project gives a positive NPV at what rate? 19%, project should be accepted. Otherwise, no. Now we calculate NPV. Estimation of NPV basing on what? Risk adjusted discount rate. Investor made investment 0 period 15 lakhs. Present value factor would be 1, right? 15 lakhs. 1 to 4 years since same cash inflow will get it. You have to take present value factor, present value annuity factor. Annuity factor, what rate? 19%. How many years? 4 years. The factor value 2.639. So 6 lakhs into 2.639 equal to 15 lakhs 83,400. Now cash inflow minus cash outflow. 83,400. Are you getting? So this is risk adjusted discounting rate. Risk adjusted discount rate is combination of two things. What are they? Risk free rate plus risk premium. As risk increases, risk adjusted rate increases, sir, risk premium increases, sir. As risk increases, risk adjusted discount rate increases, sir, risk premium increases, sir. Sir, question don't have clarity. As risk premium increases, risk adjusted discount rate increases because risk premium increases. Okay? But what about risk free rate? Dani kuda increase chesi saripodiga? No, sir. Risk free rate will remain same only, but risk adjusted discount rate increases. Because profit is reward of risk taking. That is a classic dialogue. But high profit is reward of high risk taking. Okay? Because you people today from morning to till to the time you've been spending means you are taking risk. You deserve what is it? Reward. Certainly you will get it. Okay? Then certainly you will get it. What cash inflow? Certain cash inflow. The next technique is nothing but what NPV? Certainty NPV. Sir, expected NPV already discussed, sir. Already so far NPV finished. Expected NPV finished. Now what NPV? Certainty NPV. Certainty NPV means what? This is the NPV computed on certain cash inflow. What is that? Where investor could not like, what is that? Actually, normally, basically, that Kathakali could not accept, sir. You tell me what is it? Exactly. So, because some investor, they used to make crores of rupees. So, when you invest crores of rupees, if you say actually means it does not accept. Sir, probably shut up. Okay, they will send you out. You have to tell what is it? Exactly. Such a cash inflows are what? Certain cash inflow. So, certain cash inflow based, if you estimate NPV, such a NPV is called what is that? Certain. What is a certain CE factor? Sir, it is the one of the method of estimation of NPV where the corporate company calculates certain cash inflow. How do you get certain cash inflow? By multiplying uncertain cash inflow with what is certain equivalent factor. How do you calculate certain equivalent factor? Means certain cash inflow divided by risky or expected cash flow. If you want to expect this certain cash inflow here, this should be cross multiplied, right? So risky expected cash flow into CE factor, then you will get what? Certain cash inflow. By bringing this present value of certain cash inflow, deducting cash outflow, then you will get it. What is it? Certain. So certainty NPV equal to PV of certain cash inflow minus PV of certain cash inflow. Certain cash outflow. Here, sir, certainty cash inflow CE factor is there. This CE factor moves 0 to 1, but it never crosses more than 1. Why, sir? If you expect 1 rupee to be expected, hardly how much you will expect? 1 rupee you will get it. Sometimes you may not get 1 rupee also. So you never get more than 1 rupee. That is a bias situation. It could not possible. So CE factor summation lies 0 to 1. Probability distribution summation lies 1 only there. Hello? That is a total 1. Here it is a 0 to 1. It never be more than 1. So CE factor formula, certain cash inflow divided by, right? How do you calculate certain cash inflow then? Uncertain cash inflow into CE factor. CE factor frequency lies in between 0 to 1. So what do we do? How do you calculate certain NPV? Sir, take certain cash inflow, not take uncertain cash inflow, multiply with what? Certain cash inflow, sorry, CE factor, then you will get a certain cash inflow. Basing on certain cash inflow, you can take present value. Okay. So basing on that value, if you compute NPV, such a NPV called certain NPV, right? Certain NPV may be very, very low. No problem. You should accept. I told you that Puri, Mr. Murthy went to Subbarao, went to hotel, very thin man, but he saw this much of Puri. Oh my God, my stomach is thin. How should I eat that much of Puri? Are idiot? That is uncertain cash inflow. When it comes to, you will find certain. Once you put it what? Hand, right? Then, okay? That is. And even mummy also uses frequently risk adjusted discount rate, certainty equivalent approach. What? While preparing curry. What is mummy? This is the curry. Arey, kitna tha re? Utna tha. Jab cook kiya, itna ho gaya. They used to say, Antunindra vandite anta indi. Inta indi. Vandaku mundu uncertain cash inflow. Vandin tarvata certain cash flow. Mummy, you know, CE factor. You can compute NPV అని అడుగు. ఏదో పోసి ఏదో అగ్గిపుల్ గీసి పెట్టింది. Okay. That is a certainty equivalent factor, right? This is, now can we calculate this problem? This problem RTP November 2018 model. Hello? 2018. And because recent concepts already we discussed in classroom. That is the reason I could not touch. Why? Because we know that you people come again. So if the same problem again means you won't feel happy, even I don't feel excitement. That is the reason I went and I collected the old one. And however it is there, already you practicing, whenever you want to check this video, it means that you will get another chance to solve one more problem. Okay, that is the point. So Gaurav Limited using certainty equivalent approach in the evaluation risky proposals, the following information regarding new project as follows. Year 0, 4 lakh, 1, 2, 3, 4, 5. 3 lakh 20, 2 lakh 80, 2 lakh 60, 2 lakh 40, 1 lakh 60. Certainty equivalent factors here is given. Now tell me, in first year, CE factor 0.80. What do you mean of this? For first year, every 1 rupee you are going to get it 80%. That means 3 lakh 20,000. Yeah, like that. Second, 0.7. Third, 60 into 0.6. 0.240 into 0.40. 0.1 lakh 60 into 0.30. 48,000. By taking that cash inflow, if you estimate an NPV, that is called, what is that? Certainty NPV. Highly important point. While evaluating certainty NPV, you should always take risk-free rate. You should not take risk-adjusted discount rate. Why? Because already you mitigated risk, right? Once again, if you take risk-adjusted rate, then it will gives you double impact. Okay, ma? So now you see it here. Estimation of NPV basing on certainty equivalent factor approach. Here 0, 1, 2, 3, 4, 5. Cash flows 4 lakhs, 3 lakh 20, 2 lakh 80, 2 lakh 60, 2 lakh 40, 1 lakh 60. CE factors. Now while multiplying, just calculate immediately. 4 lakhs, 3 lakh 20 into 0.80. 56. 2 lakh 80 into 0.70. 1 lakh 96 or 56? It's wrong? 1 lakh 96. Okay. 2 lakh 60 into 0.60. 56. 2 lakh 40 into 0.40. 96. 1 lakh 60 into 0.30. 48,000. Right? Whereas PV factor is given how much? 6%. 6%. 1. 0.943. 82. 0.890. 0.840. 0.792. 0.747. Present value would be here check it, 2,56,000 into 0.943. 74,440. Yeah? Third year 1,31,040. Next fourth year 76 or 36? 76,032. Next fifth year NPV, PV of cash inflow minus PV of cash outflow. How much? Right. Since NPV positive in certain cash inflow, this project should be accepted. Okay. This is what is the difference between expected NPV, certainty NPV. Sir, there we used to take a probable cash inflow. Here we will take a certain cash inflow. Difference between that and this? That is, which is a, even though we evaluate risk, which is the purest risk one? Risk-free one. Certainty is the purest risk-free one, whereas which one? The expected might be, what is that? Risk-oriented. Right. And since NPV basing on certain cash inflow is opposite, is positive, not positive actually. So it is beneficial to select the project. Next one, what is it? Sensitivity analysis. Why I took this image? Touch me not leaf. Which one? Touch me not leaf. Too much of sensitive. If you touch one leaf, right, remaining, this see, this is a sensitivity analysis. Sensitivity analysis indicates NPV. Here it is the sensitivity analysis. Next concept. Maximum among this given task, sensitivity analysis is highly sensible. What the factor is a sensitivity analysis? NPV is sophisticated productive technique, no doubt at all. But the point is this NPV depends upon several factors. So E is not equal to E. What is it? Is not equal to evaluation time, means execution time. In such a case, these factors may change because of so far factors, risk element factors we calculated, right? So now by which factor can make which change in how much percentage given factor change may makes NPV 0, or else if the given factors changes this much, what would be the impact on NPV? So investor may come to your office, he may ask it different way. Now coming to sensitivity analysis. Sensitivity analysis, what we are going to identify. First, what is the sensitivity? Outcome. What is the outcome? For sensitivity is outcome for an event or an incident. That is called sensitivity. In sensitivity analysis, what we do is we will compute NPV. Hello? In order to compute NPV, we have to consider several factors. What are they? Sales price, variable cost, fixed cost, financing cost, terminal cash inflow, life, tax rate, investment, depreciation. All the factors directly, indirectly determines NPV. But in sensitivity analysis, what percentage of change in given factor makes what is it? NPV 0. We are going to find it out, that one. And which factor small change also makes NPV 0 means we will identify that NPV is so sensitive to concern factor. By hedging that factor, one can control risk of the project. Hello? Then another one is, if the given factor changes this much, then how much NPV changes? We can also calculate in that way. One way is, if the given factor changes this much, how much NPV changes? Okay? Another one is, if the given factor changes, how much percentage given factor has to change so that it can make NPV 0. You can calculate any of the way. Are you getting my point, ma? So that is the important point of sensitivity analysis. Generally in sensitivity analysis, we will calculate NPV, PV of cash inflow minus PV of cash outflow. But NPV should be positive, where NPV equal to sales units, selling price minus variable cost minus fixed cost. Actually present value annuity factor, if it is a multiple. Single means present value factor minus PV of cash outflow, means directly NPV depends upon 1, number 2, number 3, number 4, number 5 and 6, rate and N. Yes or no? And number 7, investment. So these many factors depends upon this one. We have to find it out which factor is so sensitive to NPV. By controlling that factor, one can hedge the risk. That is, what is that? Sensitivity analysis. Got it? So that would be the observation of sensitivity analysis. Now you see, this is the problem, new study material problem this is. In this problem, X Limited considering its new product with the following details. Initial project cost, how much? 400. Annual unit sales, 5 crores. Selling price per unit, 100. Variable cost per unit, 50. Fixed cost per year is 50 crores. Discount rate is 6%. Calculate NPV. If you want to find it out NPV, what? It is easy only. Now the question is, find the impact on project NPV of 2.5% of adverse variance in each variable. Each and every factor changes adversely. So which variable is having, what is it? Maximum effect. Hello? Now here you see, first we will calculate NPV. Here annual unit sales, how much? Next from this, what do you do? Here it is. Estimation of NPV. NPV equal to PV of cash inflow minus PV of cash outflow. NPV, sales units into selling price minus variable cost minus fixed cost into present value of annuity factor R percentage n number of years minus PV of cash outflow. NPV, 5 crore sales. Yes or no? This is a units. Into selling price, how much? 100 minus variable cost 50. So 50, if you multiply 5 crores and minus what is this? 50 into present value of annuity factor 6% 3 years means 2.637. If you multiply minus 400 crores, if you deduct 134.6. NPV positive or negative? Positive. Now we are not at all used probability. We are not at all used expected. Yes or no? But our approach is, we will believe that cash flows are remain same only, but in the cash inflow estimation, one of the factor might be so sensitive. Which factor that would be, we have to find it out. Now NPV is 134. Now here the point is, if the, what is the question is given? If the adverse impact of each factor by how much percentage? 2.5. Now investment is there. Present investment is how much? 400. If the concern investment should give adverse impact means investment value increase or decrease? Increase. Increase means 400 into 1 or 2.5%. How much? 410. In such a case NPV. So 5 crores into 100 minus 50 crores into present value of annuity factor. Up to here same only. But this time investment increases to 410. Are you getting? Now 534.60 minus 410 equal to 124.60. Now try to understand. Previously NPV how much? 134.60. Now how much NPV is how much? 124. Why it is decreased? Because investment increased. Now you can make analysis. Previously NPV is 134.4. Now it is 124.60. So how much percentage it changed means 7.43%. Increased or decreased? Decreased. Yes or no? Now, what is the observation? Client, you can call the client and you may say, sir, by chance 2.5% investment increases means our NPV decreases by how much? 7.43%. Okay, then immediately we'll ask one more. Which one? Selling price. Selling price increase or decrease? Decrease. Now, present selling price is how much? 100. Now 2.5% decreases means? Now you see 5 crores. Here 97.5 minus 50. If you 5 minus 50 into annuity factor 2.6373, 673 minus 400. How much you will get it? NPV 101. Now if percentage of change, previous one, now current divided by base years, that is 24.82%. What do you mean of this? If selling price, if the selling price decreases by 2.5%, NPV changes by how much? 24.82%. Now tell me, between these two factors, which is so sensitive? Now, being a manager, which factor you should give attention? Selling price. Sir, this is also created attention, sir. Array, that created 7.43, but whereas here it is 24.81. You have to maintain only this. Hello? Fair and Lovely is important. More than ointment. Hello? తెగిపోయింది అక్కడ బ్లడ్ పోతుంది, కలర్ రావాలంటే కలర్ పోతుంది అక్కడ. కాబట్టి విచ్ ఈజ్ ఇంపార్టెంట్? ఆయింట్మెంట్ ఈజ్ ఇంపార్టెంట్. సార్, ఫేర్ అండ్ లవ్లీ ఆల్సో ఇంపార్టెంట్. అఫ్ కోర్స్ మ్యాన్, ఫేర్ అండ్ లవ్లీ ఆల్సో ఇంపార్టెంట్. బిఫోర్ దట్ విచ్ ఈజ్ ఇంపార్టెంట్? ఆయింట్మెంట్, because they go blood jar over there, right? That is. Here another one is, what is that? Variable cost. Variable cost increase or decrease? Increase. Present variable cost 50. Proposed variable cost 51.25. Now you see. So 5 crores 100 minus this time 51.25 minus 50 crores into present value of annuity factor 400. I got the NPV 117.89. What is the percentage of change? 12.41%. Hello ma? Now what is impact? If variable cost increases by how much? 2.5%. NPV decreases 12.41%. Similar to fixed cost. I calculated fixed cost would be 2.48%. I got it. Similar to, with this 5 factors I find it. Fixed cost. If fixed cost increases 2.5%, NPV changes by, whereas variable cost increases 2.5%, 12.41%. Sales units decreases by 2.5%, 12.41. What about selling price? 24.82. Now tell me, the client is there in front of you. What advice you can give it? Sir, you pay attention to only selling price. If you pay attention to selling price, right, your project risk can be hedged. Sir, remaining factors is okay, but this is most sensitive. So this is the way to evaluate the project. What the ma? Okay, clear? Sir, one small doubt, sir. Sir, some factor you said increased, some factor decreased. What is this, sir? It is not adjustable, sir. ఇది చాలా తప్పు చేస్తున్నారు సార్ మీరు. ఇంక్రీజ్ చేస్తే అన్నిటిని ఇంక్రీజ్ చేయాలి, డిక్రీజ్ చేస్తే అన్నిటిని డిక్రీజ్ చేయాలి. అప్పుడు ఏం చేయాలి? మెట్లు మీద తోసేయాలి. అవునా? వాట్ దే ఐడెంటిఫైడ్, he has to give, what is that? Adverse impact. So for adverse impact, some facts may increase, some factor may decrease. Okay? And I got this question from one of the great person, but I conveyed that their question is not increase. They asked us, what is that? Adversely. You read the question once again. You are reading, sometimes you are missing some core information, right? That is, got the point? This is the so sensitive identity, right ma? And next one is sensitivity NPV also we completed. Then another one is you have scenario analysis. You see how many scenarios are there, what to do తెలియదు, ఏం తినాలో కూడా తెలియదు. బఫే సిస్టమ్ పెట్టారనుకో, అవునా, బిల్ ఏమో 1000, ఐటమ్స్ ఏమో 1000 ఐటమ్స్. వాట్ ఈస్ దట్? వన్ యూ పే 1000 rupees, ఇఫ్ యూ గో దేర్ మీన్స్ టోటల్ ఐటమ్స్. ఎంజాయ్ బాలసుబ్రహ్మణ్యం మీన్స్ ఇన్ దట్ కేస్ రియల్లీ రియల్లీ వెరీ సాడ్. వాట్ హ్యాపెన్? తింటే కడుపు నిండిపోద్దామని బాధ. తింటే కడుపు నిండిపోయింది అనుకో, ద నెక్స్ట్ బెస్ట్ ఆల్టర్నేటివ్కి యూ కెనాట్ డూ, వాట్ ఇస్ దట్? జస్టిస్. Unproductive waste. Even though you ate, but you will start to cry by taking. Why? Because you will lose, what is that? Next best alternative. So scenario analysis means, what is that? Even if it is a sensitivity analysis, we concentrated only one factor. Hello. In scenario analysis, we will consider what is it? All the factors. At a time, all the factor may changes. Okay. In sensitivity analysis, one factor changes, remaining factors remain constant. We took an assumption. But in scenario analysis, what happened? Every factor, entire globe works against you. In such a case also, you got the NPV positive, nobody is going to stop you. Do you agree? In scenario analysis, we will identify all the factors works against you. All the factors creates a risk element. Even considering all the factors, if you compute NPV is positive, then there is no need to worry. There is a 3 types of scenarios. What is it? Best case scenario, worst case scenario, then moderate scenario, right? In this situation, worst case scenario, most likely best case scenario, you have to find it out. For example, year 1, you have to calculate what would be the worst case scenario. XYZ Limited considers project A with the initial outlay of how much? 14 lakhs. And the possible 3 cash inflows attached to the project is follows. Year 1, worst case, how much? 4,50,000. Most likely 5 lakh. Best case, year 2, 4 lakh worst, 4,50,000, 5 lakhs. Year 3, 7 lakh, 8 lakhs, 9 lakhs. Cost of capital is 9%. Calculate NPV. You see the year 0, 1, 2, 3. Factor value, I took it. Worst case, how much it is? You already, 450 means zeros I removed, right? 450, 400, 700. Yes or no? Worst case. What is mostly likely? Most likely it indicates 550, 450, 800. What about the best case? 650, 500, 900. By taking this cash inflow, we got the NPV. Now tell me, if the best is happens, I supposed to generate 311.85. But if worst is happens, minus 11015. But in most likely to, what is that? 100. There is a chance that in most likely to 100 I may get it. But if it is a best turns to 311.85, worst thing happens 1110. If you get ready with this worst of how much? 110.15, you will get what is it? Best of 31185. But in worst case, what happen? We will consider that maximum worst situation. What happens? So this is the NPV. This is bearable. We can accept. So this is the idea of what is it? Which analysis? Scenario analysis. What is the difference between sensitivity analysis, scenario analysis? All the factor changes against company. That is called scenario. Only one factor will take what? Sensitivity analysis. Examiner maximum they will ask sensitivity analysis. But we should also consider which one? Scenario. For example, in the coming problem, if I add 1 point, terminal cash inflow, 0, 4 lakh, 1 lakh might be. Now worst case, 0, 4 lakh, 1 lakh. In best case, how much I take? 0, 4 lakh. Moderate, 1 lakh. Worst case, 0. You are not going to get it. Okay? Because we always think what? Negative. Are you getting? Always think worst we will first conceive, then we will move to best. That is. And finally you have what is that? Variance, standard deviation and coefficients of variance. So these are the certain statistical techniques. How do we calculate expected standard deviation? Variance is nothing but what is that? What you actually expect and what is the difference of movement is happens. That is called variance. Standard deviation is the square root of variance. For example, how much expected cash flow you expect? From that standard deviation is 100. Expected cash flow 40. Hello? Expected cash flow 40. Standard deviation is 100. What do you mean of this? Means whatever the expected cash flow you calculated by considering probability also, that may deviate by 100. Hello? That may plus or minus. Okay? So standard deviation means what you expect and what you actually you are conceiving. Already I told you, మీ అబ్బాయి చేయి దాటిపోయాడు, మీ అబ్బాయి బాలసుబ్రహ్మణ్యం ఎప్పుడో చేయి దాటిపోయాడు అని మా డాడీతో సంబడి టోల్ మీన్స్ చేయి దాటిపోయాడు మీన్స్ మా డాడీ చేయి పెట్టాడు, నేను ఎగురు దూకి వెళ్ళిపోయానా? వాట్ ఇస్ స్టూపిడిటీ? వాట్ ఇస్ దిస్? I asked this, you are deviated. Okay, that is a standard deviation. Tell me in English, why you chai datipadu, ur datipadu, what is a stupid? So that indicates variance, standard deviation, what is that? Coefficients of variance. Coefficients of variance also projects same, but by taking 1. How do you calculate this one? Means first you should understand what is that? Take cash flows, multiply with the probability, estimate expected cash flow. Hello? Then expected cash flow you sum it up. From the summation you have to find it out deviation. Deviation you will get it cash flow minus expected cash flow. Then in order you may find a plus or minus. To remove this plus or minus signature, what do? You have to d square into probability summation. You will get what? Variance. Square root of variance equal to standard deviation. Coefficients of expected cash flow divided by standard deviation is nothing but coefficients of variance. Now tell me, if project A, here you see, project A, possible event A, B, C, D, E is given, cash flows are given, probability is given. Project B, cash flows, probability given. They are asked to variance, standard deviation, coefficients of variance. This is for new project, new study material they given. What we have to take? Possible events, cash flows, probability. By multiplying both, you will get what is it? Expected. And cash flow minus what is it? Expected cash flows. You will get it, what is it? Deviation. Plus or minus is there. That is the reason, in order to mitigate this one, you have to do square. When you do square, this plus or minus gets disappeared. And by multiplying pi, you will get the variance. If you sum, you have to get the variance. Summation of all these values, you will get the variance. Square root of variance equal to standard deviation. Now standard deviation equal to 2.191. 2.191 means what is the point here? You expected 12,000, but the thing is, it may happen, what is it? Plus or minus. Whereas coefficiency variance, same logic with respect to project B also, 4.195. Hello? And while coming to coefficients of variance, standard deviation divided by sum of expected cash inflow. Project A 2191 divided by 12,000. How much? 0.1825. Project B 4195 divided by 16,000 equal to 0.2621. So what is this 0.1926? For 1 rupee, if you expect the deviation takes place, how much? 0.1825. Got the point, ma? Sir, you are saying a standard deviation also conveys same, sir? Yeah, standard deviation takes aggregate. What is that? Aggregate means you are expected how much? 16,000. Standard deviation is how much? 4,195. What happens? Plus 4,195 minus 4,195. Then again, in here also you are saying same, sir. But here, for every 1 rupee of expected cash inflow, the deviation might be 0.1825. Between these two, which project is low risky? In which project deviation is low, that project should be accepted. Which one? A. Got it? Then this, with this, we concluded, what is it? Risk. Major point, only 5 marks they will get it. What are the areas we can expect? Sensitivity analysis, expected, certainty, then certainty, expected NPV, risk adjusted, discounting rate based NPV, sensitivity analysis, scenario analysis, and certainty. Got the point, ma? Right. So with this, we concluded this one, and we take which one? Dividend decisions. I think working capital is 28 hours. Yes or no? Capital budgeting 22 hours. Cost of capital 14 hours. But the same chapter, all the chapters, we have to discuss one. I know your capacity. One problem, Aneja limited in capital budgeting, 1.5 day we wrote it. Hello? 1.5 day. Today I started, 2 days it completed. And you are writing comfortably. Such a time frame, even knowing that your pulse rate and the capital budgeting we are discussing means you already have the idea, but once you observe means automatically you will get all the gaps. And if you listen this one, frequently you take the material and just observe it, 99% you will get it. Because I could not came randomly because mastermind says that, sir, marathon is there. Take a class means okay, no problem, sir. I will take shower and I will come. Okay, kuch nahi, kya hota hai? Nothing. I can know, sir. No. What I personally believe that whatever the work I am going to do, that this is determines student confidence at last. And at the end, after preparation of certain level, student might have little bit doubts. So once this thoroughly one day, if you are allocating 1 hour, 1 day today at the 2 in the tough time means you are allowing the most valuable time for this class. In such a case, I should not come with a randomly. That is the reason I investigated, I searched, I studied, I thoroughly prepared each and every one. Before preparing this slide itself, I made a note it. Because I cannot sit directly, I will, by solving the problem, then only I will type it. So, by keeping this information with you, even if it is in social media, they will keep in masterminds. Just whenever you have a doubt, just you get it this one. Within second, you can recoup all the concepts. But along with our regular notebook. Don't expect a regular class. How it has happened in such a way means even 8 hours. I think there is no chapter even 8 hours. Even leverage also we crossed at 12 hours. Even worst case, leverage chapter 12 hours. In capital budgeting, crossed Bradipet, Arangalpet, Gaya. Okay, that is. Now, dividend decision. This is simply very, very important chapter. You can understand the dividend decision. Hardly so far 5 marks question only they given. Only 4 models, 3 models as per Walter, Gordon, Modigliani, Miller, and another one is dividend discount model. Financial management, initial class itself we discussed. Financial management is a subject of what making? Decision making. How many decisions? Financing decision. But the fact is not actually 3 decisions, only 2 decisions. Third decision may happens if you take successfully first 2 decisions. First major concept, if you ask me, I will tell you only 2 decisions are there. One is financing decision. Financing decision, what it indicates that where you are going to get the money, where to get the money affect the shareholders' wealth. You have to get the money so that which affects the shareholders' wealth means wealth has to increase means KO has to decrease means you have to raise the financing at a least cost. Then where to invest the money, it means that where to put the money. Keep it in mind, where to get the money, where to put the money. You have to get where KO would be least. You have to put the money where IRR should be highest. When IRR is greater than KO, then you will have a surplus funds. With this surplus funds, what to do would be, what is that dividend decision? Here it indicates regarding whether the excess profit you got it. How do you get this excess profit? When IRR is greater than cost, yes, then you will have a surplus funds. This surplus funds, what we do, should be given to shareholders or retain it, what we call, what is it? Dividend decision. Whatever the decision you can take, man. But the thing is, you have to increase market value. I remember long ago, a student from Andhra Pradesh, while paying lotteries, he lost 73 lakhs. Their parents gave to him that dividend distribution. Not 73 lakhs, sorry. Here's 95 lakhs. Here it is, Maji. It is happens in Andhra Pradesh.
ఇప్పుడు డిజిటల్ ఇండియా
अरे कौन रे ये? Okay. You see here it is there, November 2020. Here online class drag. Here it is. Telangana student. A student lost how much? 95 lakhs. You see their parents gave him 95 lakhs and manage it, maintain it. Right? They declared dividend. What happened? The value gone. Okay, and he paid comfortably. Which one? Online game. He lost everything. So simply logic is that, right? How a parent has to take care about his kids. Similar to what is that? If dividend also should be taken like this. If a company makes a wonderful profit, in order to increase market value, what the company has to do means whether that earned profit should be declared or retained. That is called what decision? Dividend decision. So here. There are different types of theories with respect to dividend decision. Irrelevance theories, relevance theories, other theories. Irrelevance theories. What this irrelevance theories argues that dividend decision does not influence what? Market price. Only one theory is there. What is that? theory. What is the irrelevance theory? Relevance theory means dividend decision can influence to increase market value. That may be positive or negative is called relevance theories. You have Walter model, Gordon model, whereas Graham Dodd, Walter, Gordon would be two models given. Other theories are there, traditional theories, Linter theory. Where we can make one more theory is also called dividend discount model. Actually, in our material, study material, theory part point of view, you have theory, Walter theory, Gordon model, and Linter theory, Graham Dodd, and dividend discount model. Hello. Dividend discount model also is there in our material. So these are the models to be considered. First, Walter theory. Walter argument is, Walter theory is relevant or irrelevant? Relevant theory. Walter theory, whether the company has to pay dividend or not to pay dividend, is depends upon two things. What is that? Cost of equity, rate of return. What is the rate of return? You should understand. When company retains, company has to invest this fund somewhere else. Hello? When company retains, company has to invest somewhere. So where the company is going to invest these funds, how much return company has to generate, that return is called, what is it? Rate of return or IRR. IRR of the company is 20%. What do you mean of this? If company retains, for every 100 rupees, company may generate how much? 20 rupees or 20%. Now what is the cost of equity? If company declares a dividend, investors take that money and invest somewhere else. Hello? In such a case, he may generate the return. That return is called KE. Now R is 20%. KE is, R is 20%, let us take. KE is 10%. What is the difference between R and KE? R is nothing but if company retains and company reinvests that funds, what is the return it's supposed to generate is called, what is it? R. R is 20%. What is a KE? If company declares, investor get a chance to invest and he will get it as how much? 10%. That is called, what is it? KE. Now what to do? Very simple. You are working for the sake of your equity shareholders. Equity shareholder working for himself. You are a financial manager. You are working for the sake of himself. He is also working from himself. Now tell me, who can work better than for himself? Company. Then in such a case, why you are giving dividend? Since R is greater than KE, don't declare what is that dividend, retain and reinvest, make him wealthy. Hello? When R is greater, when KE is greater than R, give it, because he is the better comparing to you, that is give it a dividend. So this is the idea about Walter model. So Walter model, in order to find it out market price, he identified, I told you 4 things. This is the hand, right? Keep it in that. Market value is nothing but, according to Walter, market value is nothing but present value of future benefit discounted at, what is that? Investor expected rate. If you want to bring into present, what is that? If you market value, investor identifies that market value is nothing but present value of future benefit. So if company makes EPS, from the EPS company gives, what is it? Dividend. Hello? Dividend. So present value of dividend, then what is this? Retaining. From the retaining, you will have 4 questions. How much you are retaining? At what rate you are reinvesting? How much return you are getting? Total return, how much you are getting now? Hello? How much dividend you are giving? What rate you are investing? Yes or no? How much return you are getting? And what is the total return you can generate now? That could be calculated with the market value. This market value formula would be, what is this? Here I will take operating leverage, you know, where we are. Walter, 640 pages we came. Okay, this is the slide. Are you getting? Now. So when R is greater than KE, right? What is a KE? Kya maje? This is investor expected rate of return. Investor expected rate of return. What is this? IRR. IRR is 20%. KE is 10%. What is his opinion? So company has to retain. So in order to increase market price, since R is greater than KE, by following 0% dividend payout ratio, right? Company can increase market price. Whereas company can decrease market price when? When R is greater than KE, company follows how much? 100% dividend payout ratio. When R is equal to KE, then dividend decision does not influence. Okay, that is the point. Here, many people asked, sir, R and KE, you are saying now same. R and KE, R is greater than KE. Sir, in future, R and KE may changes, sir. In such a case, assumption. No KE changes. Okay, sir. One more thing, sir. We give a dividend, sir. Okay, then we will raise the fund, sir, outside. No, we will. If you want to invest, means we have to retain it. Sir, we do one thing, sir. Debt is available at cheap cost, sir. Shall I go? Well, shall we try, sir? No. No debt. Only retained earnings we can make a investment. Sir, Balu sir, my point is, if you invest, you will get. If you get loss, sir, assumption, no loss. Hello, sir. If you invest, sir, certainly sometimes risk may happen, sir. No risk class. Hello, sir. If you invest, sometimes brokerage charges also might be high, sir. No brokerage. Sir, how should I know, sir, my investor earns this much? Perfect market competition. What is this? All are assumptions. If you take all are these assumptions, you can understand this theory. So Walter theory is based on what is that? Perfect market competition. Are you getting ma? Perfect market competition. No flotation cost, no transaction cost. Company has a perpetual life, and all the company's investment generate what is it? Return, and K and R remain what is that? Constant. So how do you calculate market value of firm according to this? Market value MP0 equal to D plus E minus D into R divided by KE whole divided by KE. This is the market value. Whereas if R is greater than KE, if you follow, right, 100% dividend payout ratio, then बच्चे क्या हो जाएगा? Market price gone. Okay, that is the point. Market value of firm equal to D plus E minus D into R divided by KE whole divided by KE. Market price is nothing but present value of future benefits. What it speaks, you see the D, this is the D, present value of dividend. What is this? R. So D means once your dividend is given, what you are the question? What is the R? Where you are investing? How much return you are getting? What is the total return getting as on today? So when you bring the both into present, you will get the market price. Okay, that is the point. Here market value basing on this, can you able to solve this problem? What is the market value for problem in this? Walter theory. What are the assumptions of Walter theory? R and KE remain constant, no transaction cost, no flotation cost, no tax. How do you know that investor earning this much? Perfect market competition. Sir, any loss? No. You will make a return. Okay, sir, is it 1 year or 2 years, sir? Forever it will generate. Hello, that is the point, ma. So now you can calculate number of equity share is how much? The following information available XYZ Limited. Number of equity share 1 lakh. EPS is 4. DPS is 2.4. Equity capitalization rate. Equity capitalization rate is KE. How much? 12%. And rate of return on investment is how much? 15%. Now in this problem, you have to calculate as per Walter model, what is the market value of share? To keep the share price 40, what should be the dividend payout ratio? As per Walter model, what would be the optimum dividend payout ratio? Market value at a optimum dividend payout ratio. This problem is available at a new study material. This why I have taken this problem means November 19 public exam, they asked for 5 marks. November 19. 5 years has happened, right? Now, tell me, as per Walter model, what is the market value of share? Market value equal to MP0 equal to D plus E minus D into R divided by KE. Now, divided by KE. Now, try to understand. If you come here, according to Walter, this is the formula, right? Market price equal to what is this? 2.4 plus 4 minus 2.4 into 15% divided by 12% divided by 12%. How much? 36.67. And another one is to keep the market price 40. What would be the dividend payout ratio? What is the formula of dividend payout ratio? Dividend payout ratio equal to what is it? Dividend divided by EPS. So first EPS is given. You have to find what is it? Dividend. Working note 1. Estimation of dividend per share. Market price. Estimation of dividend per share basing on market price. Well, here x plus, this is the d, hello, d equal to d plus e minus d into 1.25, because r divided by ke is 1.25 divided by ke equal to 40. If you make a cross multiplication, 0.25x minus 5 minus 4.8, thus xr dividend equal to how much? 0.8. 0.8 is dividend. Then dividend payout ratio equal to dividend divided by EPS into 100. 0.8 divided by 4 into 100 is how much percentage? 20%. Okay. And another important point what they asked is, if IRR, one more point what the given is, as per Walter model, what is the optimum dividend payout ratio? Here you can say that R is how much in this problem? 15%. KE is how much? 12%. What the answer you can give it? As per Walter model, what is the optimum dividend payout ratio? 0%. And market price at Walter dividend model is, formula would be 0 plus EPS minus 0 into 1.25 divided by KE. Hello? If you take this value here, it is here, market price, this slide has gone, I think so. Okay, here you can calculate. Dividend is how much actually? Market price is 0, right? 0 plus EPS is 4 minus 0 into 1.25 divided by 12%. How much, ma? 41.67. If you follow optimum price, optimum dividend payout ratio, you can make the market price 41.67. Whereas here you are making 36.67, right? This is what theory? Walter theory. Next you have, what is that? Gordon. Gordon argument is completely different from Walter. Once again, what is the Walter theory? Explain. Walter theory, relevant or irrelevant? Relevant means what? Influence market price. What is the difference between R and KE? R means rate of return earned by company. KE means when company has to increase the market value. Sir, when company increases market value means that depends upon R and KE. If R is greater than KE, yeah, but KE is greater than R, 100% dividend. Okay. Market value of Walter theory, D plus E minus D into R divided by KE minus, right. Okay. Coming to Gordon theory. Gordon theory is little bit approximate one. So here the point is, according to Gordon model, dividend is relevant or irrelevant? Relevant policy of the company. Firm is moves with 100% equity. R and KE remain, what is that? Constant. And here the company argument is very, very simple. You see, Walter theory argument is, when company made a EPS, hello, EPS, from the EPS, if you retain it, but whereas after you retain it, when you start to retain, instead of declaring dividend, equity shareholders risk what happen? Increases. Hello? Face pedtadu? He changes his face because you are crying. Because you are retaining, right? Why he is crying? You retain. EPS you made it. Once you showed a EPS, he felt very, very happy. Then immediately what he said? I am not declaring dividend, I am retaining. Then his face will come like this. And if you retain and you are reinvesting, then immediately you will ask, you hear the financial manager, sir, where you are investing? He says that batteries manufacturing. Batteries means drone batteries and electrical car manufacturing. No. Radio batteries. Radio batteries means then immediately he will start. Oh my God, Sarvanasana. Okay. So, whereas what the point is, if you retain, immediately market value won't increase. If you retained this retained amount, what you have to do? Reinvest, and you must submit, what is that? Growth rate. If you retained and reinvest, you submitted growth rate. When this growth rate projects automatically, he feel very, very happy. His investor expected rate decreases. When investor expected rate, why investor expected rate decreases means risk decreases. Why risk decreases means because here growth is there. When growth is there, growth increases, risk decreases. With effect, investor expected rate of return is decreases. With effect, market price increases. So once you declare a dividend, or once you made it a EPS, whether you retaining or dividend does not makes. But if you retain, thereafter you have to make what? Lot of reinvest, then you have to generate better return. Hello? Then you can, if you submit a growth rate, that growth rate indirectly decreases risk element. When risk element decreases, automatically market value increases. So this is an identity of garden theory. So picture abhi baki hai dost. There is a film dialogue. This theory says like this: just you retain means no. Thereafter what happened? You have to retain and reinvest, and you must submit a growth. So that is this model conveys that according to this model, market price equal to MP0 equal to DPS1 divided by KE minus growth rate. If you submit a KE, for example, DPS1 5 rupees, KE investor expected rate is 20%. You given a growth rate of how much? 5%. In such a case, how much it would be? 5 divided by 15%. How much market price, ma? Huh? 33.33. But next time you gave wonderful growth rate, you made it a 15%. In such a case, you gave it market price would be 100 this time. Next time you gave it how much? 19 rupees. 19% growth rate you gave it. 500. Now what is observation? Market price is increasing. Why? Growth rate increases. When growth rate increases, because of growth rate, investor expected rate is decreasing. With effect, market value increasing. So what he want to convey that when you retain money means you see, check that whether you can reinvest and submit a better growth rate or not. If really growth rate able to you generate, right, then you can do the miracle and you can increase the market price. Once you don't have a chance, right, better to give a, what is it? Dividend. So that is the point of Walter theory. Okay. Can you able to solve this problem? You see the following figures of XYZ Limited. Okay. XYZ Limited. Net profit 30 lakhs. Preference share is how much? 12%. Number of equity shares 3 lakhs. Return on investment is 20%. Cost of equity 16%. Means R is how much? 20%. K is how much? 16%. Calculate price per using, what is it? Walter dividend, Gordon dividend model. When dividend payout ratio is 25%, 50%, 100%. 25%, 15%. Now tell me, R is greater than KE. Hello? R is greater than KE means when the market price increases, means when growth rate able to increase. So here growth rate, how do you calculate growth rate? Growth rate equal to retaining ratio into rate of return on reinvestment. So what is according to this model formula? Market price equal to DPS1 divided by KE minus growth rate. Now if you come to identity, first earning availability equity shareholders, earnings how much? 30 lakhs minus preference dividend. You got it, what is that? Earning availability equity shareholders. EPS equal to earning availability equity shareholders divided by number of equity shares. How much? 6 rupees. Estimation of market price. Market price equal to DPS1 divided by KE minus growth rate. Now estimation of market price when dividend payout ratio is 25%. 25% means here growth rate in such a case retaining ratio into rate of return on reinvestment. 25% dividend payout ratio means retaining ratio 75. R is 0.20. 0.75 into 0.20, 15%. Market price D 6 rupees divided by 25 minus how much? D, here it is D, dividend payout ratio 25, right? 6 into 25 ratio 25%. 1.5 divided by 16% minus 15%. 150 rupees. Whereas if you do 50% means EPS into 50%. How much? 3 rupees. 3 rupees means the 50% if you invest at 20, you will get the 10%. Hello? Then investor expected 16% minus 10%. 50. Previously 150, right ma? Whereas in third option, when it is 100%, in such a case, here it is a growth rate, retaining ratio into rate of return on reinvestment, 100% dividend. In such a case, how much it would be? 37.5. So now final observation. So what is observation? Market price is increasing, when growth rate increases. So growth rate increases, investor expected rate of return decreases, with effect market value increases. So once you have a better what chances? Reinvestment and growth rate chances, you better to retain, otherwise no. So this is the identity. Already I told you one of the philosophical observation. A father may take care of his girl, his daughter, by taking lakhs of decisions. But coming to one marriage, if he takes wrong decision, right, entire thing goes out. You retained, but still somewhere you done a mistake in what is it? Reinvestment. Everything is gone. So that much of cautious you have to take. That is the intensity of which one? Gordon model. Okay, ma? Walter model formula? Gordon model formula? Yeah, so with this we completed. These are the formulas, Walter and Gordon. This is the formula I asked, right? D plus E minus D into R divided by KE divided by KE. There is a Gordon model, D1, DPS1 divided by KE minus growth rate. Okay. Thereafter you have which one? Before that, Modigliani Miller theory and a dividend discount model is there, Dividend discount model. What the dividend discount model? Dividend discount model, it is a theoretical part instead of a problematic. Dividend discount model, it indicates that when newly formed company, when it comes to market, you try to understand. Dividend discount model, it's a theory part. You see, dividend discount model. A new company is there. Hello? When new company comes to the market and issues equity shares. Issues equity share means investor gets risk. Yes or no? Because it is what company? New company. There is no any historical supportive statement that the company can give better return. In such a case, he never show interest to buy this one. But thing is, if he want to buy, he will expect which one? Discount. When he expect a discount, automatically if company in order to collect money from him, if the company provides discount, automatically what happened? Then company fell into undercapitalization. Do you agree? Are you getting? Undercapitalization. What the company do means, instead of providing discount to client, by considering its new business, new opportunity, it declares dividend in such a way that up to 5 years, I can generate better return. That's why if investor expected rate of return is suppose 14% means the company makes announce, I will give you growth rate of how much? 20%. How long? 5 years. Then what happened? 5th year onwards, I will follow the normal rate what the market is providing. How much? 8%. Instead of getting discount from me, just you can expect direct return. Hello? That is the point. When company makes announcement, the investor starts to think that is it right to buy the share price or not. He will think that what happened? It is a better to hold for how many years? 5 years. And take 5 years what? 5 years, what is that? Dividend. Hello? And 5 years dividend he will take, and 5th year ending, his expected rate is 14%. Whereas company is providing, his what is that? 8%. In such a case, 5th year he will sell the security, he will get the market price. Now investor thinks in such a way that 5 years dividend with the growth of 20%, he will bring the present. Plus 5th year he will sell the security, he will bring the present. Total market value would be 1,500. His point of view, he brought the total benefit into present. What is the total worth? What is how much? 1,500. That 1,500 is called intrinsic value. What is it? Intrinsic value. Intrinsic value he calculated by taking how the company is going to pay dividend in future. Are you getting? Now intrinsic value 1,500, but a company is ready to sell the security at 500 rupees. Now worth of this security is how much? How much it is? 1,500. Now company expects only just how much? 500. Now tell me, investor buys or sells? Buys. When buys means share value, what happen? Increases. So now share price is increasing. Why it increasing? Share market price is increasing. Why? Because buy. Why is buying? He calculated intrinsic value and compared present price. Intrinsic value, how he calculated? Basing on dividend policy done by the company. Hello? So this is a long approach. You declare a dividend. How you are going to declare that basing on that I calculated intrinsic value. Basing on that intrinsic value, I compared with the present value. Then I came to know that so my investment is less than what I am getting. So it is a better to buy. With effect, what happened? Market value increases. Suppose if he got the 500, whereas company expects 1000 from him, means then it is a better to sell. Here market price decreases because he is selling. Why he is selling? Because intrinsic value is low. Why intrinsic value low? Because of your dividend decision. Okay, this is the theoretical part. While having Walter Gordon, don't expect which one? Dividend discount model, but you should understand what the concept is. And last point is, what is it? Modigliani-Miller approach. Modigliani-Miller approach argument is whether the company, it is a relevant theory or irrelevant theory? Irrelevant theory. Modigliani-Miller argues that whether the company may, it is, what is this theory? This is what theory? Irrelevant theory. Whether company may, approach is irrelevant theory. Whether company dividend declare or not to declare, company does not makes any effect. But if the company makes, what is that? Investment. The company market value is not depends upon, what is that? Dividend decision. But company market value depends upon what decision? Investment decision. So how effectively you are going to invest is determines market value, but not what is it? Dividend. Okay, that is the idea of this theory. This theory identifies that, right? An investor, instead of providing dividend does not make any sense. Why? Because paying dividend is historical thing. How you have performed is can be identified how much of dividend you are paying. But I am going to invest my money in your company now means not by looking at your past, by looking at what is it? Your future. So even though your dividend is not good, don't worry. But you are convey that you are how, in what aspects you are going to invest, what areas you are going to invest, how much return you are going to support. So with that may increase, what is that? Market value. Are you getting? So that is his idea about relevant theory. But the thing is means, how should I know that investment decision where which project we are going to get it? Let us have perfect market competition. Number 2, once you make investment, is there any transactional cost? No transactional cost. At least tax, no tax. Okay, no tax. If you make investment, if you get a loss, no chance of what is it? Getting loss. So this is an observation, assumptions of this theory. But this theory conveys that one more important point is market value is nothing but present value of future benefits. Here one more point is company has what policy? Fixed investment policy. Life is nothing but 1 year. We are not going to take a total number of years. Project may have perpetual life, but for the sake of calculation, we will take only 1 year. So according to this model, market price equal to present value of future benefit discounted at investor expected rate of return. Now tell me, how should I calculate MP0? When you want to calculate MP0, how should we calculate MP0? MP0 indicates, here this formula is identified. MP1 equal to what is it? MP1 equal to market price as on today means 1 year life means MP1 equal to, or MP0 means what do you say? MP0 equal to DPS1 plus MP1, hello? MP1 divided by 1 plus R. Yes or no? Because 1 year dividend, end of the period market value, you are going to bring into present. This is the MP1. What from this formula? This is the first formula. Number 2, what about the MP1? MP1 equal to MP0 into 1 plus KE minus D1. This is nothing but second formula. Hello? And if you want to find it out, number of new shares. What is it? Number of new shares means new shares for the sake of investment, because you have a money, you want to invest at the end of the period, but you don't have sufficient money to invest. You may go with what is that? New number of equity shares. New number of equity shares, you may get it investment minus earnings minus dividend divided by MP1. And finally, market value of firm would be what is that? existing shares plus new shares into MP1 plus earnings minus investment divided by 1 plus KE. So this is nothing but market value of which one? Firm. What about this above one is market value of share. Hello? This is the market value of share. So already this model simply conveys that dividend decision is irrelevant. When the company wants to find it out, here it is. Here. This is whose value? Economics. Array, no economics. Economics for our subject is there 50%. Economics for finance. We are financial management. Alright. So MP0, see, MP1 equal to, what is it? MP0 into 1 plus KE minus DPS 1. Okay. This is the first one. When you want to make a investment, you need a money, right? How do you find it out? How much money should be required means you have to find it out what is your investment minus earnings minus and if you made up any dividend payment, that is a amount required, net investment amount required. New shares you are going to issue means investment you need minus earnings minus dividend divided by MP1. Got it? And if you want to find it out market value of firm indicates existing shares plus new shares into MP1 plus earnings minus dividend divided by 1 plus KE. So this is the point. Sir, here earnings is there, investment actually. Investment, earnings, investment. Okay, where is the dividend, sir? Dividend is adjusted in what is it? New number of shares. Hello? New number of shares we adjusted. So here what we are going to declare, whether you pay dividend, not to pay dividend does not influence. What going to influence means your investment decision. How effectively you are going to convey your investment, that gives you better return. That is a point. He observes this. Now basing on this, you make solve this problem. This is the past exam question paper. You see, November new study material and MTP November 18 also they have given. So in this problem we are going to prove that market value of firm, market value of equity and market value of equity, market value of firm will remain same if you declare a dividend or not to declare a dividend. Answer the following question. theory is relevant or irrelevant? Right. theory is relevant or irrelevant? MP1 formula. So see, theory final argument is that if a company whether give a dividend or not to give a dividend is a secondary issue, but every year ending company has to make investment. If company declares a dividend, money goes out, but he has to invest. When company declares a dividend, automatically certain worth of cash goes out. With effect, a company market value what happen? Decreases. But immediately company has to undertake investment decision. So in order to undertake that investment decision, company has to raise funds. In order to raise the funds, company issues a share. Now share value will increase or decrease? Decrease. Why? Because your market value decreased, you know. Now you see some cash balances went off. Automatically market value what happened? Decreased. Immediately you have to undertake investment. You need a money. Automatically you have to issue more number of equity shares. In such a case what happened? In balance sheet more number of shares increases. And in asset side amount comes and you can make investment. In liability side shares value increased and at the same time in asset side investment increase. Both would be what is it? Set off effect. Even your investor is there. You gave a dividend. You feel very happy. But once you give a dividend, its market value of share what happen? Decreases. So before, but if you won't give a dividend, in such a case what happen? Market value will remain same. So his argument is once if you be an Indrasena Reddy, so for the sake of construction of dam, if you give all your agricultural lands, everything, what happened? Next scene would be Kasi. Your market value what happened? Decreases, bam bam bole. Are you getting? So, Tisko, Lejao, given, everything if you give it means your market value what happen? Decreases. So, MM theory argues that dividend decision at the end of the period, whether you declare a dividend, not to declare a dividend, not the matter, but what investment strategy you are going to project, that depends upon your market value. But keep in mind, once you declare a dividend, your balance sheet certain amount gets disappeared. With effect, market value of equity what happen? Decreases. But whereas your responsibility is you have to undertake investment decision, you don't have enough money with you, you have to go with the equity at a reduced market value because you declare dividend. In such a case, in balance sheet, liability side shares increases, asset side amount comes in the form of investment. Here cash balance increased, their liability increased. Set off effect take place. Then what is an advantage? So either dividend declared or not to declare, it does not make any sense. So MP1 equal to, what is the formula? Whereas number of equity shares to be issued means investment money minus earnings you can deduct, but from that earnings you can pay dividend divided by MP0. Now you see this problem. RST Limited has a perpetual 10 lakhs in equity share capital 100 rupees each. The shares are currently quoted at par. The company proposes to declare a dividend of how much? 10 per share at the end of the current financial year. The capitalization rate for the risk class of which the company belongs to is 12%. What will be the market price of the share if dividend is declared, if dividend is not declared? Assuming companies pay dividend profit of how much? 5 lakhs and makes a new investment of 10 lakh during the period. How many new shares to be issued? Use the MM model. Now you get it here. When dividend is declared, not to declare. Given information, MP0 is how much? 100. DPS1? DPS1 na? How much they given? 10 is what? The company proposes to declare DPS1, right? K equal to, so we know that MP0 equal to D1 plus MP1 divided by 1 plus KE. Then MP1 equal to P0 into 1 plus KE minus D1. Now estimation of MP1 when dividend is declared or not to declare. MP1 not declared actually we need, right? MP1 means 100 into 1.10 minus 0. How much it is? 112. Whereas when dividend is declared in such a case, 100 into 1.10 minus company supposed to declare how much? 10. How much it is? 1 or 2, right? Whereas estimation of number of new shares to be issued when dividend is declared. In such a case, new shares equal to investment minus earnings minus dividend divided by MP1. Okay, in such a case, 100, sorry, how much it is? 10 lakhs minus 5 lakhs minus 10,000. Here it is how much? 10 rupees. This is the 10,000 is the shares and 10 rupees is dividend. Into divided by 1 or 2 would be the market price. How much? 5,882. So this is the model they declared. Dividend declare or not to declare. But you can prove with this problem, what is that? You can also maintain market value of firm also. You can prove market value of firm, it indicates when you declare a dividend, not to declare a dividend. In such a case, formula would be MP's market value of firm would be, what is that? Existing shares plus new shares into, what is that? Into MP1 plus earnings minus investment divided by 1 plus KE. But MM theory, maximum MM theory, they won't ask you that market value of firm verification. Because if the goes for market value of verification, problem would be asked for how many marks? 10 marks. But 10 marks, if they ask dividend decision, means paper would be very, very easy. So they won't ask you. Maximum 10 marks they could not ask. So far, maximum 5 marks. Walter theory, Gordon theory, MM theory. But Walter, Gordon collectively, he may ask. Got it? Now, tell me the formulas concerned with this one means Walter theory. Walter, D plus E minus D into R divided by Gordon. What is the intrinsic value? Present value of future benefit discounted at investor expected rate of return. What is according to MM theory? What is a MP1? Net earnings, number of new shares to be required, market value of firm, existing shares plus new shares, right? 1 plus KE. What is the life of valuation in this problem? Life of the company in valuation, 1 year. Okay. With this, the dividend decision also we completed. Then we have only one concept. What is it? Advanced capital budgeting chapter is this. There is no exclusively chapter. What is it? Advanced concept in investment decision. We the people gave a title for this. Exclusively Mastermind designed such a chapter, because some problems are little bit complex. By considering that factors, they identified this chapter. Okay, but in advanced concept, some important concepts and cost to be identified. Sunk cost. What is the sunk cost, Maji? The cost before commencement of the project. Any cost incurred, such a cost is called what cost? Sunk cost. While calculating NPV, should we consider or ignore? Ignore. Common cost. Common cost means those costs. General administrative overhead cost. These are the costs if you undertake a project. Not to undertake a project, this cost exists. Watchman salary. Hello? General administration expenses. Everything comes under the category of what is it? Common cost. Should we consider or ignore? Ignore. Opportunity cost benefit. Opportunity cost benefit means because undertaking a project, if you because of investing in a project, an opportunity creates, you will get a benefit. You will generate a benefit. That is called what is it? Opportunity cost benefit. Opportunity cost loss. Navjeevan Hospital, morning class we discussed. Because of investment, he lost what is it? Commission. That is called what is it? Opportunity cost loss. When opportunity cost loss happens, should we add a deductor? Deduct. Opportunity cost benefit? Add. Specific cost means exclusively advertisement. A company is there, it incurs advertisement. Now the same company made additional investment, it produced a product, but this time exclusively it is giving advertisement for only that specific product. In such a case, you should consider what is that cost. That is called specific cost. For example, Samsung gives ad, Samsung, that's enough. Is it a specific cost or common cost? Common cost. Samsung gives iron box ad, specific cost. That should not be considered for what? Samsung laptop, hello? Samsung mobile, because that advertisement given for only iron box. Okay, that is a specific cost. Working capital treatment. Working capital morning only discussed in working capital. If you make a fixed asset won't work smoothly because you have to incur some additional amount. What is the treatment? Add to fixed asset, recover at the end. What about the subsidy? Subsidy, it should be deducted. Treatment of depreciation in the presence of tax, in the absence of tax. So when T is there, D is there. When T is not there, right, a tax and tax shield. If a company gives a tax rate, come to conclusion that if you make a profit, tax. If you get loss, right. Capital gain, capital loss. Capital gain means whenever you purchase an asset at the end of the period, if you scrap the asset more than written down value, then it is called gain. You have to pay tax. Loss, right. Profit and loss. From the regular sales revenue, if you deduct a cost, you will get what? Profit. From the regular sales revenue, if you deduct more cost, then you will get what? Loss. Gain is different, profit is different, right? These are the concepts you should understand while calculating NPV. Morning class we discussed NPV, right? Along with that NPV concept, you have to consider all these factors. What are they? Sunk cost. Before Gatam Gadha. Before commencement of the project, cost incurred. Ignore. Common cost, not specific. Ignore. Opportunity cost benefit. Add. Opportunity cost loss. Deduct. Specific cost. Consider. Working capital. Consider. Subsidy. It reduces investment. Treatment of depreciation. T is there. Tax and tax shield. Tax shield is the inflow. Tax is an outflow, right? These are the concept, right? Thereafter, one more identity. What is it? Replacement decision. Replacement decision. A company may replace its existing machine with what? New machine to increase for its value or wealth creation is called what is it? Replacement decision. Reasons for replacement. Why company go for replacement means number one, to increase output or to decrease maintenance cost. Sometimes what is it? Both. So why company goes for replacement means very simple, to increase, to decrease maintenance cost and both. And the replacement decision, it happens in two ways. One is total approach, incremental approach. In our model, in your material, what method is there? Incremental. Sir, total approach means what, sir? Total approach means you have an existing machine, you have a new machine. You are going to calculate NPV for which machine? New existing machine for the remaining period, and the new machine NPV also you are going to calculate. And final NPV is going to compare with one another. Which project NPV is highest? That project should be identified. That is called what NPV? Total NPV. There is another approach is given. What is that? Incremental NPV. Incremental NPV is similar to, what is that? Replacement of my bike. Similar to, if I want to replace my bike with a new bike, what I do first? I will sell. But before, if I sell means income tax people will come, That's why while replacing, what is that? You have to follow the following steps. Step number one, what you have to do? Calculation of, what is that? Depreciation. Why you have to calculate depreciation? Because first you have to scrap. I to agree, right? If you calculate incremental approach, step number one, what to do? You have to calculate depreciation for each of the machines. Are you getting me? You have to calculate depreciation for what? Each of the machine. For old machine you have to calculate, new machine you have to calculate. So depreciation equal to cost minus scrap divided by life. Then you have to what to do? Scrap the what asset? Old machine. You gross sale proceeds of old machine. You sold out. Because calculating depreciation, you calculated written down value. You compared both. You may get capital gain or capital loss. If gain is there, pay tax. Loss is there, tax shield. And finally you will get it, what is it? Net sale proceeds. This is the amount you used to get by scrapping the asset. Then what you will get? You have to buy new machine. Go to the cost of machine less net sale proceeds of old machine. Add, if at all any working capital is there, you can add. Finally you can find it out, what is it? PV of incremental cash outflow. What is the first step? Depreciation. Step number 2, net sale proceeds. Step number 3, incremental cash outflow. Then you have to calculate PV of incremental operating cash inflow. It is better to find it out PBDT. PBDT of new machine minus PBDT of old machine. You will get, what is it? Incremental PBDT less incremental depreciation less PBT less tax. You will have PAT. Add back to incremental depreciation. You will get what? Incremental CFAT. If you bring into present, you will get the incremental operating cash inflow. Then you have incremental terminal cash inflow. How do you calculate incremental terminal cash inflow? Net sale proceeds of new machine at the end of the period you take it. Less net sale proceeds of old machine at the end of the life you take it. Your difference would be incremental net sale proceeds and recovery of working capital. So you will get the terminal cash inflow. Okay, this is the recovery of working capital. Net sale incremental net sale proceeds plus D, you will get the terminal cash inflow. You can bring into present by using present value factor. You can find PV of terminal cash inflow. Are you getting? So this is the point to be considered. And finally incremental NPV. Incremental NPV, how do you calculate? Incremental NPV is positive. Project should be accepted, otherwise reject. Once again, what are the steps? Tell me once. Okay, what is this? This one. This one. Incremental operating cash inflow. This one. This one. Right. If incremental NPV positive, what do you say? Negative. Reject. Got it, ma? Okay. Now you have a problem. This problem is extracted from RTP, Old Study Material, and Old Practice Manual. This problem is there. Old Study Material is there. Old Practice Manual is there. Because from past exams, these days he is going with, what is it? Old Study Material. Why? Because you people are new batch. Maximum you cannot touch which one? Old. That is the reason if they want to give any question, it would be easy for examiner to pick the question from, what is that? old study material. Now, you have a problem. If you are able to solve this question, wonderful. Okay? You want to take break? Half an hour. Break means it may continue class, right? Half an hour I will complete, no problem. This problem, right? Feel yourself great means you are doing best for yourself. Hello? Not for others. I am also doing best for, not myself, yours. Okay? Jai Hind. Now, you see, an existing company has a machine which has been in operations for how many years? 2 years. Its remaining estimated useful life is how many? 10 years with no salvage value at the end. Its current market value would be how much? 1 lakh. Now, what is the an existing machine, an existing company, what is the point? An existing company which has been in operation for how many years? 2 years. Its remaining estimated life is 10 years. No salvage value. The current market value is how much? 1 lakh. The management is considering the proposal to purchase an improved model of similar machine which gives increased output. Why the company is going for replacement? Output, right? The relevant particulars as follows. Purchase price, how much? 2,40,000. New machine is 4 lakhs. Estimated life. This machine 12. Actually 2 plus 10 only, 2 has gone. What is its remaining life? 10 years. New machine life also 10 years. Salvage value is nil. Annual operating hours, how many? 2,000. Selling price per unit, 10. Output per hour, 15. Material cost per unit, 2. Labor cost per hour, 20-40. Consumable stores, year, 200, 500. Repair, 2,000, 5,000. Repairs and maintenance, 9,000, 6,000. Working capital is 25,000, 40,000. So this is the information. The company follows straight line method of depreciation subject to tax. Tax is there means you have to consider depreciation. Should the existing machine should be replaced or not? Okay, this is the point. Now tell me step number 1, what to do? Depreciation, what method? SLM method. SLM method, cost minus scrap divided by life. Can you tell me? Cost, here you see. Yes, step number 1, very good. Step number 1 you told, what is it? The estimation of depreciation. New machine, cost is how much? 4 lakhs minus 0. Scrap value 0 divided by life 10. How much? 40,000. New machine, 2,40,000, right? 2,40,000. This is existing. 2,40,000 minus 0 divided by 12. Every year how much? Then incremental depreciation? 20,000 only, no Maji. Next, what step I do? Tell me. I have to sell the machine. What is the value of the machine I am going to sell? 1 lakh. 1 lakh I sold. What is the written down value? I purchased asset for 2,40,000. I used asset for 2 years. Every year depreciation is 20,000. For 2 years means 40. 2,40,000 minus 40,000. So 2,40,000 minus 40,000 means what is the written down value? 2 lakhs. Bhaiya batao 2,40,000 worth of asset. 2 lakh worth of asset you scrapped for 1 lakh. Now you get the capital loss. Hello? Then you will get the tax shield. Tax shield of how much? 50% means 50,000. Net sale proceeds 1,50,000. 1 lakh note. 1,50,000. 1 lakh you sold asset. 50,000 you got tax shield. So 1 lakh plus 0.5 lakhs. Total is 1,50,000. Got it, ma? Hello? You told 1,50,000, 1 lakh. 1,50,000, right. Now we have to go to the Patnam Bazaar. For what purpose? To buy, what is that? New machine. What is the cost of new machine? 4 lakh. But no need to spend 4 lakhs. Because already you have 1,50,000. It's not a problem. It's a practical. If you think it is a problem, oh my God, colors and numbers means you will get the fever. Jwaram vachesi mottam. But if you simply say that Balu sir existing bike is going to sell at Patnam Bazaar, that's enough. Practically what happens? Very simple. Only income tax person will come officially. Now you see cost of new machine, how much? 4 lakh. NSP of old machine as on today, 1,50,000. If you deduct it, how much? 2,50,000. Add incremental working capital. Because already old machine working capital is there. How much? 40,000. New machine working capital is needed. So the difference should be added how much? 15,000. Total PV of incremental cash outflow would be 2,65,000. Are you getting? Next, Now what we do is you have to calculate PV of incremental operating cash inflow. Actually, you try to understand working note you have to do here. Why? Because you have to calculate PBDT of what machine? Existing machine, new machine. Sales revenue, new machine. How much can you tell me? Hours into output per hours into selling price. Already can you tell me here what is it? Existing machine, annual hours 2000. Output per hour 15. Selling price 10. 2000 into 15 into 10. What about this? 2000 into 30 into 10. Here this much. New machine 6 lakhs. Old machine 3 lakhs. Less material cost. Material cost 1,20,000, 60,000. Material cost how we calculated? Material cost per unit. How do you get the units? 2000 into 15 into 2 rupees. What about existing new machine? 2000 into 30 into 2. What about labor cost per hour? 2000 into 20. Here 2000 into 40. Consumable stores directly given. Repairs and maintenance directly given. Now, basing on this, what I have done is here labor cost. You calculated 80,000, 40,000. Consumable store 5,000, 2,000. Less repairs 6,000, 9,000. I calculated PBDT for new machine 3,89,000. Old machine 1,89,000. Difference is 2 lakhs. 2 lakhs is the incremental PBDT. Incremental PBDT less what depreciation? Incremental depreciation. Less I got the PBT. Less tax. PAT. PAT 90,000. Add back to incremental depreciation 20. Incremental CFAT 1,10,000. Like this, how many years I am going to get it? 10 years. So 15% 10 years means sanity factor 5.019. I brought into present 5,52,090. Okay, coming to incremental terminal cash inflow. Gross sale proceeds of new machine is 0. Old machine also 0. Incremental and net sale proceeds 0. Only one thing is there. What is it? Recovery of working capital 15. Finally, terminal cash inflow 15,000 only. This happens at the end of which year? 10th year. To bring into present means 0.247 into 15,000. You will get 3,705. Hello? Now incremental NPV. Incremental NPV, PV of incremental operating cash inflow, PV of incremental terminal cash inflow minus PV of incremental cash outflow. Incremental NPV 5,52,090 plus 3,705 minus how much it is? 2,90,000, 2,795. He got it. Incremental NPV positive. So now project should be same model problem in CA Institute material also is there in your material. But there instead of selling asset you have a 5 options. Book value, exchange value, resale value, yes or no, like that only there. But the model is same. Okay, you have a 2 alternative. One problem you tried here and one problem I solved there. So with the 2 problems concept is same. Okay, what is the step number 1, Maji? Step number 2, step number 3, incremental cash outflow. Step number 3, incremental operating cash inflow. Then incremental terminal cash inflow. Incremental NPV. Okay, this is the point. Since incremental NPV is positive, accepted. Otherwise, rejection. Okay, this it is assumed that company might get what? Tax shield on capital loss. Balu sir, in the problem they could not mention which one? Tax shield. Tax shield exactly company may get or not to get, they could not given. But we took the assumption that company might get what? Tax shield. Right. So the next point is NPV IRR conflict. Don't expect such a problem in public exam. Okay. But what is NPV IRR conflict? Why these people are fighting here? This man is NPV, this man is IRR. Okay, NPV IRR conflict. What is the NPV IRR conflict means? While evaluating 2 mutually exclusive project, I repeat, while evaluating 2 mutually exclusive project, NPV IRR conflict may arises. NPV IRR conflict may arises. The reason for in NPV IRR conflict means what, sir? As per NPV, one project is preferable. As per IRR, another project is preferable. Thus, there is a conflict between NPV and IRR. Why is there is a conflict means because of two reasons. Number one, having disparity. First have disparity. Number two, mutually exclusive. Projects are mutually exclusive. Another one is disparity. How many types of disparity? Three types. What are they? Cash flow disparity, size disparity, life disparity. Okay, sir, disparity is there. Then what we do, sir? Similar. Decision is financial management objective is to maximize wealth of equity shareholder. So NPV achieves this objective. So prefer the project which has highest NPV. Okay, that is the point. Now here the question is, here first we do what is it? Cash flow disparity. What is the cash flow disparity means? Pattern of generation of cash inflow. Nothing but pyramid versus here one more point I would like to tell you. Here it is. What disparity you are getting? Here NPV IRR conflict means here NPV IRR conflict. So what disparity? Size disparity. Size disparity means project A 40 lakhs, project B 20 lakhs. What disparity here? You see, ये कितना है, इसको देखो, ये कितना है, कितना साइज है इन लोगों का, right? This is what disparity? Size disparity. This is what is it? Life disparity. You see how much life this man and how much life this man. And what about another one is cash flow disparity. Cash flow disparity means pyramid versus opposite pyramid. Hello? So when size disparity, life disparity, cash flow disparity happens, you will find what is it? NPV IRR conflict. In the problem, first we will go with the order here. First, what disparity? Size disparity, also called what disparity? Investment disparity. In investment disparity, how do you identify? Here two project is there. One project investment is how much? 60 lakhs. Another project is 44 lakhs. Whereas this between these two project, which project should be identified? Okay, when you evaluate what is that? Scalar size disparity, certainly NPV IRR conflict arises. NPV IRR conflict arises. In solution, in order to solve this one, you can go with what is that? Incremental NPV, incremental IRR. So what disparity? For size disparity, you have to solve with what is it? Incremental NPV, incremental IRR. It means that what is the identity means? Here there is a two project. This project is 60 lakhs. This project is 40 lakhs. But if you, everybody wants to take which project? Biggest project only, right? But if you choose project A, you will choose to make investment which one? Project B. Are you getting my point? If you choose project A, you miss a chance to make investment where? Project B. In such a case, everybody wants to do project with a huge investment. Now what happen? Additionally, if you invest additional investment, right? Additional investment, what would be the maximum benefit you supposed to generate? For example, I repeat, scalar investment disparity means these are you can get only for theoretical point. Okay, you try to understand by having NPV biggest concept, you cannot get this one. But scale disparity, project A, project B is two projects are there. Here two projects. In the project A, how much investment is? 60 lakhs. Project B, 40 lakhs. Direct labor cost is 30,000. Here it is 15,000. Second shift it is how much? 19,000. Overheads here 5,000. Here it is 5 lakhs. Here it is 4 lakh 20,000. Repeat again. Once again. Project A investment how much? Project B direct labor. Project B project then second shift nothing, right? Overhead is there. Project B. Now tell me, dear students, which project should be preferred means generally everybody wants to become what is it? Rich, big, huge. Yes or no? So if I will prefer always go with which one? A. If I go with A means comparing to project B, I supposed to make investment of additionally how much? 16 lakhs. Yes or no? If 16 lakhs, if additionally I will invest in this project, Additionally, if I get NPV positive, in such a case, which project I will prefer? A. If I additionally invest that amount, if I get NPV negative, then B. That is the reason when there is a what disparity? Size disparity. You have to calculate incremental NPV, incremental IRR. You see here, additional investment you are going to make how much? 16 lakhs. And additional savings, how much it is? 4 lakhs. Because previously is 34 lakh, here is 30. Incremental overhead cost, it is going to increase. Hello? It is increase. How much? Previously 4.2. Now it is, if new machine take 5 lakhs, huge machine, and a small investment would be 4.2. Here it is outflow, this would be inflow. If you bring everything into present for the period, right, 1 to 10 years, you got 16 lakhs would be outflow, 24 lakh 57,840 would be inflow, then 4 lakh 91,568 would be outflow. Now if you calculate NPV, incremental NPV is positive. How much? So should we accept or reject? Accept. What is the size disparity? Sir, while evaluating two mutually exclusive projects, as per NPV, one project is preferable, as per IRR, another project is preferable. Whenever there is a size disparity, right, certainly NPV IRR conflict arises, sir. But this conflict can be resolved with what? Incremental NPV or incremental IRR. What is another disparity you have? Life disparity. Life disparity means one project life is 10 years, another project life would be 3 years. For example, here you have a two project, project A, project B. Project A life is how much? Project B, 3 years. Now which project would be best? We should not consider total. We should go with what? Annual. Hello? Incremental happens only what disparity, Maji? Size disparity. Life means annually. Total should not be considered. We have to go with what? Annual. In such a situation, NPV is given. In regular class also we discussed what NPV we calculated. Annual NPV. SRO? Annualized NPV equal to NPV divided by present value annuity factor or percentage n number of years. Here cost of capital in this problem is 12%. 12% 6 years. How much the factor value? You have to take 6.497. Here it is 6.497. 12% 6 year factor value 4.111. So 6.497 divided by 4.11 means 1.58. What about project B? Annualized NPV equal to 5.157. So 12% 3 years. How much it is? 2.402 because life is how many years? 3 years. So 5.156 divided by 2.402 equal to 2.1465. Now tell me annualized NPV, here it is 1.58. Here it is. Since annualized NPV is highest, thus it is a beneficial to accept. Which one? Project. Now size disparity. What NPV? Life disparity. Annualized NPV. Total should not be considered. Only annualized considered. And final one more concept is there before going to cash flow disparity. What is NPV? Adjusted NPV. What is adjusted NPV? Adjusted NPV, I gave a notes also. See, whenever any project undertakes with what is it? Do you remember this? My notes. What, Maji? So why I kept the last means this is my own work with the own written work. That is a typing work. This is written work. Adjusted NPV means a project which runs 100% equity. In such a case, they may calculate NPV, they feel very happy. But the thing is, that project could not able to get what? Tax advantage on debt. Hello? If the project moves 100% equity, such a company only thinks what is that? Adjusted NPV. Because that project could not get what is that? Tax advantage. So adjusted NPV means what is that? From the viewpoint of debt, we will look at the project. We are undertaking this project with the equity. What might be happens if the same project might be done with what? Debt. Hello? 100% debt. In such a case, we might have get what? Tax advantage. Let us take there is a company which took a 100% equity. They got NPV negative of 30 lakhs. Generally, we say that project should be rejected. But we know we can say that no. The same project, if you do with what is debt, you may get the tax advantage of 40. In such a case, your NPV is negative of how much? 30. Here tax advantage is 40. This 40 would be set off with this. Still you have what is it? 10. So such a 100% equity oriented NPV is called what NPV means? Base case NPV. For the base case NPV, we will add tax shield. Morning class MM theory. Market value of tax shield equal to debt into tax rate. For that base case NPV, if you add which one? Tax shield, then you will get what NPV? Adjusted NPV. Okay, base case NPV means the NPV which you estimated completely purely by what is it? Equity. This is called what is it? Adjusted NPV. Another one is base case NPV. Are you getting? So in the problem you have calculation. First what you have to do? You have to calculate base case NPV. Base case NPV equal to PV of cash inflow by taking what rate? KE, right? For that you have to calculate what? Tax advantage. Simply debt into interest rate into tax rate into present value of annuity factor. This is one formula. Very, very shortcut formula. Debt into, that is okay. Better than that. Debt into tax rate. You will get the market value of tax shield. If at all any flotation cost is there, you can take it. Now what to do means adjusted NPV equal to base case NPV plus savings of tax benefit from debt financing. That is flotation cost. So you know that in problem number 10 in your material also they are given. First we calculated what NPV? Base case NPV. Then we calculated tax shield on debt, and the debt is raised 280 lakhs. 280 lakhs into tax rate. We identified this. Adjusted NPV equal to base case NPV, PV of tax relief on debt plus what is it? Minus issuing of flotation cost. Tax benefit we added. Issuing of flotation cost we identified. So this is one more NPV. What is that? Adjusted NPV. So far what NPVs we calculated? NPV, incremental NPV, annualized NPV, modified NPV, expected NPV, certainty NPV, adjusted NPV. What NPV? NPV. I forgot an NPV. Okay. This is also one of the concept, Maji. With this last page we touched. 714, one concept we missed. What is it? Cash flow disparity. What is a cash flow disparity? Because cash flow disparity at last what we are considering, your parents have money now, you don't have money. But if you learn this concept wonderful way, one day you will have money, your parents won't have. At the time, don't say that I'm great. Okay? Because, my father used to say, Ray, your LKG fees, if I would have purchased MRF share price, okay, my dad would be very, very great, right? Sometimes my dad made very, very innocent decision. The innocent decision is he paid my school fees. Yes or no? Even if he knows what shares. MRF shares might be good. But the thing is, I'm giving a reasonable NPV. But the thing is, sometimes what happen, our parents make, what is it? More income, we don't have money. But one fine day we have money, but our parents won't. And one thing, particularly in Guntur 2 days back, I think last week it happened, Sattanapalli area, father has an insurance policy worth of 50 lakhs rupees. For the sake of 50 lakhs rupees, his younger brother killed his father. Anybody read this article, ma? No, you are on Bradipet only. But the conflict fight came in a distribution of who is going to get the LIC money. But not yet given, because LIC people means they are innocent kid kada. This person is died. If you say, sir, my father died. Okay man, take this money. Will they give? They will make these many analysis, then they will find it out. Simply what they do is, so it's not a right thing. Okay, coming to cash flow disparity means pyramid versus opposite pyramid. Pyramid versus opposite pyramid means one project initially gives, what is it? More cash inflow. Another project later period gives high. Such a disparity is called, what is it? cash flow disparity. When cash flow disparity is there, NPV, IRR conflict happens. This conflict can be resolved with what is it? I told you modified NPV, modified IRR. What is modified NPV? Modified is nothing but reinvested. Hello? Reinvested. What is that? There is a two project cash inflow is there. What we can do is we are not going to take cash flows of this project, cash flows of this project. This project cash flow we are going to reinvest outside, and this project cash inflow also we are going to reinvest. And after considering the reinvested cash inflow, basing on that we will take what is it? NPV means that NPV is called modified NPV. IRR is called modified IRR. You see, modified NPV. It is the NPV which is estimated basing on modified reinvested cash inflow. It is also called what value? Terminal value. Modified IRR means it is the IRR which is estimated basing on modified reinvested cash inflow. Steps to be followed. What is that? First, terminal cash inflow you have to identify. Then modified NPV equal to PV of modified cash inflow minus PV of cash outflow, and calculation of modified IRR. How to compute this girl is, see, theoretically you told sir, but practically how sir? See expression. How to calculate what is that? Modified NPV. Very simple. Cost of machine is how much? 10,000. Estimated life 3 years. Every year cash inflow how much ma? 6,000. Cost of capital is 15%. To calculate NPV, every year cash inflow same, we would have multiplied with the present value annuity factor minus cash outflow. NPV we will get it within second. But our job is to not to find what? NPV. We have to find it out what? Modified NPV. Here reinvestment rate first year 12%, second year 10%, third year 9%. What we have to do? You see, calculation of what NPV? Modified NPV. What we are going to do is, first year you are getting 6,000. This 6,000 can be reinvested 2 years. Why? Because you are going to calculate after considering third year cash inflow, you know. Hello? Whereas second year one, you can reinvest 1 year. Third year nil. But what is the rate? Here you can reinvest 12%. Here is 10%. Here 9%. So 12% if you invest at 2 years, 1 rupee will become 1.254. 1.254 means then 6,000 will become 7,524. What about 10%? 1.1. 1.1 it would be 6,000. 6,000 into 1.10, 6,600. 6,000 into 1, 6,000. So finally total modified cash inflow you are going to get at the end of third year would be 20,174. Now actually you are not getting multiple cash inflow, dear students. You are getting only one cash inflow. That cash inflow equal to what is that? 20,124. Are you getting? This is the modified or reinvested cash inflow. This cash inflow you have to bring into present. Modified NPV equal to PV of modified cash inflows minus PV of modified cash inflows. So 20,124 into present value factor 15% 3 years minus 10,000. You will get it of NPV how much? 3,242. Since modified NPV is positive. Like this you have to calculate project A, project B. Suppose project A modified NPV 3,242, 8,684. What do you do? Better to take which one? Project B. Okay. And how do you calculate modified IRR? Here also I will give one more problem for you. Modified IRR, let us take an investment 1,36,000. Every year cash inflow, here profit before depreciation but after tax they given 30,000, 40,000, 60,000, 30,000, 20,000. What you are going to do means you have to invest first all these cash inflow. These are the cash inflow, right? And years. This cash inflow 4 years, 3 years, 2 years, 1 year. And rate is how much? 8%. And I find it the future value factor. I multiplied with both. And I find it, what is that? Modified cash inflow. Up to modified cash inflow, modified NPV, modified IRR, modified up to 50% problem will remain same. Here you invested the cash outflow, you got the modified cash inflow of 2,13,517. Now you have to calculate modified IRR. Means IRR you calculate, you know that universal Maha Mantra. Calculate IRR means I know NPV. So modified IRR means PV of cash inflow minus PV of cash outflow at rate. What is it? NPV would be 0. If you bring the present value factor, you will find the factor value 0.636. By tracing this one, IRR lies between 9% and 10%. Then at a 9% you have to calculate NPV 2824. NPV at 10% minus 3370. Now using what is it? Interpolation, you can calculate modified IRR. Modified IRR formula L1 NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. It is nothing but 9.455%. So what is the difference between calculation of NPV and IRR? Nothing is different, everything is same. Only thing is there we take a cash inflow. Here you will take what is it? Modified cash inflow. What is another name of modified cash inflow? Reinvested cash inflow. Okay, Maji? So this would be your segment for this. Okay? But maximum, whatever the questions I identified and I gave, 90% solves your issue. But the thing is, even so far you are not at all good at subject. Even now onwards, just by analyzing this concept, you can crack the CA exam, no problem. But only thing is, while solving the problem, you are not going to get excellency. You by understanding each and every concepts. So what is the treatment this? So how to identify it? So if you once you have a clarity with respect to concepts, you can solve, right? All the best. Jai Hind. Milenge. But you are my students. There would be certainly one future days you maybe become the richest people in the world because of in corporate culture. That's why I took all the photographs of corporate culture. Hello, you see all the shoot people. Why? Because from till morning to evening, my students are always in Bradipet. So they always see these many people. But I want to give the fresh look to you people. That's why I took all the corporate people. You have to be like this, right? Thank you. All the best. Practice well.